The home supplies business, fourth quarter like-for-like sales coming in a little bit lighter than the market had anticipated. 4.6% on like-for-like sales growth is lower than they had expected, than the market had expected. But they're talking about another year of adjusted EPS growth, Guy.
Anna, European equities year-to-date have added over $1 trillion in value. Yes, bonds are given some of that back, but European equities are certainly higher, and we're expecting that to continue. Okay, Thursday's opening trade is upon us. Let's take a look, ring the bell, figure out what is happening. The FTSE 100 is up by 0.1%. It is expected to climb. Clearly, there are going to be some individual areas that we're going to keep an eye on what is happening in the oil space as well. But airlines this morning are in focus. Defence stocks remain firmly in focus. This key meeting that we are going to be watching out for. Got a series of names coming through with numbers this morning. Take a look at what is happening with Schroders as well this morning. We're going to be speaking to Merck a little bit later on. There are a number of earnings numbers that we need to focus our attention on. But the big picture macro story remains, it seems, in charge. The CAC is up by 0.6%. It is outperforming this morning. The IBEX is up by 0.3%. We await for Germany, as we do every morning, that it has been at the forefront, the vanguard of the story in Europe over the last few days. In fact, so far this year. So there we are. We're up by, let's call it circa 0.5% across Europe thus far, without the DAX having already opened. Tom, what else are we looking at?
Across your sectors, and as earnings and as the equity story in Europe continues to look through higher yields and the sell-off on bonds, when does that story start to adjust? Currently across your sectors, energy, to your point around oil prices, currently up 1.1%. Now, of course, oil in the last few weeks has been under pressure. You're seeing a bit of a gain coming through for Brent WTI in the session. Tech also getting a lift, up close to 1% as we wait at the DAX, with the focus, of course, on the auto sector on the back of the tariff story and the adjustments there around a reprieve, at least for a month, in terms of the automakers from Canada and Mexico. Currently, tech up 0.9%. Travel and leisure, to your point around the airlines, getting a lift, up 1%. Energy still top of the list across your sectors on the downside. Utilities, personal care and healthcare.
Yeah, real positivity around the aviation sector, then it would seem, looking at some strength out of Air France KLM. So that's one of the stocks that drives that travel and leisure move.
Entain also is up sharply higher within that space as well, more on the leisure side than the on the travel side. So you're certainly seeing some gains coming through there. In fact, from a percentage point of view, it's the second best performer out of Europe. Ellis, the only stock that is outperforming it. In terms of where the heavyweights are, it's interesting to see there is some dividend in the market this morning. So I think HSBC goes ex-dividend this morning. It is down as a result of that. I think some of the miners are also clocking a little bit lower, but Pharma giving back a little bit of ground, and Reckitt down by 2.5%.
We were speaking to Schroders earlier, and the CEO, of course, that company currently up close to 4%. The earnings story filtering through on Schroders, of course, in terms of asset management, AUM, a bit of a pickup there. They focus on the wealth business. The DAX still waiting for a print there. Here in the UK, the FTSE 100 currently flat. Over in France, the CAC gaining 0.6%. Just checking your sectors again. It's travel and leisure now top of the list, gaining 1.4%. Autos opening higher as well, as suspected, of course, gaining 1.2%. But there's been volatility there, linked, of course, to the adjustments around the tariff story.
Yeah, and does this growth in Europe mean that rates stay higher for longer? Markets adjusting their ECB expectations, and I see real estate is the worst performing sector today, so that would fit with that theme. Let's talk about where we are in markets. Bishwan Zhu joins us, a global equity fund manager at Royal London Asset Management. Really good to have you with us this morning. Another busy day. They're all busy these days, aren't they, Bishwan? Let me ask you about your outlook for European stocks broadly, because it's just, I mean, yesterday this whole story took on another another complexion, had another meaning, but infrastructure in Germany, defence spending across Europe seems to be the place where a lot of people are excited right now. How excited do you get to play those themes?
Yeah, so I think there is a short-term picture and there is a long-term picture. In the short term, the valuation across the European equity is still unassuming. And just let's remember, Germany and France, the two major economies, were still in recession. So the stimulus is going to be able to trigger cyclical return, and that's going to be positive for the European equity. But the long term, I think the biggest question is growth. So is Europe going to be able to generate growth? And I think that's not straightforward. If you look at the big picture, actually Europe has more challenges than before after the Trump presidency. There's a cost factor of defense. So that's for us to see. So we think it's too early to say there is a macro story in Europe yet.
Okay, really, that's interesting. Is that because the things they spend money on, defence, for example, you know, in the short term, you might need to spend it on US defence companies, not in Europe. Does it come down to how much of this is infrastructure spend in Europe as to whether we get that growth multiplier?
Yes, exactly. So, the kind of sea level changes, Europe has to take care of its own defence and pay for it. And the reality is Europe can't quite take care of its own defence yet because it hasn't quite the supply chain. So a lot of those orders will need to go to US. They will land in the US in a kind of near to medium term. And also, who is going to pay for that, right? And let's not forget, over the last year, all the incumbents were nearly voted out, and the extremism is on the rising. So you need to kind of finance the warfare state from the welfare state, and that's not a straightforward line. So the growth, is Europe going to boost the productivity and growth? That's really the long-term big question, and that's not straightforward.
Funding the warfare state with the welfare state. You talk about the relatively benign nature of valuations in Europe. Does that apply to the defence sector? What is the strategy around defence if you don't already have exposure in that area right now?
I think right now, if you look at over the couple of last weeks, the US stocks, the industrials, have come off quite a lot. And if you think about where the defense money will land, a lot of that will lead to high industrial activities in the US. So I feel that's an interesting area maybe to take the valuation opportunity and to add. And also if you look at tariff, right? So there's no way to predict tariff. But if you are a corporate, you are not able to predict that as well. What you would do is, if you are considering your next CapEx project, you are more likely to do that in the US. Again, that leads to increasing US industrial activities.
Does that suggest that the question marks about US exceptionalism are slightly overdone? Does the US exceptionalist story have further to run, despite the softness in some of the data that we're seeing?
From a long-term perspective, the US fundamental is less challenged than the other regions. So I think some of those exceptionalism is valid. But I think that this market reaction we had was also rational, because it was very much like how much this exceptionalism was priced. But now we have more room to... Yeah, we had a repricing of the US market slightly.
The US economy has outperformed over the last few years in no small part due to the fact that the fiscal spend has been enormous and European equity markets have been in its shadow. Now we've got a situation where we are going to see significant spending in Europe. Why do we not get the same results and European equities go higher as a result of what is happening on the fiscal front?
So at Royal London, we rarely invest just based on macro story. For example, our positioning, we were overweight Europe, although we were very pessimistic on the macro side. But that's just a result of the kind of mispriced cash flow we just saw in the European domestic business, in the industrial business. Yep. There was a long-term mispriced cash flow, and that we were overweight. Sure. So we think it's more important just be really selective instead of saying structurally go long US, or now we switch to structurally go long Europe. In this type of environment, what you definitely have is higher interest rate volatility, and you want to build up a portfolio that can fend you off that. It's kind of life cycle diversified, so you have something that works well in a kind of high rate environment, you have something work well in a growth environment, and you blend.
Is a diversified portfolio going to underperform again? Because that's been the challenge. It was a challenge when the US was outperforming. If you don't have European defence stocks right now, you are underperforming. How, as a portfolio manager, do you make sure that you can keep up with some of these moves? What do you need to do to make sure?
Yeah, with diversification, we mean like very high stock-specific risk. So
right.
You really make sure you discount for those uncertainties, and you really pick single stocks that.
Is that easy to do right now?
I think that's actually a great opportunity for active stock pickers, because those volatilities goes on, and that really, if you are very clear about what you want to buy, and that more often gives you the right price to buy than less. So we are actually quite excited. Change is good, and a lot of change is happening in Europe.
Yeah.
Certainly a lot of change, yes. Yeah. So what's most mispriced versus your expectations? What looks like it's I don't know, babies being thrown out with bathwater, or, you know, something that looks really wrongly priced right now, a good opportunity that you're looking at?
I think some of the mature industrial companies in the US and Europe are still mispriced. Because people think they don't have pricing power, etc. But if you think, and some of them are really good capital allocators, and in an inflationary environment, they would have the pricing power. And in a tariff environment, they have a changed pricing power, because you need to buy from them rather than import. So we feel like some of those mature, kind of late life cycle industrial companies in Europe and US remain very attractive.
Why do you have more faith in their pricing power than others in the market, do you think? What's causing that divergence of views on whether these big companies have pricing power right now?
I think that's slightly a different dynamic in the US and Europe. So in the US, it's basically the result of years of outsourcing and offshoring, so that you have a very consolidated market, and where the supply is very disciplined. So this industry structure, we feel, is underestimated. And for Europe, I think that's just the kind of payoff, the kind of how the cash flow is priced for some of those mature industrial companies remains quite large, because people just stream to the defense companies, etc. But then actually the input players into those companies, they remain quite cheap.
What's the potential pain point that you'd be watching for when it comes to higher rates in Europe, as we look at yields jumping and ECB cuts being faded out by the markets?
I think leverage is definitely a pressure point we need to look at, because this is the kind of spending extra 500 billion defense spending from Germany, and another 500 billion infrastructure spending. They're not funded. So will that lead to higher financing costs among the European corporates, especially small and mid-cap? So we saw that during the COVID crisis, when the supply chain, the energy prices bankrupt so many companies. So just beware of the balance sheet.
Does there come a point when the sell-off in the bond market derails the upside for European equities?
Yes, in the medium term, if Europe cannot show that those reforms are leading to higher growth, higher productivity, I think that's likely to happen. That's why I think there is no straightforward European growth story yet.
Bishwan, that's a really interesting angle. Thank you very much indeed for sharing it with us this morning. Bishwan Shu, Global Equity Fund Manager at Royal London Asset Management. Core 6 looks like this. This is the picture we are looking at. There's significant moves this morning in the aviation space. We are watching LVMH also go higher, ASML go higher. There is some weakness out there this morning. It's interesting that the pharma sector certainly is under a little bit of pressure. Let's figure out what else is happening. Joe's here with the details.
Guy, in these airline stocks today, specifically in Air France. Take a look at this one. It's up almost the most in 5 years now for that stock. It was in and out of a trading hole. It was up around 17%, opened up back now. We're up around 13% on that one. I've been asking traders in my chats what's going on with that one. They're pointing to the cash flow. The leverage seems to be improving at the French company, given they do have a big debt load. That seems to be easing now, and therefore the stock coming back up, actually continuing a decent gain. And also Lufthansa rising as well, pretty strong numbers out of the German airline, really. But Air France, the star of the show in the airlines today, a massive jump for that one. Then also in the logistics space, similar sector, we've got DHL moving, the company announcing a buyback and also they are trimming some of their costs. It seems to be feeding through into capital returns for the company, so another decent gainer for DHL. We will eventually get that one on the screen, I'm sure, but you'll have to take my word for it. DHL, we've got it down the bottom there. We're up almost 10% for that one today. Then we've also got Reckitt Benckiser. Don't think I'm going to have much luck with that screen. There we go, Reckitt. We've got that one. We're down 3% for Reckitt. Once again, weak sales, weak like-for-like growth for Reckitt. Not selling enough Sillet Bang, of course. And also, it is looking like the vaccine and some of their other healthcare drugs also looking a little bit weak. So the organic sales at Reckitt missing once again. More weakness for that stock. It's had a bad run over the past couple of years, of course, for Reckitt. Then in terms of gambling, Entain really strong in the US. All that NFL betting boosting the company. We're up 3.5% for Entain today. The owner of Ladbrokes as well, but got this big partnership with MGM in the US, so that one getting a boost. We're up 3.5% for Entain. Then over to the stock of the week, Eutelsat. Of course, the company did speak to Tom earlier as well. Now, this stock traded at the end of last year at €1. We're at €8.25 on Eutelsat. A huge jump. We're up another 5%. It doubled yesterday. All the news on Starlink, of course, boosting that one. And then finally, finishing on airlines where we started, but this time Ryanair. We're getting a downgrade from Morgan Stanley today, which says the valuation is too full on that one, and also seeing some increased costs, mainly related to fuel, according to Morgan Stanley. So come down to equal weight, but it does look like airlines getting a positive read from those Air France and also the Lufthansa numbers. So that one actually higher, but Morgan Stanley no longer a buyer of Ryanair. The stock's still up 1.6% this morning, though.
Joe, thank you very much. Joe Easton from our equities team. Tom, throughout the last hour of the programme, we've had a sort of drip feed of lines coming through from China. We're getting through the NPC, all these important meetings taking place in China. Yep. And today, monetary policy seems to be to the fore. We've been hearing from the PBOC and a big tech theme coming through this morning.
Yeah, yesterday at the National People's Congress, it was where they outlined the broad themes in terms of how they want to direct this economy from the Premier. Today, you're getting some details, as you say, from a press conference where you have the Finance Minister and you have the head of the PBOC, amongst others, giving detail. And they're putting money where their mouth is when it comes to that lean into tech. We've seen all the excitement about DeepSeek, and today Alibaba as well with a new model. And now it seems officials are wedded to the idea that AI innovation could be part of the solution in terms of reviving the growth outlook for the Chinese economy. And Peng Gongshang, the PBOC governor, saying they're going to expand tech re-lending to 800 billion yuan from 500 billion, and also lower some interest rates as well around re-lending when it comes to the tech sector.
What are they doing with the consumer? How do they get the consumer going? Seems to be the biggest challenge that China faces right now.
That is a much bigger challenge than the overall impetus and catalyst around tech, at least for now, for China. And interestingly, and we have some reporting on this from the Bloomberg today about how the pressure from Trump, not just in his second term, but in the first term as well, 1.0, not 0.1, has led to a focus from policymakers in China to revive the consumer, to try and support the consumer around and away from manufacturing and exporting. They still have a lot more to do on that, but they have stressed that, and they did stress that in the language yesterday in a work report from the National People's Congress. Now that needs to be implemented as ever. But the consumer drive, they've woken up to the fact they do need to enliven the spirits of the consumer in China.
Yeah, absolutely. So we focus on whether we get more fiscal stimulus out of China. Coming up, we bring you an exclusive conversation with the CFO of Germany's Merck after the drug to semiconductor firm. It does all of those things. Forecast slow profit growth for the year. That's next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. Shares in Germany's Merck KGaA trading higher this morning after reporting earnings, saying it sees slow profit growth this year. This is the company's life sciences unit, continues its recovery, while its semiconductor division sees growth from the AI boom. Joining us for an exclusive conversation is the CFO of that business, Ellen von Roeder. Helen, thank you for joining us this morning. Talk us through what stands out to you from the results, how it sets the business up going forward. Slow growth, where are you in recovering from part of that COVID slump?
Hey, good morning from sunny Darmstadt. So overall, I mean, 24, we ended up pretty strongly on profitable growth, delivering on our guidance. And what we're seeing is a very strong year-end, especially in Q4. All three businesses went back into profitable growth. And that's ultimately what our guidance is about for 25. We are very confident in the future. We do see that growth theme continuing. And as I look to the three business sectors that we have, life science, process solutions, coming out of destocking, coming out of the COVID issues that we had, and basically going back into our midterm guidance trend. Healthcare delivering, as we know, and as we continue profitable growth over our established and novel portfolios. And then, of course, electronics benefiting very much from the continued AI boom.
Hello, good morning. It's Guy. A 25 billion euro sales target was talked about, and it was potentially going to be reached this year. How far away is that target right now?
So if you think back when the target was issued, that was issued during COVID heights. It was pre-Ukraine war. So overall, I think 2 years ago, we even took down the target because ultimately it was something that we had issued in the past. If you look at our guidance, definitely 25 is not a year where we're going to deliver the 25 billion. I think that's fair to say.
Okay, so you won't get to 25 in 2025. Good morning to you, Ellen. Let me ask you about semis. You mentioned that the AI boom is helping, of course, the semiconductor part of the business, the electronics part of the business, and that makes sense. But in the broader semi space, what can you tell us about that? Because there's the AI side, and then there's the sort of broader, more consumer-facing side. How's that performing?
And indeed, that's a market of two stories. Number one, you have the AI side, you have the advanced nodes where we are very well positioned and we're seeing double-digit growth in that area. But then you have the sort of broader market where on the back, in my opinion, of actually pretty weak consumer demand still, we're not seeing the recovery we had hoped for and that normally you would see at the end of the semiconductor cycle. Most people and experts you talk to is like right now targeting a H2 recovery in that sector. Let's see. I mean, you also had a few news out on China, the China consumer. Let's see how the US consumer is behaving to see to what extent that market return will accelerate or not.
Helen, what are you doing in terms of the tariff impact? How concerned are you about tariffs, and what specifically are you as a business doing to mitigate some of that impact?
So we're a 350-year-old company, and we've been dealing with a lot of uncertainty during our tenure. Overall, we are basically relentless focused on customers and our clients globally and delivering for those. What we have done in the past and over the last couple of years is to really make sure that we spread our CapEx across the regions that we serve. You may know our business is more or less a third, Asia, Europe, and the US. And we've now really localized our supply chains. We've really localized our production facilities. And as a result, feel we're very well positioned around the current geopolitical tensions. All of the CapEx and all of the uncertainties are very much a CFO bonanza because, I mean, we are scenario planning left, right, and center. And I can tell you the answer is agility and reacting to what comes our way.
But a lot of uncertainty, and it's amazing that we've seen suddenly Germany becoming the epicenter of a growth story in Europe, the government potentially spending significantly more money, infrastructure spending, defense spending. Does that change your perspective once again? It's another big surprise, and I'm wondering in your home markets, in Darmstadt, how that potentially could be felt. As a senior leader at a large German company, how are you viewing this?
Overall, I think we are really looking at Europe with a massive potential. The thing is, like, we as Europeans need to get together, and I think that's happening right now. Europe is really understanding what its role in the global orchestra is and how they need to deliver. So I'm super confident and super positive around politicians, society, but also the economics pulling together and making sure that we finally deliver on what Europe's promises. So I'm actually quite excited here.
You say you're a third in different regions. Will you be more Europe, Hélène, soon?
Overall, as I said, it's like we service a global customer base. And per se, we are seeing opportunities across all three regions. So at this point in time, I'm not sure we're going to pivot one way or another. Because all three markets and all three segments offer very strong opportunities for us. Don't forget, we're very much centered in megatrends of this globe. And they are more or less across the globe the same way.
Okay, Hélène, thank you very much. Thanks for joining us. The CFO of Germany's Merck KGaA, that's Helen von Roeder. Thank you very much for joining us. We will stay in Germany with the ECB in mind. Coming up, the European Central Bank is widely expected to cut interest rates again today. That'll be the 6th time since June. We are going to go to Frankfurt. We'll get a preview because even if today looks pretty simple, where we go from here looks less so. And a lot of economists and others very divided on what we are going to hear for the rest of this year from the ECB. This is Bloomberg.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields.
On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China Show live every weekday.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome back. This is the opening trade. We are 30 minutes into today's session. The gains coming through on European stocks being faded somewhat, just up 0.3% after a solid day yesterday. Of course, the tariff news, the adjustments around the auto sector, but the continued focus on the defence spend. Here in the UK, the FTSE 100 actually down 0.5% at 8,712, but a decent session over in Germany. The DAX up 1.2%. We lead up, of course, to the meeting as well. The decision from the ECB, the European Central Bank, is poised to cut interest rates today at a time, of course, when the bond sell-off continues and yields are up. For the 6th time since June, the volatile economic backdrop is sowing divisions over the path ahead. Traders now favouring just 2 more rate cuts by the ECB this year. That adjustment coming through. Let's go to Lizzie Burton, who's on the ground for us in Frankfurt with a preview. A cut fully expected then, Lizzie. What else are you going to be watching for today?
But it's all about the path ahead, Tom. And even before all of the tariff news and the defence and infrastructure spending news, I'd have told you that anything could happen after April, because analysts are divided, the Governing Council is divided. One analyst says that today could be the last cut of the cycle. Other analysts are saying that you could have cuts all the way to 1% by January 2026. And it's because, if you listen to the ECB Governing Council, some of them are still worried about sticky services inflation and higher energy costs. Others are worried about sluggish growth in the euro area. But this week, we did get some encouraging data on the inflation front. We had services inflation falling below 3.9% for the first time since April 2024. In the fourth quarter, you've had a bit of easing on the wage growth front. And both of those things can give confidence to policymakers, maybe, that actually they will get inflation back to that 2% target in the coming months. So I'd say the big tell for markets is going to be, do they drop the language that describes policy as restrictive? Because if they do, that would be seen as an indication that actually there's going to be a pause in these rate cuts, or maybe an end to these rate cuts. But if they don't, that would be read as a big signal that another cut is coming in April.
OK, so we watch that use of language very carefully, Lizzie. Economists seem divided on where we go from here. Governing Council members seem pretty divided on where we go from here. And the German fiscal boost just coming this week, that must change the calculus a little.
Totally. I'd love to be a fly in the room for this meeting, Anna, because it is seen as a paradigm shift. There was a historic move in markets yesterday on bunts, and lots of analysts binning their euro-dollar parity predictions. But crucially, as you said earlier, traders paring their bets on ECB cuts for this year, because they see a boost to growth from this. I think it's Goldman Sachs sees a 2% boost to German growth off the back of this, up from 0.8% for next year. And so if we look at that, actually it means that you need to pass what comes out of Brussels in this European Council meeting, but in the press conference, I'm sure Christine Lagarde is going to be asked, what is the ECB's role in response to this? Economists at Allianz are saying, if you've got heftier budget deficits, if you've got spreads widening, do they need to come back and restart these large-scale bond purchases through the transmission protection mechanism? You need to you need to weigh that with the tariff threat, but I am sure that the ECB will be telling you, we don't make policy, we don't make projections off the back of threats, and at the moment, that's all Donald Trump's trade tariff threats are.
Lizzie, thank you very much. Bloomberg's Lizzie Burden in Frankfurt, of course, and we'll bring you full coverage of that ECB decision from 1:15 London time here on Bloomberg TV, with the ECB President Christine Lagarde's news conference coming at 1:45. So much to talk to her about during that news conference.
Absolutely. Let's continue the preview of what we are expecting in Frankfurt a little bit later on. Moritz Kramer, Chief Economist and Head of Research at LBBW, joining us around the table. Good morning. Nice to see you.
Good morning.
Does Christine Lagarde have enough information to make the right decision today? We don't know what's going to happen with tariffs. German spending plans are being unveiled, but there's a lot of kind of uncertainty around all of that. Everything seems to be in flux right now.
Absolutely. I mean, economists always say that the forecast is very uncertain.
Yeah.
This time it's really true, actually, because we're seeing huge shifts both in the international trade arena, but also what was announced from Berlin this week. I mean, these are very big moves, which are very hard to price. So today, the cut will come, but what will also come today is new forecasts from the ECB staff. And I would expect that the forecasts are going in the wrong direction, meaning that inflation is probably going to be ratcheted up a little, and growth is going to be moved down.
How wide do you think the fan charts on the available kind of information are at the moment? How wide do you think the jaws are? The kind of, what do the tails look like, and how important are those tails?
Well, some observers would now speculate they were almost done. I think that's probably not right. We have the discussion starting, probably triggered by Isabel Schnabel, and that's a good thing. You need to have this conversation. You cannot just go on autopilot, meeting after meeting after meeting. But that doesn't mean that we're there yet. So I think there's still a couple of rate cuts left. And partly I say that because I believe in Donald Trump, not in him as a person, but as actually doing what he's saying he's doing. So I would firmly expect that some sort of tariff threat will materialize, and for an open economy like the euro area, that's a big deal. So so we will have sort of more dampening pressure on prices, on wages, because the real economy is subject to downside risks.
Moritz, does that mean, good morning, so from what you said there, do I conclude that you think the negatives from tariffs are bigger than the positives from European fiscal spending? Because this week we got really excited about possibly more growth in Europe, but you're saying actually you think the ECB will keep cutting because inflation won't be a problem. Is growth going to underwhelm because of tariffs as well?
It's a matter of timing as well. I think the tariffs will act much faster than the fiscal expansion. And the fiscal expansion, we're really talking about Germany here. So we need to, I mean, I welcome sort of the reform of the debt brake. I've been calling for that for a long time. I don't think it's a necessarily good idea to borrow for defense, because that's a consumption expenditure and that should really be paid out of current revenue. But so the investment will be ratcheted up, and that's absolutely necessary. I mean, infrastructure in Germany, digitalization, schools, universities, waterways, rails, etc. There's been so much that was underinvested over a quarter of a century. So this is high time that this is being done. But let's not believe that this is starting tomorrow. I mean, this takes a long time. You have nothing shovel ready, really, to that extent. The companies, the construction companies don't have the capacity. And what we also need to address is the complex mechanisms in actually getting the money out of the door from the budget. Remember, we used to have a debt brake, but we also used to have surpluses. So it was not a matter of money alone. The money was there, but it was too complex. So every year, money was left over in the capex budget of the government. So they need to work as well and just becoming more agile in spending.
Okay,
and only if that happens, I think next year we might see some positive impact. But what I just heard, 2% extra growth, I think if you believe that, you're set up for some disappointment.
Because it's just going to take longer, to deliver, I suppose is what you're saying. When you look at some of the well, we haven't got a lot of detail maybe on the German spending plans yet, but in terms of the balance between spending on military and then spending on infrastructure, what are you assuming will be the multipliers of this fiscal spend into growth? Because if it's all military in the short term, maybe it goes to the United States, but it isn't all military. There's a lot of infrastructure spend as well. So how much of a multiplier should we factor in?
I would think the multiplier from the military side is less, partly because there's no free capacity in the defense sector. If you look at the order books of the major European defense manufacturers, they are full. They have a pipeline of 2, 3, 4 years, some of them. So some of it will have to be imported, yes, and that actually detracts from growth. So that's actually a negative to growth if you import. So the multipliers will be much larger for infrastructure investment, and that's the nature of the game, because it's investment. So investment creates future returns, and it's perfectly fine within the limits of reason to borrow, because you will have these future returns. So that I see quite positively. I think if there is credibility and if the construction sector can actually prepare for this, and it's more than just, and it's set up for 10 years. That's very good. That gives companies a lot of visibility. Yeah. So that's going to be the bigger issue.
Maurice, you're saying you do take Trump at his word when it comes to the threats around tariffs for Europe. What are you modelling in terms of the economic impact specifically of those tariffs?
Much will depend on whether Europe will retaliate, which it will probably be doing in part. So the estimates that I would endorse would say that probably if you have a 25% tariff, which is sort of the announcement that he made, and this comes sort of April, say, which I think is a plausible scenario, we would probably see growth declining in Germany by 0.5, a little less for the euro area overall, because the euro area is less dependent on exports to the US. But that would push even the euro area close to recession. And that's, to come back to the beginning, that's why I think that the ECB is not done yet.
And you think the ECB gets below 2% by the end of the year?
No, I think 2% is probably where they're going to land. But again, the uncertainty is such that I think it would be unwise for Christine Lagarde now to give, and she will not do that, but to give guidance on where they will land. But I would not endorse views that say we go to 1.5 or 1. That would require really a calamitous recession that's currently not on the horizon, even with Donald Trump in the wings.
German bond yields rocketed higher yesterday. The rest of Europe rocketed higher yesterday in terms of its yields. Germany doesn't have a debt to GDP problem. Many other countries do have a debt to GDP problem. Is the ripple effect out of German spending into higher yields elsewhere going to cause problems in places like Rome?
It's certainly not welcome there. I mean, that's the irony of it all, no? The rest of Europe has always been calling on Germany to create more demand and reduce the trade surplus. Now they're doing it. Now it's negative as well. So you have got to take one or the other sacrifice. So I think this will heighten the pressure on sort of weaker sovereigns in the euro area from the market side, not so much from the rating agencies, but from the markets. And on top of that, we also have, of course, the initiatives to loosen the conditions of the Stability Pact for allowing more spending on defense. So, the markets don't really care whether it's inside or outside. The limit, it's there. It's debt. Yep. So I think that is a risk. And we still have a situation where cheap bonds are being refinanced at much higher coupons. Now the coupons are going higher still. So that will create really pressure on the budgets. And if we carry on like this without sort of having a vision on how to rein in deficits, not only in Italy, I mean, France is the bigger beast even probably on this. It's not going to end well. So we need this plan. Now there are other urgent things to address, like defense. What are we going to do without the US? And that requires more spending. And again, my preference would be to have some sort of revenue-raising mechanism, like a solidarity surcharge or something like that. But that's probably politically infeasible. So there will be more debt. But we must not have this as an open-ended window of increasing borrowing.
Yes. So is there something that Germany will be under pressure to do, Moritz, to make this pain less for France, for Italy, in terms of higher yields?
Well,
that might not be the right way to phrase the question, but how does that political pressure come to bear?
Well, that would mean that you have that you borrow less, right? I mean, it's a supply and demand issue. So we had this huge move in the bond market yesterday because of the expectation that the supply will go through the roof from Germany, which probably is a bit of an exaggeration. This will be much more gradual. But that would also mean then that if you borrow less and give relief to France and Italy and others, that you spend less on defense, for example, or less on infrastructure. So you've got to have it one way or the other.
Do more joint debt? Does that help? Also politically difficult?
I mean, that's obviously something that the French want because they have little fiscal wiggle room, if any. So the experience, I would say, with Next Generation EU is not so compelling that you need to do this for defense as well. And for Next Generation EU, you had some investment spending where you could argue that the returns from this investment will actually help to pay back the debt. This one, on defense, this is no payoff unless you're sort of planning to have a war of aggression and exploit the other countries, which I don't think is currently what we're looking at. So, no, I think joint issuance may still be in the discussion, but it looks more like that we're going towards sort of more generous wiggle room on the deficit rules.
Okay, certainly being talked about in Brussels today then. Thank you very much. Moritz Kramer, Chief Economist and Head of Research at LBBW Bank. We thank him very much for coming to speak to us. So it'll be a topic of conversation at the ECB, of course, Guy, and then in Brussels, where EU leaders are meeting. Yeah,
we've got a council meeting taking place today in Brussels, leaders meeting to talk about what they are going to do next. An emergency set of talks designed to push through and mobilise this defence spending that we've just been discussing with Moritz. We are live in Brussels next. Yesterday, we heard from Ursula von der Leyen. Today, it's going to be interesting to hear what the leaders have to say. That conversation is next. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
In response to the historic appeal of the future German Chancellor, I have decided to open the strategic debate on the protection afforded by our deterrent to our allies on the European continent. Whatever happens, the decision has always been and will remain in the hands of the President of the Republic, head of the armed forces.
The French President Emmanuel Macron addressing his nation last night ahead of today's EU leaders' special summit, emergency summit, on the subject of defence and Ukraine. Let's have a look at how some of the companies that are connected, of course, to this defence story are trading today. We've seen weeks of slowly pricing in and then days of very quickly pricing in faster defence spending, more defence spending here in Europe, and that continues to some degree today, although at slightly slower pace for some names than we've previously seen. Melrose, on the other hand, we spoke to Peter Dillnot, the CEO of Melrose, earlier on. That stock now down by 11%. Perhaps sticking to guidance, Guy, was the line you were mentioning.
There's been a huge ramp up in the stock. They basically confirmed guidance. Was the market hoping that guidance would be raised?
Yeah.
He was a little bit more cautious on that. He's talking certainly about quite a positive defence picture going forward, but they stuck to guidance. Is that what is causing maybe the unwind of the recent rally?
And defence, 1/3 of their business, as he pointed out to us. Let's stick with the defence theme then. Bloomberg's Oliver Crook is in Brussels at that EU Leaders Summit and can give us a sense of what to expect. What are we going to hear today? We already heard from Ursula von der Leyen earlier this week, of course.
Yeah, so listen, Anna, if there's been a wake-up call since November that we've been hearing from European leaders, as they've been repeating to us since then, this is really the week where Europe got out of bed, right? So everything from the EU proposals, what is going to be discussed today is some of the things that were unveiled by Ursula von der Leyen earlier in the week. We should just remind our viewers of what those are: about 150 billion euros worth of direct lending from the EU, another 650 potentially being unlocked by basically easing fiscal rules across EU member states in order to basically be able to debt finance without any consequence defense spending. And we should also say that the really largest sea change here, yes, it is at the European level, but it's really fundamentally the thing that is driving things is at the German level. We have a German chancellor-to-be who is actively lobbying. The German chancellor that's coming in is actively lobbying to the EU to loosen fiscal rules. This is a seismic shift from the Germans. We're talking about establishing funds, working around the debt brake, potentially nearing, it could be 500 billion in terms of the infrastructure fund, maybe several hundreds more in terms of defense. That is really the moment here. And this is Germany really waking up, beginning to flex its fiscal muscle. And you have to sort of plug this into the bigger picture here. Generally, on a day like today, when we think about the markets, we look to the ECB. We think about what the ECB is going to do. We are now shifting to a world where it's from monetary policy driving the markets to the fiscal policy driving the markets. I mean, what could the ECB possibly do to move German borrowing rates by 40 basis points in 2 days? Never has happened in the past. It is now a fiscal story.
Yeah, and what lit the fire, arguably, was, of course, the fallout, the very public fallout between Trump and Zelensky of Ukraine. Yesterday, of course, the US cutting off intelligence flows to that nation. To what extent, is that being seen as just a leverage, a point of leverage for Trump, or is it seen as something more concerning for Europe, for Ukraine, and how Europe responds?
I mean, listen, I think it's this is the sort of key to negotiation. It's being seen by the Europeans as both, right? It is actively going to have damaging consequences for the Ukrainians in their war efforts. Of course, that follows the halt of arms that are now basically not being delivered anymore to Ukraine. But it's also just one of many levers that Donald Trump can continue to pull if he wants to exert more pressure on President Zelensky. President Zelensky, who will be in attendance to some of these meetings a little later today, he'll be in Brussels to discuss with European leaders. And the real question is, and unfortunately it's It's a question we've been posing for a very long time, and the answer may be not a whole lot more, is what can these European leaders do in terms of actively delivering, in terms of hardware, to supplement what we've had from the United States. We've heard from European officials that basically there's enough hardware from the European side to continue to support Ukraine basically until the summer. But at the end of the day, the wake-up call that arrived for the Europeans may have arrived a little too late for Ukraine, for whom it will take many years to develop a lot of the infrastructure and the hardware that needs to be delivered. But again, we'll see what they can come up with in this meeting.
Ollie, great stuff. We'll look forward to the details and the coverage a little bit later on as we work our way through the day. ECB Council meeting, two big events taking place in Europe. The bond market continues to react to all of this. Bunds continue to climb, higher yields. Bunds continue to sell off with higher yields, probably is a more accurate way of putting that. Valerie's here with all the details.
Yeah, what a day it is. Like we're headed for maybe another double-digit gain to the bond yield today, getting very close to 3% on the German yields. And my question is, you know, are there other countries out there who are going to be struggling with this current rise in yields? One of them, in my mind, goes to the UK, who's already promised more fiscal spending when it comes to defense, has not promised very much when it comes to cutting other spending programs on the back of it. But thankfully, the OBR has likely already taken their snapshot of the market for the spring statement later this month. So maybe Rachel Reeves gives a bit of a reprieve there, that this recent rise in yields won't necessarily eat into her fiscal headroom on paper when she does make that spring budget. Well, the other thing from the Macron address to the nation yesterday is he ruled out raising taxes, meaning that this extra defense spending that France is going to want to do has to come alongside cutting welfare programs. Elsa, I really think you're really pushing the return of the bond vigilantes when it comes to France and the UK. Yeah, that could be really interesting, because even if Germany has their headroom and the bond market's quite relaxed about that, as it ripples across Europe, it can have unforeseen or very foreseen consequences, I suppose. Interesting to see, and yeah, we spoke to a guest earlier who was talking about warfare needing to be paid for with welfare, and so that starkly illustrates the choices that are being made by various governments. Interesting that stocks are actually flat now in Europe, Valerie, raising their gains. Stock 600 is flat, US futures pointing lower. Wondering where the session from here goes, because we've been talking about some trends that are a couple of days old now.
Yeah, well, okay, I think the one big thing for the market is Lagarde's tone this afternoon. Does she reflect any of this market exuberance in her speech, or is she still going to be constrained, talking about caution ahead, maybe mentioning the tariff war in the path ahead? Because, you know, the market might already assume that some growth impact from these fiscal spending programs could be baked into their forecast. But if Lagarde doesn't today, because she says maybe it's too soon to take that into account, she'll spin a dovish message, which means, I mean, euro could be at 110 before we know it, right? If she maintains the fact that they still want to cut, that they see caution ahead, that they're worried about GDP growth, not necessarily worried about inflation, and those cuts are back on the table all of a sudden, you know, you could see the European currency definitely take another leg higher if she maintains that old line.
Some European exuberance. Valerie, thank you very much indeed. Let's carry on with that kind of European exuberance theme. We spoke to the CFO of Merck a few minutes ago. Listen to this exuberance.
All of the capex and all of the uncertainties are very much a CFO bonanza, because, I mean, we are scenario planning left, right, and center. And I can tell you the answer is agility and reacting to what comes our way.
Excited. Expecting to see more. I think she went on and was even more excited. But it's interesting. We talk about the animal spirits. The US has had animal spirits being unleashed over the last few years. If it's translating this quickly into exuberance at a CFO level, not normally known for their exuberance, then maybe actually animal spirits arrive.
Moritz Kramer suggesting that maybe we need to keep our hopes of those animal spirits just a little bit tempered because of the time it'll take to deliver.
He thinks the ECB forecasts are too bullish on growth. He sees 0.5% of growth this year.
Dare I mention the T-word tariffs, and we'll be back to talking about growth threats. Right, the pulse is up next. This is Bloomberg.
the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
EU leaders gather in Brussels for emergency talks as they scramble to mobilize additional defense funds. Now, the French president says he'll open talks on a European nuclear shield. German bonds fall, extending their worst daily drop since 1990, following the nation's historic spending plans. Plus, the European Central Bank will most likely cut rates today, but tensions cloud the path ahead. Now, also coming up, we'll discuss the bond sell-off, tariffs, market uncertainty, and AI with Joe Davis, Vanguard's global chief economist and global head of investment. First thing is first, let's take a look at the European markets map. Again, we've seen this route really start in Germany as investors focusing in a lot on what the debt market will do. The picture across the board, if you look at equities, look, the FTSE down some 0.8%, the DAX a little bit up. Again, this depends on whether you have a lot of stocks that are very prone to defense industry or aerospace industry, and that kind of in these days actually gives you a more indication of what that index will do in the next couple of days. Let's move it across asset, because of course the big story is a global bond sell-off continuing due to Germany's spending plans, which are expected to reshape the growth outlook on the continent. We're seeing big moves. Germany, the 10-year 2.885. It's also filtering through not to other asset classes, but the fixed income space as a whole. And then euro-dollar 107.93. It's quite priced in that actually the ECB cuts today, but then the governing council is divided between the hawks and doves of what they should do next. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. A global bond sell-off driven by geopolitical uncertainty. For Europe, it's a watershed moment for collective security. Oliver Crook is in Brussels as EU leaders discuss how to ramp up military spending across the bloc. Lizzie Burden is in Frankfurt for the ECB decision a little bit later as central banks navigate this new reality. But first, I'm joined by our EMEA news director, Ros Matheson. Ros, there is, again, a lot going on, and you're seeing a lot of the spending plans now infecting a lot of the market. The French president gave this address yesterday that was quite presidential but also quite worrying, where he talks about a nuclear shield. Is this just the latest effort to try and counter what's happening between the U.S. and Putin?
Well, it's really a signal that for Europe, at least, the fabric of the security umbrella involving the US is breaking down or is no longer seen as reliable, because for decades the US has helped provide that nuclear deterrent for Europe as a whole against perceived threats, including Russia. And France is the only EU state that has nuclear weapons. Obviously the UK does as well, but is not in the EU. And a recognition really from Macron in that speech is that, well, we can't rely necessarily on the US to continue to provide that nuclear deterrent, so maybe France now has to provide that for the rest of Europe on its own. And obviously that's a delicate one at home for Macron to say that, but we can see, you know, the messaging that's coming from him in those remarks. And also after Germany, with the incoming Chancellor Friedrich Merz did actually say, France, maybe now you need to provide that nuclear umbrella. Again, all of that is saying we no longer feel we can rely on the US in the minute.
Yeah, and Ross, this is ahead of the EU leaders meeting today to discuss ways to unlock billions of euros to boost European and Ukrainian security. This comes after, as we were just discussing, Emmanuel Macron said he'll enter into talks to use the nuclear capabilities to defend European allies. So let's also go to Brussels, where Oliver Crook is standing by. Ollie, I mean, there will be a number of options on the table, but can we actually expect anything concrete today?
Yeah, I think we can. I think that we get sort of what we're going to get concretely are some of the outlines that Ursula von der Leyen laid out a little bit earlier in the week. And we're talking about unleashing hundreds of billions of euros in a bunch of different sort of avenues. One way is direct lending from the EU, 150 billion euros. They're talking about easing the fiscal rules. That would mean that basically member states would not be subject to the debt rules that the EU has over their members when it comes to spending on defense, i.e. you basically have no more limit in terms of how much debt you can accrue, debt financing defense. And what is a sort of really sort of peculiar and very interesting and probably the most significant part of what we're seeing right now is that you have an incoming German chancellor from the CDU, Friedrich Merz, who is actively lobbying on behalf of Germany to ease fiscal rules in the EU. That is something that is really without precedent, in addition to the fact that the Germans are now easing the debt brake, as we've talked about. So in a certain way, I think that Friedrich Merz's announcement is even more significant than anything we've got out of the EU. In a certain sense, he is the one who is making sort of the biggest waves as far as defense is concerned. And he's not even going to be in those leader meetings. He's not yet chancellor, though he is at the EPP pre-meeting, which is where we are right now. He just walked in where they're discussing with their lawmakers and other leaders within the EU, within the EPP party. But that is going to be the main focus today for European leaders. The other two things we're going to watch very closely for, Francine, is how active is the conversation about joint debt within Europe to defense, for funding defense, and also what are they going to do with these Russian assets? How active a conversation is that? And again, Francine, we should just say that on a day like today, we tend to look at the ECB for market moves in monetary policy, but right now it is all about fiscal. The ECB couldn't move German yield by 10, 20, 30, 40 basis points over 2 days.
Yeah, the ECB couldn't, but they have to deal with the fallout. Ollie, thank you, Ollie Crook there. Now, the European Central Bank poised to cut interest rates today for the 6th time since June, though a volatile economic backdrop is definitely showing divisions over borrowing costs. Let's go straight to Lizzie Burden, who's in Frankfurt for us. Lizzie, I mean, if you look at the ECB, they have a lot to contend with. Market moves, growth, instability. How will they respond?
Yeah, you're completely right. And even before all of that news, Francine, on tariffs and defence policy, it was already kind of wide open what happens beyond the April meeting. Today, pretty much nailed on in terms of a cut, but the Governing Council really divided between the hawks concerned about sticky services inflation and higher energy costs, and the doves still worried about sluggish growth. If you look at the analyst path expectations ahead, some say that today could be the last cut. Some say that you could cut all the way to 1% by 2026 at the start of the year. So today they are also, of course, going to be asked about all of you've just talked about in terms of the whatever it takes package from Friedrich Merz, the expectation that it is going to boost growth. Goldman saying it could be 2% for Germany, up from 0.8%. And most importantly, traders therefore paring their bets on ECB cuts this year. But then you also have to factor in tariffs, right? That is the elephant in the room. Donald Trump, the elephant in the room of this meeting today. But I'm sure that Christine Lagarde's position really is going to be we can't make policy or projections based on what is at the moment just a threat.
Lizzie, thanks so much. Lizzie Burden there at the ECB. There's full coverage of that ECB decision from 1:15 London time. Of course, with ECB President Christine Lagarde's news conference at 1:45. We're back with Ross Matheson. Ross, I mean, there's so much going on. I guess the million-dollar question is, can Europe stay united? Can they find the funds and try and get organized?
Well, that's the question for today's meeting also, because some of the things that they're talking about on defence, they don't need everyone in the EU to sign up for. They don't need that majority of all states to say yes. And so they can do it even if Hungary, for example, which is the one we're talking about, says no. But the really blockbuster fundraising that they will need, if they are thinking not just about defence today, tomorrow, but 5, 10, 15 years, is do they have to look at joint financing? And that requires everyone in the EU to sign on. So the really high numbers that are possibly needed to build out these armies in the way that some European leaders are talking about, that requires the EU to row together. And it's very clear that Viktor Orban is a bit reluctant on some of that. He's certainly reluctant to have anything tied to more aid going into Ukraine. So how do you split that off? Where you talk about building your own defence, but not necessarily meaning that you're sending more weapon shipments and so on to Ukraine. So a lot of complexities to navigate. But even if we get there and EU leaders get to the point of saying this is what we agree on, weapons just don't magically grow on trees. I mean, you have to get contracts done. You have to get companies to agree to take those contracts, to build their production lines. They like certainty mostly from long-term defence contracts. If they're going to change everything that they're building and how, they want to know that contract's going to be there in 5 years. And so this stuff gets very slowly moving. But I guess the argument is if you don't start now, then when?
Yeah, thank you so much, Ross, for, of course, that terrific briefing. REMA News Director Ross Matheson. Now, coming up, German Bunds extend losses, putting pressure on global debt markets. We'll get the view next from Joe Davies, Global Chief Economist and Global Head of Investment Strategy at Vanguard. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back, everyone. Now, German Bunds extending their worst daily drop since 1990 following the nation's historic plan to boost defense spending. Now, the rout, of course, putting pressure on global debt markets. Let's bring in Joe Davis. He's global chief economist and global head of investment strategy at Vanguard. Joe, thank you so much for joining us. There's a lot going on, and especially in the market space today, there's a lot going on because there's questions, of course, about how Europe and Germany can afford to do all of this. Where does this go?
Well, I think for Germany and for Europe, I think we're looking at, for the sustainable future, higher structural deficits. Now, why should I care as an investor? They're generally supportive for growth, not massively so. But I would say for investors, look at what happened in the United States 2 years ago. That was the primary reason neutral rates rose and the fair value on the 10-year Treasury rose. So if you map what may happen in Europe with the Bunds and curve, that points to a neutral rate that's markedly higher than where it was just a few months ago.
And this has huge implications, of course, for euro, dollar, for ECB, kind of for everything. So you're expecting
fiscal
more of a
thrust matters if it's sustained. That matters for the neutral rate.
So what are you buying up right now?
Well, again, I think you have to think about fixed income as an overweight in a position. We've been articulating that for clients for over a year, partly because of this structural higher neutral rate. You also have high valuations in the U.S. I mean, we've been on that theme for 2 years, and we're not going to pick the top, but we're underscoring, outside of the U.S. Europe seems more positive. It's more the U.S. exceptionalism, always had an expiration date on it because it's just unsustainable from a valuation perspective.
But Joe, overall, and this is something that, when you look at the U.S., people say that Donald Trump cares a lot about the economy and he cares about valuations and therefore he cares about the stock market. But if the end game is trying to get blue-collar jobs back to the U.S., this has bigger implications for the dollar, which is dollar actually negative or dollar down. Right?
Yeah. So I think that this is the push and pull. I mean, you're trying to take on globalization, like head on. I think it'll be mixed success because some of these jobs are just not coming back. Some of the losses were technology driven. Right. But nevertheless, you could think of a governor on the process being an S&P 500 that doesn't drop too fairly. I'm worried about what I would call the uncertainty tax. Right. It's the change in policies, regardless of what the policy is, that will start to erode growth expectations below 2%. That is not our baseline. But if they continue to rise at the pace they have been and then hang there for let's say for the next 6 months, Francine, then we're talking about downside risk for growth.
And this is what CapEx, this is what
CapEx, business uncertainty. It's what a CFO, consumer spending. I think it's really on the investment side. It's high beta, it's smart. But if you're a CFO right now, you just don't have to be in the auto sector to say, do I have as much confidence in my plans? That's where it'll really bite if it does.
But it seems that the markets are slightly off that, right? There's there's a correction, but how much
I think
more
they're underestimating that risk.
Yeah.
But we'll see going forward. Again, tariffs have been, it's a wild card scenario. China hasn't surprised us in terms of what we've seen. I was skeptical that the Mexican and Canadian tariffs would bite, just given the auto manufacturing disruption. It's tough to operationally incorporate, but that's the biggest risk factor.
Are tariffs inflationary?
They are in headline, but then you have it's a downside to growth. It nets out. It puts the Federal Reserve likely on hold. That means they rescind from the battlefield a little bit, where they've been a supportive for growth and for risk assets. If you have negative momentum through uncertainty and you have high valuations, that's usually not a good recipe.
When you talk about, U.S. exceptionalism at some point coming, if not to an end, pausing. I mean, would this be the moment under Donald Trump? This feels like a pretty bold call.
Well, again, our thesis was we were going to have an unraveling this year, or I should say, Francine, a weakening of some of the supply forces that were really positive for the soft landing narrative. It had less to do with demand weakening in the Fed. It had much more to do with labor supply, which was massive, and productivity lift. And so I think we see a little bit weakness there. The uncertainty tax is the wild card. I'm hopeful it won't continue to spike, but that's something if we're going to have a change in our forecast, it'll be because of that.
What are you expecting the Fed to do? Again, that's moving around quite a lot.
Well, we have some modest easing at the back half of the year. We debated the timing because of the stickiness of inflation. Again, tariffs are more of a push, and then it would be the uncertainty. Labor market's holding in there. Even if the down throttles, you have a labor supply constraint starting to emerge, and so it's going to be the unemployment rate that'll probably matter the most in the next 3 months.
Especially if immigration is handled right.
That's what I'm saying. Our leading indicators, they're coming close to zero. And the immigration, effectively had 80% to do with the soft landing in the labor market. So it was material.
When are you expecting dollar to weaken?
Well, I think it'll be this tension between the tariffs, right, which should push the U.S. dollar up, with the uncertainty that will push growth expectations down. That's the current horse race in the markets. Right now, we're kind of like it nets out, but that makes me nervous because rarely do they. So it'll be the uncertainty tax that'll carry the day.
Given everything that's going on in Europe, so the ECB is expected to cut today.
Yes.
What does it do next?
Well, that's our baseline, some honest easing. I think, though, if you're the ECB, I would be looking at what has happened in the United States in the past 2 years. They don't have to answer this question today, but where's the neutral rate? I don't think it's 2.5%, certainly not below that. So if the ECB had dots, I would say they would be likely moving up in the next several years, and the bond market will start to price that reality. It seems like it's already getting there. Yeah. Whether or not it sticks, these deficit spending and defense spending has to be structural, has to be permanent.
Where does the UK sit?
UK, I'm actually more optimistic. Again, where I worry about Germany over the next 3 to 5 years is they may have a fiscal thrust. They don't have an AI thrust. UK certainly has some of the fiscal thrust. We can debate how the positives and negatives, but they do have a better propensity on the AI front. Mm-hmm. And so there, from a private sector perspective, they have more upside risk.
They also seem to be getting closer to the EU. Unclear if it's only defense or if it's actually a way of getting closer, which could mean also something with trade.
Yeah, no, this is a dynamic that bears watching, right? Because we're seeing shifts in the world order as we speak.
Joe, thank you so much. Joe Davis from Vanguard stays with us, and we'll talk AI and China next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Welcome back. Now, chipmaker Marvell Technology delivering a revenue forecast that actually fell short of the highest estimates That's disappointing investors who are looking for a bigger payoff from the AI boom, and it's down 14%. This is a story that we've seen over and over, not necessarily bad results, but actually investors disappointed. In the meantime, Alibaba shares surging after the Chinese tech giant unveiled its latest AI model that it says uses just a fraction of the data required by DeepSeek's R1. Well, we're back with Joe Davis from Vanguard. His book, Coming Into View, How AI and Other Megatrends Will Shape Your Investments, will be released in May. Joe, that's wildly exciting. Congratulations on the book. I mean, this is probably the one thing that at the moment is being lost because the geopolitics are dominating, but that could change everything, our economies, the way we live, and at the end, how you measure things as well.
Well, I mean, again, it's been a labor of love, this project. It's been a team effort, Francine. But I think what we're proud of is looking at all of these major forces that matter. Globalization, tariffs are clearly one. Demographics, aging of society, debt levels. You're talking about Europe, or just a few minutes ago, and then of course technology, AI, shorthand for technology, and we're quantifying how all those forces, they'll interact and push and pull. How will that affect equity market investing, fixed income, and growth and inflation? And the results, because it's an empirical framework, we believe we're the first ones to quantify these odds, because we're talking about the future. It's been eye-opening to me. I can tell you the consensus view that the IMF, the World Bank, and the Federal Reserve have for growth and inflation has extremely low probability of ever happening in the next 3 to 5 years because of the tensions between, say, deficits, which can push down, can push up interest rates and down growth, and AI, which could be transformative for the labor market. That's the tug of war that the book talks about.
So AI in terms of what, just massive layoffs because of AI, or can it be used?
It's not. So we're able to look at every job description in the world and what AI can do. I think the misnomer of the debate is AI will augment 3 jobs for every one it automates away. So it's going to be the greatest disruption in the labor market over the next 7-10 years since the computer. But it's not dystopian, other than perhaps for 10 or 15% of the markets. But what the irony of the developed world is why trend growth is low is because we have a lack of automation in the service sector. So that's where it'll offset some of the weakening demographics. And then globalization, I think the fallacy is it's retreating. Actually, it's accelerating when you look at the nature of technology and how it's changing. So again, we're trying to quantify these for investors, and what do I do with it with my portfolio?
So what is the one thing that you think will actually impact the biggest change in terms of markets?
Yeah, I think there's 2. One is structurally overweighting fixed income, regardless of how the technology plays out. Because if there's deficits dominate, which is the one primary scenario that emerges, clearly AI and technology will disappoint. The more eye-opening to me, Francine, was even if you are belief that the most likely scenario is AI is transformative, about as much as a personal computer, you should not overweight growth stocks and technology stocks in your portfolio. Why? Because transformation leads to other types of companies become more productive in using it, and they're not nearly the valuation level over the next 5 or 10 years. So I'd say for asset allocators out there, whether you are dismissive on AI or you are optimistic on AI, overweighting value parts of the market, and this has happened in every technology cycle over the past 100 years, and we talk about that in the book. That's the winning strategy.
Okay, Joe, you have to come back. I have a million and one other more questions. Joe Davis, a global chief economist and global head of investment strategy at Vanguard. Coming up, as Europe scrambles to protect its borders, we'll discuss what we can expect from the European Defence Summit. That's next, and this is Bloomberg.
case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also. Yeah. Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. EU leaders gather in Brussels for emergency talks as they scramble to mobilize additional defense funds. Now, the French president says he'll open talks on a European nuclear shield. German bonds fall, extending their worst daily drop since 1990, following the nation's historic spending plans. Plus, the European Central Bank will most likely cut rates today, but tensions cloud the path ahead. Now let's return to the EU, where leaders are meeting to mobilize billions for European defense after the U.S. stopped providing some intelligence for Ukraine. Well, Bloomberg's Oliver Crook is on the ground in Brussels. I mean, there are a million things that we need to talk about, but the end question is, can Europe stay united and together on this?
Listen, I think that it's the kind of urgency, it's the kind of crisis that's bringing to the fore radical action that we have not seen from the European Union in a very, very long time. So I think on that front, you're going to find some unity in places that you didn't before. For example, from the incoming German Chancellor, the head of the CDU, Friedrich Merz, who is basically now Germany is lobbying on behalf of the European nations to basically loosen fiscal rules. This is the German CDU Chancellor talking about encouraging the European Union to take on more debt. This is an event that's really without precedent, even in the times of the financial crisis, within the times of COVID. This was not really the sort of German approach to be talking so openly about this. So they find unity there. They will find also unity on the issues of some of the initiatives that have been put forward from the EU, borrowing or lending, I should say, 150 billion euros for more defense spending, and those loosening of those fiscal rules. Where the unity will not be as present is that where it often is lacking, and that is on the question of Viktor Orban, the Prime Minister of Hungary. How active will he be in trying to block some of these programs? We know that that the European leaders right now are trying to find ways to circumvent him. They will be able to do that on a number of points. But the two big questions ahead of this meeting is how real is any conversation about the possibility of joint debt, and that will require unanimity among the EU 27, and also the question of Russian assets that are still frozen. Will they be exploratory? Will they be sort of bold enough to start talking very openly about touching those underlying assets that to the tune of about 300 billion euros in the absence of that U.S. support, which has been, as we've been talking about, evaporating over the last few days?
Ollie, thanks so much. Oliver Crook there with the very latest from Brussels. Now, as Europe responds to U.S. President Donald Trump's abrupt U-turn on American foreign policy, the stakes have never been higher for both European and Ukrainian security. Now, to discuss all of this, we're joined by Elizabeth Braw, Senior Fellow at the Atlantic Council. Elizabeth, thank you so much for joining us. We have some great geoeconomics analysis from our research team. The latest piece is basically Germany unveils a bazooka, the EU a pea shooter. There's been so much in terms of news to go through. how worried are you about the future of Europe, of staying together, staying united, but also finding a policy that works to defend Ukraine and their own borders?
Well, I think the good news here is that European countries, EU member states, I should say, are acting much more in unity than one might have expected. Even just a couple of years ago, we constantly hear about bickering within the European Union. Well, now that, as you said, the stakes are so high, they are really coming together. Yes, there are a couple of outliers, Hungary and Slovakia, that may spoil the show, as it were, or at least make it more difficult to get on these joint united defense plans going. But nevertheless, this is a massive feat for 27 countries that are very different amongst themselves. Then the challenge is you can agree on defense spending all you want, and that is a massive achievement in itself. But the spending is one part, and getting the equipment is another part. And then once you get the equipment, where are the soldiers going to come from? We already have trouble recruiting soldiers within each EU member state.
So how long can actually Ukraine survive without the U.S.? I mean, this is, I guess, the first question. I know the Biden administration took steps in the final weeks to ensure that it had a little bit longer. Can it survive beyond the summer without European help at the same time?
Yeah, so when it comes to Ukraine, we get different estimates, but the Ukrainians themselves, and that's really who matters in this equation, they're saying they can fight on for another few months. And we should remember they have defied expectations before. Vladimir Putin operated on the assumption that it would only last for a few days. But of course, it is a major major problem facing them now. But if they can last to the summer, at least then we can get from existing European stocks and existing European assets, financial assets, more support for Ukraine.
Elizabeth, I mean, again, there's so much to unpack. When you hear, Emmanuel Macron talking about a European shield basically supported by France, does it mean that the current NATO shield is breaking down? Do you expect the U.S. to get out of NATO?
It is an extraordinary turn of events to even hear talk about a European nuclear shield or nuclear umbrella. The U.S. presence in NATO has been a guarantee ever since NATO was created, and I think your viewers will remember the likes of Dean Acheson, who then was not just part of forming all these different arrangements after the end of World War II, but called his autobiography "Present at the Creation." Now we are seeing the opposite from America, which is why this conversation even has to be had about some sort of combined French-UK nuclear umbrella, or possibly a French nuclear umbrella. It is extraordinary. The French, of course, have always been a little bit hesitant about the U.S. role in Europe, but now it turns out that the French role may indeed become indispensable.
I mean, is this the return of the Franco-German axis?
I don't think it's a return of the Franco-German axis. That ship has sailed, or maybe I should say that tank has rolled within the European Union. There are many countries on the eastern flank that are keen to have a stronger voice, but we are seeing the return of the European initiative, within NATO, the European pillar within NATO, and frankly, more innovative thinking. So France and Germany were always the engine from an industry perspective, economic perspective, but now innovative thinking, more ambitious thinking from France, Germany, Poland, the UK, by the way, also in a NATO perspective, around what can be done.
I mean, the one thing that I feel is very difficult to answer, that we haven't really, gotten to the bottom of, is what exactly is the nature of the relationship between President Trump and President Putin. What does President Trump need from Putin? Why has there been this 180 in relations to Ukraine?
Well, what seems to be the case is that President Trump, unlike his predecessors, doesn't believe in alliances. He believes in major countries, major powers acting amongst themselves, deciding essentially the fate of smaller countries amongst themselves. And of course, that leaves very little room for alliances. The core of U.S. international engagement for many years, ever since World War II, really has been that it has alliances, and those allies are its friends and with whom it shares values. But if you don't care much for shared values and alliances, then why should you bother with small countries? I think the drawback of giving that up is that you don't have that core of friends whenever you need friends.
But are you expecting, relations with Russia to be normalized quite soon?
Well, that seems to be the U.S. intention, and we even heard Marco Rubio talk about opportunities for mutual investment. It's an extraordinary turn of events when, at the moment, we still have Western sanctions in place, Russian assets frozen and possibly needing to be seized, and at the same time hearing the U.S. talk about potential business dealings. Business deals.
Business deals. Thank you so much for joining us, Elizabeth Brother, Atlantic Council Senior Fellow, with a great overview on some of the intricate and difficult questions that we've been trying to answer over the last 10 days. Now, coming up, China outlines plans to boost the economy after setting a bullish growth target despite U.S. tariffs. We'll have the details next, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Now, speaking earlier this hour, China's commerce minister said U.S. tariffs will disrupt supply chains, hinder global growth, and if Washington goes further, Beijing will respond in kind. Now, it comes as economic leaders have been outlining fiscal measures as part of the National People's Congress. Well, Bloomberg's chief North Asia correspondent, Stephen Engel, joins us now from the NPC's Media Center in Beijing. Stephen, thank you for joining us. So the press conference has just ended. What were your key takeaways?
Well, it was a fairly staid affair for the first couple of hours until a direct question came in on China's response to the Trump tariffs. And that's where Wang Wentao, the commerce minister, sort of unleashed some sharpening words against that trade action. Of course, just yesterday or the day before, we saw the second retaliatory steps on some $22 billion worth of U.S. goods on some tariffs. It's on top of $14 billion worth of U.S. Goods a couple of weeks ago, or 3 or 4 weeks ago, in the first 10%. Now it's up to 20% from the United States. So Minister Wang said this type of coercion and extortion won't work on China. China won't be intimidated. If the U.S. continues down this path, China will continue to retaliate in kind. He went on to say the U.S. should start acting like a big country and get along with others. So those were the sharpest words coming from the Commerce Minister. Some of the other people that were up on the stage included the central bank governor, as well as the Finance Minister, the top planning body head, and the securities regulator, and all kind of towed the similar line that the Chinese economy will have enough stimulus to weather internal domestic economy struggles as well as those external uncertainties. Francine?
Stephen, what are the challenges to China's ambitious growth goals?
Well, I think they alluded to it as well. PBOC Governor Pan Gongsheng essentially said, we have the tools in place. We can cut interest rates. We can cut RRR, reserve ratio requirements, when necessary. It's also a sentiment that was echoed by the finance minister. They put on a brave face. We all know that the property sector has dragged down consumer confidence, and the #1 priority, as outlined by the Premier Li Qiang yesterday, is boosting domestic demand, and boosting domestic consumption is going to be at the heart of that. Now, the biggest challenge, perhaps, is the wild card coming from Washington, whether further tit-for-tat trade war could basically mean China will need more stimulus to prop up its own economy down the road. Most economists that I've spoken to expect China to have given themselves room to add more stimulus, perhaps at the Politburo meeting in April or further down the road, if the external environment deteriorates further. But they do claim that they can have monetary and fiscal levers to pull if the external situation worsens.
Stephen, thank you so much. Bloomberg's Chief North Asia correspondent, Stephen Engel. Now let's also bring Yu Ji, a senior research fellow on China and the Asia-Pacific program at Chatham House. Thank you so much for joining us. What is the way forward for Chinese growth? Will they be able to hit the 5%, or what are the major setbacks you see going forward?
Nice to see you, Francine. I think 5% of target is really an aspiration for this year, considering the worsening external environment and also compared with last year. So I think 5% is really more of an ambition rather than a target that has to be met. However, having said that, if we observe very carefully on the government report from yesterday, there's been extra public deficit being allowed, growth with 30% more than last year. And also on top of that, you may have noticed that the 3 trillion RMB extra long-term special bond being used for consumption boost. So that is to say, the most difficulties in here within China is to drive the domestic consumption. However, having said that, I think that's most of the economists being focusing on. But there's a quite substantive chapter within this year's government report by saying that what China is trying to do is trying to boosting its innovation capability as a way of driving the economy. So while we have the traditional way of saying by driving the domestic consumption, but I think really what really comes to the priority for Xi Jinping's cabinet for this year is again to double down this drive on self-reliance towards innovation and spending money on it. So it's perhaps, I mean, it depends how they play with the ball, really. On the one hand, they will be interested in consumption, but then on the other, I think some innovation capability, that's the key thing.
Usually, can you tell us about inflation? So again, if it's around 2%, how much deflation in this trade war, tariff concern, spectrum do you see going forward?
Yeah, I mean, of course, again, from yesterday's report, I mean, it was inadvertently admit that it's the deflation problem was in China. But how the government is going to go ahead to resolve about it, and I think remain quite unclear for now at this stage. I think for now, the government is very keen to send a positive message, but without backing by substantive measures regarding what to do next to resolve the deflation issue and also to drive the consumption question.
Usually, do you understand, or do you have a somewhat of an understanding what kind of relationship President Trump wants with President Xi?
Well, from my understanding, is Donald Trump obviously want to crafting that sense of personal friendship with President Xi by both of them being a very strong leader and strong man. But then on the other hand, I think what China really wants is China wants to have a calm and functional coexistence with the United States. So that is not exactly what Donald Trump wants. Instead, Donald Trump would be more interested in making deals, and we don't really know at this stage what deal it will be. But nevertheless, I think they want to somehow develop that sense of bromance to Xi Jinping. But I don't know China whether will be able to reciprocate or not.
How much do you think Trump's tariffs will push China and President Xi to change the growth models they've been trying to achieve?
I don't think so. I think I have a quite serious doubt in here. Much discussion in the past few years has been revolving around how to drive China's innovation capability, and much of the policy design, and you would probably see this also in the coming up, the 15th five-year plan as well, was a substantive focus, and all the financial and national resources been focusing on technology and innovation. So I think even if we're talking about the economies facing very strong headwind, but I think nevertheless, the security question, the national security question coming to as the priority for President Xi. That is to say, he will have to make sure the economy could withstand the geopolitical pressure, could withstand the science and tech export control from the United States.
I mean, I know there's also a number of discussions in capitals in Europe on whether they need to pivot a little bit more towards China because they feel abandoned by the U.S. How much will that benefit China?
Well, I think it's too early to judge at this stage for now, because we're kind of unsure how far this support towards Ukraine would last, firstly. And secondly, I think China is also trying to be quite cautious in here and to make sure that, well, by repair its much damaged relationship with Europe on the one hand, but not to irritate Donald Trump, and hence that would actually provoke him to double down the China containment strategy. So I think Beijing for now is sit quietly and watch to see how the situation evolves on the European side.
Usually, if there is a change in consumption and we see that going up, is there a specific data point in China that you'd be watching out for?
Well, I would actually go back to the, according to your previous report, I said, what is the writing for the next Politburo readout to see whether there will be changing in wording, but also in changing substantive policy from both central banks and the Ministry of Finance regarding how to boosting the domestic consumption. Because so far what we have is only to providing limited subsidies for buying consumer goods, but that's just not sufficient at all.
But I mean, China also needs, of course, a very healthy industrial sector. That means producing energy. That means producing, weapons, but also being less reliant on the U.S.
Well, I think Beijing has already begun that process of diversification, really ever from the end of the first term of Donald Trump already. So if you actually look into the trade data, it is no longer the global north, so hence the United States or EU as the top trading partner with China, but instead is actually the ASEAN countries and has been the top trading partner with China. So I think China already began with that diversification process, but how further this will go? I think one challenge for China is, given this very prolific sense of manufacturing products being flooded into global sales market, that would also pose as a challenge for some of the global sales countries that are also interesting boosting its industrial capability. So how further this China's high-end export growth model could go, and they will have some serious doubt in here.
Usually, thank you so much for joining us, a Senior Research Fellow there at Chatham House. Now, coming up, trading halts in French satellite operator Eutelsat, as the company tells Bloomberg that talks with the EU are progressing to replace Elon Musk's Starlink. That, of course, conversation is up next, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is The Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Until now, we have been together with Starlink there, but it's clear that everybody's asking us today, can you actually replace especially the very large number of terminals that Starlink has across Ukraine? And that's something we're looking very actively at, yes.
That was the Eutelsat chief executive saying talks with the European Union on replacing Elon Musk's Starlink are intensifying as the U.S. pulls back from the commitments to the continent's security. Now, Starlink has been an essential service for the Ukrainian military over the past 3 years. Shares in the French satellite provider Eutelsat have now soared more than 400% this week. Now, Bloomberg also understands that the Italian government is having growing doubts about closing a $1.6 billion deal with Musk's Starlink in light of the U.S. pullback. We understand that the Prime Minister, Giorgia Meloni, said at a ministers' meeting on Tuesday that the country should look to SpaceX alternatives due to changing geopolitics. Now, Meloni has been positioning herself as a bridge between Europe and the U.S. administration and has a long-standing rapport with Musk. Air France KLM shares soaring this morning, up the most since 2020. The airline says it aims to lift seat capacity by 4 to 5% this year and improve operating profit by at least 300 million euros. You can see that stock price gaining some 20%. Now, don't miss our exclusive interview with the Estée Lauder chief executive, Stéphane de la Favrie. That interview will be Stéphane's first since taking the job in January. That's tomorrow at 9 a.m. London time. There's also full coverage of the ECB decision from 1:15 p.m. London time here on Bloomberg. You can catch Christine Lagarde's news conference at 1:45 p.m. Up next, Bloomberg Brief with Danny Berg and Manus Crane in New York. And this is Bloomberg.
suppose I want to buy a computer, but I want to have AI in my computer. I want to be really up to date. Do you have AI in your computers yet?
No, not yet, but is coming soon. And we think this is going to be one of the largest transformations in the PC industry in decades. What will be possible starting this summer is to run large language models in AI PCs, which means that what today all of us are doing in the cloud, where you use any of the applications that you can, you will be able to do it locally. And what this means, which is why we think this is important, is it will be much better from a cost perspective, because running models in the cloud is expensive. It will be better from a security perspective, because you will be able to use the model with your own data locally without having to upload your data to the cloud, and you will be able to do it anywhere in the world. And also for applications where speed is important, where latency is important, you will be able to do it locally much faster. For example, in gaming, where the game needs any resource the computer have, it will be a much better model. So it's going to be a big change starting this summer.
At the same price, too?
Slightly higher price, but if we look at the increase of price versus the increase of value, not comparable.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning from our global headquarters in New York. I'm Manish Krani alongside Danny Berger. You're welcome to Bloomberg Brief. Let's start that agenda.
A German bond rout goes global. Yields in Japan, Australia, and the U.S. all rise as EU leaders gather for an emergency defense summit. In autos reprieve, President Trump exempts car makers from tariffs on Canada and Mexico for 1 month. All of that ahead of an ECB decision expected to lower rates for the 6th time since June. Good morning, Manis.
Danny, a very good morning. Let's start with the global bond market. Right. You are just seeing significant moves in Japan and Germany, and we are being dragged in the wake of that in the United States. The bond market is up at one juncture 44 basis points in the space of 2 days. The worst drop since the 1990s. The JGBs trading at 1.5% for the first time since 2009. And as I say, the growth scare that we saw our yields drop yesterday has been evaporated by this global bond market. Right, vigilantism or bonfire, take your superlative. Roll it down to the stock markets. I mean, we are headline whiplash, really, when it comes to these markets. A lot of the tech sector under pressure this morning. Again, just going back to what Bob Michael said, the risk of tariffs, even though we have carve-outs, are economy killers, and that is probably the overriding risk in this market.
How do you price in tariff risk when it changes day by day? Manis, you're seeing the same thing on an individual stock level basis. Let's just get into some of the things moving pre-market, because Ford is one of these. It rallied more than 5% yesterday. It's now down 1% in the pre-market. That and other car makers, again, they had a large rally with that Trump delay, 1 month delay to auto tariffs.
Chinese retail giant JD.com posted a beat in the fourth quarter. The company benefited significantly from the Chinese government stimulus efforts to spur consumption.
Elsewhere, this also weighing on the tech sector this morning. Marvel Technologies plunging nearly 16% in the pre-market. Revenue fell short of estimates, whereas investors had been hoping for an AI-driven boom in results.
And in just a few moments, Lucy Baldwin of Citigroup, and later this hour, Ludovic Sobran of Allianz joins Danny and I. I mean, that is a brutal repricing in those equity markets. And there's a lovely line from George Conclaves over at MUFG. For the first time we're really questioning the golden goose here in the USA, whether it's fiscal and tariff angst globally.
Well, we're being hit by tariffs,
Yep.
headlines about layoffs and the Doge efforts, and all of that is happening notably when Europe has switched on the switch to stimulus. It is this repricing because it's an idea of not MAGA anymore, but now you're starting to hear people talk about mega, make Europe great again. And look, Bank of America also lays it out this morning, saying that signs of uncertainty, shock hitting the U.S. consumer, and risk assets should be taken seriously.
And also the sort of the framing of the tariffs yesterday by the Commerce Secretary, Howard Lutnick, on Bloomberg, which was this is more about fentanyl rather than it is about trade. So it's trying to sort of recraft the narrative. But it's live. Tariffs are taking shape on a daily basis. And shares of the automakers, well, they're on the move this morning as President Trump grants an exemption for the automakers from the newly imposed levies on Canada and Mexico. Now, the reprieve will last 1 month. How will they perform in that month? Brendan Murray, who tracks the trade story for Bloomberg, is with us. This was a very public, I think the phrase that you use, Brendan, is this was very publicly played out. But you question the proportion of exemption.
Yeah, so we did see this carve out for the auto industry, but that's still, that 25% tariff still applies to about $600 billion worth of trade between across North America. So, and the auto exemption or exclusion that they're getting, accounts for about 250 billion, according to some of the economists who we're tracking. So there's still we're in day 3 of what is still a very disruptive trade war between the 3 economies of North America. In the meantime, we have China trying to position itself to withstand the added 10% tariff that the Trump administration put on Chinese imports, and trying to stabilize its economy and make sure it can absorb the shock from those tariffs. So yes, there was a reprieve for the auto companies yesterday, but we're still in for a number of disruptive days ahead. Remember, next week we get steel and aluminum tariffs coming into force, so that'll bring in countries in Europe and more countries in Asia. So the trade war is just kind of creeping ever outward to encompass more economies. And we heard Howard Lutnick say, April 2nd is when the reciprocal tariffs kick in. So that's an even a broader round of disruption that we're going to see.
And maybe there's some degree for why we're not seeing a follow-through on car makers, which is, okay, 1 month reprieve, and then what? And Brendan, the kind of gamble that President Trump has made, and he said this publicly, is that the U.S. can withstand these tariffs and other countries can't. But J.P. Morgan putting out a note saying that the tariff tango for the Mexican president, that she's dancing with him, has been a boon for her popularity. Her approval ratings hitting an astounding 85%. Politically, we see Trudeau also standing up for Trump. Is there a degree which these leaders, politically, the gamble to stand up to Trump is actually working for them? It means that they won't back down.
Yeah, it seems to be. We're seeing different tones being taken by the leadership in Canada and Mexico. Trudeau is very much standing up and sounding tough and saying we will fight you in this trade war. Sheinbaum in Mexico is playing it more a bit more measured approach, but she has also said that she's going to announce reciprocal tariffs, retaliation on Sunday. So we could see food items, everyday grocery store products that Americans buy. We could see, those hit in this trade war as well.
Brendan, thank you so much. That is Bloomberg's Brendan Murray. Over in Europe, EU leaders are meeting in Brussels to discuss how to unlock billions of euros to boost European and Ukrainian security. The summit also comes after President Emmanuel Macron addressed France last night, saying that he'll enter into talks to use the country's nuclear capabilities to defend European allies. Let's go straight to Brussels, where Bloomberg's Oliver Crook joins us now. Oliver, it is a complete rethink in how Europe will be spending. You see the ramifications in this bond market. How is that conversation evolving there?
Yeah, Danny, I mean, this is really a truly seismic shift. You know, I mean, they've been talking about these European leaders, a wake-up call since November. This is the week that Europe got out of bed. And that happened at the EU level, where you have hundreds of billions of dollars that are going to be deployed in various different ways, including sort of direct loans, 150 billion euros. That is what's going to be discussed today. But also easing of fiscal rules across the European Union among member states, so that EU rules, basically they can debt finance defense unlimitedly without the constraints of the European Union. And I think the most staggering part of all of this, and really where the real sea change is that sort of loosening of fiscal rules, encouraging European nations to take on more debt, has been lobbied by the incoming Chancellor of Germany, the CDU head, Friedrich Merz. That is the true sea change. And though Friedrich Merz will not be in these meetings because he is not yet Chancellor of Germany, he is really the person who has shifted things significantly here in Germany. We think about this on the day of the ECB, where we generally look at the ECB to move the markets. The ECB could not move the German 10-year yield by 10, 20, 30, 40 basis points, which is what we've seen over the last few days. So there's a shift from this sort of focus on monetary policy and the sort of to the politics, and really a sea change, really truly here in Europe for the very first time, really being precipitated by Donald Trump and his actions really in the last week.
Yeah, profound fiscal response. That's what's expected. Oliver, thank you very much. Oliver Cook, tracking the EU gathering. Let's stay with Europe. The ECB rate decision, as Oliver just said, is coming in 3 hours' time. And we're expecting another cut. Lizzie Burden joins us from Frankfurt. Lizzie, the assumption is 25 basis points. The only conversation is the press conference and what Lagarde has got to say about the fiscal response and whether we are at or near neutral, isn't it?
Exactly, Manus. Do they drop the word restrictive in terms of describing their policy? That the absolute signal of whether there's going to be a cut in April or an end or pause to cuts to come. That fiscal conversation around Merz's whatever it takes pledge, of course, going to dominate this press conference. Is it going to boost growth, this pledge? That is what the markets seem to think is going to happen. Hence why you've had the Bund moves, the euro-dollar parity bets being thrown out of the window, the traders paring their bets on ECB cuts this year because they see this adding more to growth than it does to inflation. Goldman saying that it's going to add 2% to German growth next year rather than 0.8%. But of course we need to see what happens where Ollie is in Brussels today. Lagarde likely to be asked, what's the ECB's role in all this? If it isn't making it cheaper to spend all this money, what about if you have these heftier budget deficits threatening debt sustainability, and then maybe you need to bring back the large-scale bond purchases through the transmission protection instrument?
Lizzie, it's not even just the unknowingness of what fiscal policy looks like. It is both the tariff threat from the U.S. and the war in Ukraine that could vastly change the outcome for the European economy. How much of an indicator, how much of a projection can the ECB really give at this point?
Well, you hit the nail on the head, Danny, because the ECB doesn't make policy or projections based on policy that is, well, just a threat at the moment. And that is all the tariffs are at this point. 25% tariffs on autos and all other things. But it is only a threat at this point. We don't know what the EU's retaliation is going to be to those tariffs. Interestingly, if you look at our survey, most analysts don't see tariffs moving the needle much when it comes to GDP or inflation. But we need to think about whether this is in the long term going to outweigh the fiscal threat. I'm sure it's what's going to come up in the press conference with Christine Lagarde. Morgan Stanley's Jens Eisenschmidt says that it's more going to be to do with the energy cost uplift that raises the inflation outlook. But what you could see is a change of language on trade policy, and Donald Trump very much the elephant in the room of this ECB policy decision.
Lizzie, thank you so much. That's Lizzie Burden in Frankfurt. We'll also catch up with you later in the hour as we count down to the ECB decision. Let's first get some other top stories that are trending on the terminal this morning. Bloomberg sources say that Klarna Bank is seeking to raise at least $1 billion in a U.S. IPO as soon as next week. They aim to price the IPO in early April, targeting a more than $15 billion valuation. Deliberations are ongoing. Details of the listing plan, including timing, could still change.
Michael Grimes, a former Morgan Stanley banker, is set to lead a planned sovereign wealth fund to give the U.S. a stake in projects considered critical to national security. The fund would be part of a larger public-private collaborative effort to open up large-scale institutional investment options. Grimes couldn't immediately be reached for comment.
Alibaba has unveiled its latest AI tools. They marked a big leap over the previous version. It used just a fraction of the data that DeepSeek's R1 employs. Alibaba has gained some $135 billion of market value this year. Alibaba has also pledged to invest more than 380 billion yuan on AI infrastructure.
Coming up, we'll bring you the market reads through the tariff exemption and Europe's fiscal plans. All that with Citi's Lucy Baldwin. Join us in just a moment.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
It's Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. Manus, it feels like a new world order, one in which German yields, once frozen, have become unglued. Yesterday, clocking the biggest jump in yields since reunification in the 1990s. Let's take a look at where we stand now, because it is a sell-off that has gone global. Also, speaking of a new world order, it is bond yields in Japan moving higher by 9 basis points. Yes, the sell-off goes the U.S., but it is capped with those concerns over growth. Pleased to say that joining us now is Lucy Baldwin, Global Head of Research at Citi. Lucy, it's a moment where we're inundated with tariff and layoff headlines in the U.S., and you have concerns about growth at the very same time that Europe has flipped the switch onto stimulus. Is this the right way to think about it? Are we witnessing a shift away from American exceptionalism and to making Europe great again?
Good morning. Thanks for having me. Yeah, look, it's certainly a big question whether this is actually a fairly fundamental regime shift that we're starting to see. And certainly our sense is it's pretty significant. You know, the level of stimulus that now Europe is committing to ultimately bolster GDP growth over the next 5 years in Europe, and that should unlock some significant earnings growth and upside to earnings growth across the corporate space. And then on the flip side, to your point, as Europe embarks on that fiscal stimulus, as you say, pretty unprecedented by its history, you've got now the United States really starting to grapple with the levels of uncertainty that have been triggered by the new administration over the course of the last few weeks with the approach to relationships around the globe. So essentially, you're seeing that consumer weakness start to come through. And I think that is our biggest concern. We've got a big consumer conference next week, actually, in Miami, and we're going to be listening very carefully to see what's happening to the US consumer, because all of the soft data is really pointing to this quite quite remarkable slowdown in US growth on the back of much less confidence, both from the corporates but also from the consumers as they adjust to the tariff whiplash that we're starting to see across markets. So I think it is quite a big shift in terms of regime. And actually, it's something we've been talking about since the back end of last year. You know, this is no longer the case of just wanting to be exposed to a few small, you know, parts of the US market in number terms, admittedly huge in value terms, but that need to have that cyclical diversifier outside of the US market has never been more apparent.
There's a lot to unpack there, Lucy. Let's just break it down. You've got the consumer side and you've got the flows into Europe. We've had fast money flows into Europe since the start of the year, but there's a fundamental shift in the price of the euro and in the price of European assets. If that's fast money, is there a structural asset allocation adjustment to follow through on the back of the fiscal change?
Yes, I would expect to see that coming through, because I think this is a fundamental shift in the prospects for growth for Europe. This is, you know, as we know with Europe, sometimes it takes, you know, a real crisis to catalyse action. But there's no doubt that the German reaction here to going out and spending more, not just on pure defence, but on broader infrastructure, including digital infrastructure, could be a real game changer for growth and productivity across Europe. So we feel pretty excited about those prospects to upside for growth. And that, of course, is going to drive earnings per share growth across, hopefully, the European market in time, you know, across that industrials complex, but also further downstream. It should generate jobs, etc. And that optimism and enthusiasm for Europe is just what we need to see to attract those flows sustainably back in. And obviously structural changes in asset allocation, which to your point have become very skewed to the US market from a global perspective over the course of really the last decade. This takes us back potentially to a regime for Europe that looks much more like pre-GFC, right? The non-zero rates, the slightly higher levels of inflation. But ultimately, during that pre-GFC era, Europe was not a perpetual underperformer versus the US, as of course it has been since.
Well, the consequences of that flow, Lucy, you're starting to see some digital ink being spilled about this idea that it will challenge the US dollar's status as both a haven currency and just its dominance. Larry Summers was speaking about this yesterday, saying that the volatility was to blame. George Saravelos writing yesterday, we do not write this lightly, but the speed and scale of global shifts is so rapid that the idea that the dollar will lose its safe haven status needs to be acknowledged as a possibility, considering the underperformance of U.S. risk, the declining correlation between U.S. and dollar and risk assets. Lucy, is that a threat, the idea that the dollar is the ultimate haven?
Well, of course, you know, at the margin, a lot of these policies, you know, if we see tariffs remaining, right, there's obviously a massive amount of uncertainty around what comes in, how long it stays in. You know, we've obviously seen the exemption in the auto space, right? So if we actually see tariffs coming in and remaining, there's that retaliation that happens is a huge series of negative demand and supply shocks, right? All of which are likely to weaken global growth. And I think to your point, and the point that Larry will have made, is the challenge for the dollar is if the US continues to negotiate around the globe with big trading partners, whether that's Europe, whether that's China, in a way that starts to cause other partners to form new alliances away from the United States. We've obviously seen what's happened with Mexico and with Canada, you know, again, seen as the, you know, the biggest, strongest allies, incredibly close in proximity, great ties within certain sectors. You know, there is that risk that other people form new alliances in order to try and buffer themselves from the shocks that this is causing. And I do think that has a risk, you know, obviously at the margin for the dollar. You know, we've just actually changed our view. We'd been saying last year, you know, dollar strength on the back of the election and post-election and the policies that were coming through or seem to be coming through. And our view right now is actually that's probably not where you want to be. And we've actually said let's be much more constructive on the euro here on the back of what we've seen in the last 24 hours. So absolute truth in what you're saying there.
Lucy, thank you so much. Lucy Baldwin there of Citi on the markets. Let's just show you where these bond markets are. It's where we started the show 21 minutes ago. As Danny said, there's a cap on the spike in our bond yields in the United States of America at 430. That's the growth drag relative to the seismic shift that you've seen in the Bund market, Danny. 2 days in the German Bund market, we've put on at one juncture 44 basis points. We're seeing the worst drop since the 1990s, but it is seismic changes in fiscal policy.
what is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
It's time for your front page news. This is what we got on the headlines from around the world. Kick it off with the FT. They're reporting that Microsoft has withdrawn some of its commitments with the cloud computing provider CoreWeave. Now, Microsoft is by far one of the largest customers there, but it has walked away from some of the agreements over delivery issues and missed deadlines. Representatives from Microsoft and NVIDIA declined to comment to the FT.
This one breaking on the Bloomberg moments ago that Walmart has asked some Chinese suppliers for price reductions to offset the cost of tariffs. They've asked for up to 10%, but so far few have acquiesced. Already really razor-thin margins for suppliers with Walmart trying to price cheap goods.
Yeah, we've had a bunch of CEOs warn Target and Best Buy, you're going to have price hikes pretty soon. Washington Post leads with President Trump is said to issue an executive order directing his newly confirmed education secretary to work to close the department. Now, it would take an act of Congress and 60 votes of yes in the Senate, which is unlikely given that the Republicans have 53 seats. But the more likely outcome are deep cuts to staff and programs along with grants.
Well, coming up in the show, we're going to count down to the ECB decision. A lot to grapple with for Europe. For more spending, a seismic shift. We're going to catch up with Ludovic Chabron of Allianz, and that's next on Your Brief.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
A German bond rout goes global. Yields in Japan, Australia, and the US all rise as the EU leaders gather for an emergency defense summit. An auto's reprieve. President Trump exempts car makers from tariffs on Mexico and Canada for 1 month. And all of that ahead of the ECB decision expected to lower rates for the 6th time since June. Danny, good morning. These bond markets are on fire.
And the reprieve for the equity market did not last long either. We started out yesterday with able to put up more than 1% gains. We're falling by nearly 1% this morning for your S&P and Russell 2000 futures. NASDAQ underperforms 1.1% despite getting a 1-month reprieve, but it's just for autos on tariffs, which is only 25% of the imports coming for Canada and Mexico. And yes, Manus, you said it. It is a bond market that is maybe wagging the dog this morning. It is a new world order where German yields have come unglued. We're higher by about 6 basis points this morning. The 10-year bond jumped nearly 30 basis points yesterday, was the biggest since the 1990s German reunification. Your 10-year yield in Japan crossing 1.5% for the first time since 2009. Your 10-year yield only up 2 basis points, so it's participating in the sell-off, but maybe not to the extent. And man, it's just to underscore the volatility that we've seen. This is a wonderful statistic. European equities, Monday, see their best day since 2022. On Tuesday, European equities see their worst day since 2022. Yesterday, it was again their best day since 2022. Try to wrap your head around that.
Well, the one thing the bond market is telling us, even though there's existential angst in Germany and in Japan in terms of the scale of those moves, that cap, and you flagged this at 5 a.m., the cap in the US bond market is specifically on the growth drag. The risk here, if you look at the ADP numbers, ahead of the jobs numbers, that is the drag. That is the risk on the stag side of the stagflation narrative here in the United States of America. And if there's a print tomorrow in that jobs market that indemnifies that stag side, it's a very different bond market. And that spread between US Treasuries and the rest of the bond markets in the world will shift.
Listen, we talked to Mark McCormick at TD Bank yesterday, and he basically said the market has this order wrong, that actually the concern now should not be growth, it should not be an inflation, it should be inflation. Yes. You see that in the Beige Book. They talked about how various districts said that they were preemptively rising prices. You also see Walmart saying, Chinese suppliers, you need to cut prices. There's this grappling of higher prices, and it's being mentioned over and over again for these corporations.
It is indeed, and all of that on ECB day as well. So you can sort of wrap it all up together.
Well, to be fair, expectations are that the central bank in Europe will be cutting rates again, but traders are now only pricing in 2 more cuts this year with the stimulus coming into Europe. Let's bring in Bloomberg's Lizzie Burden, who's on location in Frankfurt. So Lizzie, a cut today, and then what?
Well, even before all of the tariff and defence and infrastructure news, Danny, it was anyone's guess what would happen after April. Today seems pretty clear we're going to get a rate cut. But beyond that, analysts are divided. The Governing Council is divided. You've got some analysts saying that today is it. And then you've got others saying that they're going to cut all the way to 1% by the start of 2026. If you look at the Governing Council, you've got some who are concerned about sticky services inflation, others who are still concerned about sluggish growth. Maybe the German pledges do somewhat to change that. But if you come down to it, the data, this week we've actually had quite optimistic signs. You've had services inflation falling below 3.9% for the first time since April 2024, wage growth easing in the fourth quarter. Maybe that gives the confidence that policymakers need that they can get back to 2% in the coming months. I said it before, I'll say it again. The tell for markets today is whether they drop the description of policy as restrictive, because if they do, that could signal an end or a pause to cuts, but if they don't, that'll be a signal maybe that we're going to get another cut in April.
Well, Lizzie, Germany has laid the roadmap for Europe to have a fiscal response that sort of comes up to their own. The size of the German fiscal boost is the biggest since World War II. Europe has an opportunity to do the same. The question for markets is the boost to the growth side versus the threat from the tariff side coming down the pike from the US.
Well, of course, the EU stance on tariffs, the ECB stance on tariffs is, at the moment, they're just a threat. 25% on autos and all other things. And we don't know how the EU is going to retaliate at this point. It doesn't look, actually, at this point, that it's going to do much to change the ECB's projections when it comes to inflation and growth. But when you consider that mammoth pledge on doing whatever it takes when it comes to defence, and there's also infrastructure to factor in here as well, as you say, historic in terms of the market reaction, the Bund reaction, the Euro reaction, and traders paring their bets on ECB cuts because they see this adding to growth. Goldman saying it could add 2% to German GDP, up from 0.8%. But the caveat, as always, is it's got to be approved and it's got to be implemented quickly. Now, we're going to wait for the news out of Brussels on the Europe-wide level, but Christine Lagarde will not be able to escape this question. How is she going to support this effort? And Indeed. Is she going to have to return to the transmission protection instrument because of the impact on spreads?
Lizzie, thank you. We'll catch up with you later in the day for coverage at the ECB. I want to just show you, Danny's talked about the Bund price, just for your viewing here, up 44 basis points in the space of 2 days. This is a seismic shift, according to a number of houses. This is of debt, potential debt issuance and fiscal stimulus of epic proportions. How should we view it? Ludwig Sobran, Chief Economist, Head of Economic Research over at Allianz, joins Danny and I now. If we look at this potential fiscal response, it's a paradigm shift to sort of put all the superlatives together. But it's something different to the existential threat that was the debt crisis in 2011. How do you look at it from a boost to growth relative to inflation? Ludwig, good morning.
Good morning. I think it's in the short term, it's definitely a boost to growth and not to inflation. I think when you talk about war economics, it usually builds precautionary savings and lower capex of the firms, right? So there is a demand addition. The multipliers of defense are usually high. Plus, in Germany, the stimulus announced is half defense, half infrastructure. So it should actually be quite high. So we're talking about a point or a point and a half of growth over the next few years, right? So it's quite huge for a country that is just being in recession for the past 2 years. I'm not worried about inflation now, but we should stay worried about inflation in the future because we know the problem of war economics. War economics grants a form of inflation if there is no capital destroyed. We learned that firsthand from COVID response because we were at war against a virus. We did rationing. We did strategic allocation of capital to the effort of the war. We did debt monetization. And then 2 years down the road, we got a lot of inflation because there was a supply shock that ignited everything. So we need to be very careful here. I'm not careful about inflation now. I think the rates are responding to the uncertainty. They're responding to the additional issuance. But I think it's very overpriced and very knee-jerk a reaction. So I would be long Bund anytime now. Actually, I think it's time to add duration to the portfolio for investors out there.
Well, Ludo, kind of to that point, the numbers we're talking about, just sticking with Germany specifically, 500 billion euros for infrastructure spending, a removal of any of the debt limits when it comes to defense spending, so hundreds of billions more there. Do you assume that that actually gets done? Part of the reason we're talking about this being such a seismic shift is that it's so different from the German austerity posture that we usually get.
It will happen in some form. The problem is getting it right? Because there is always disbursement bottlenecks. There are always risks of these bold move strategies because you don't want to put all your heads in the same basket. There is always the problem in Germany to keep the reform momentum. And so there is a lot of discussions now on how, now that you unleash, that you unveil this public sector component, that you keep also the other part of the societal compact, and I would say of the other reform agenda up and kicking. I think it will happen. I mean, look, Germany needs so much investment into the grid, almost 200 billion, so much investment into transport infrastructure, 200 billion, that this has to happen. It's over 10 years, it's 50 billion per year. They have disbursement options around that. For the defense, it's a lot trickier because right now, any additional spend on defense cannot go to Germany because there is not a lot of capacity apart from Rheinmetall. You saw the stocks of these companies going up. So it's going to go a lot to the UK, a lot to France, a lot to Italy. So I'm a bit worried about how Germany feels about the positive spillovers of these defense demand on other partners. Actually, Macron is very rejoicing at the moment. So we have issues here, but something is happening for sure. And even if it's crumbs in the beginning, I think it's still very positive for a country that has been stuck into a recession for the past 2 years now.
So if the sovereign bond market is repricing to the potential for fiscal stimulus, when you look at investment grade and when you look at high yield, they need to prepare for something different. They need to prepare for Trump trade war 2. And those spreads are relatively contained, Ludo, relatively contained at the moment to where they were in 2018 in Trump trade war 1. So talk us through how you look at the pricing there in high yield and IG.
Unfortunately, I'm an internal bear when it comes to credit risk. I think the spreads are too tight. I think the default numbers are too low. I think rating migrations risks are under-evaluated, and there is a lot of mispricing in the credit space. I think the correction we've seen in the equity market is not reflected yet in the credit space. It has to happen. This is basic Shapiro formula. So I would be very worried about, the fact that defense creates a form of sectoral rotation, plus trade war, very affecting of the companies that are issuing on the high yield market, plus the other frictions that we are not talking about but are there, of course, on the very transition risk, and then the regulated sector risk and the substitution risk of all this actual focused investment in defense. I think we should be very careful. I think we should look again at the fundamentals. We should not also forget about private debt, which seems to be hot these days, and it's great. I just saw the retailization of the private debt products in the US becoming an issue. I think credit risk is going to be in the news for all of Q2. And this is what's happened when you have a growth scare in the US, reflation, you talked about that in the intro segment, plus a central bank in the US that won't be able to go much further down than 4%. So this is where the credit risk space will be higher. In the US, I would say the problems. In Europe, I guess the issue for me now is this war economic stuff. I'm a bit worried that we don't know how to deliver this promise. And so that could create credit risk for those companies that are hot right now, especially when you look at the additional refinancing needs that will be done in the manufacturing sector. We need to be very careful about how this refinancing happens because of the costs being slightly higher.
Ludo, you are truly one of the best. It is so wonderful to have you on. That's all we have time for. Ludovic Chabran of Allianz, thanks so much for joining us. Coming up on the show, President Trump grants a 1-month tariff delay for car makers. We have the details for you next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China show live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It's your Bloomberg Brief. Danny Berger alongside Manus Cranny in New York. U.S. automakers are falling in the pre-market, giving up some of their gains yesterday after President Trump granted an exemption to car makers from the newly imposed Canada and Mexico tariffs for 1 month. Bloomberg's Brendan Murray is back with us. Brendan, do we have any more clarity on what tariffs look like to Canada and Mexico than we did 24 hours ago?
Not really. I think with the lesson that we've learned in the past 24 hours is that tariffs are not just a blunt instrument, but it can ricochet back at you. So we've seen the reprieve given to the automakers. That will help save roughly $200 billion worth of trade from those 25% tariffs. But there's another $600 billion in trade that's going to get that 25% tariffs, and then you get the retaliation from Canada and Mexico, and also the retaliation from China, and you create. There's a picture that's getting more disruptive and cloudier rather than clearer. And the Trump administration has said that it's going to press ahead with this tariff with these tariff policies. We get steel and aluminum next week. Cars are made of steel and aluminum, so that's going to affect the U.S.'s industrial base as well, and invite retaliation from Europe and some steel exporters in Asia as well. So the picture, you can see a scenario where this situation kind of snowballs and starts to affect the economy. We saw the Beige Book yesterday from the Federal Reserve had 49 mentions of tariffs in there, and they weren't complimentary. These were companies complaining that tariffs are going to force them to raise prices or do other things disruptive to their business. So I think the picture, rather than getting clearer, is getting cloudier as we see the Trump administration roll out these policies.
And that's despite the Commerce Secretary joining the surveillance team yesterday saying this is not a trade war, it's a drug war. It's a drug war between now and April the 2nd. And there's the point, Brendan. April the 2nd is the day in which we understand the magnitude, the scale, and the breadth of a regime change in tariff pricing from the United States for the world. This is a paradigm shift, and a shift higher in prices is the assumption.
Yeah, exactly. So we go from applying tariffs not just for economic reasons, but also for non-tariff barriers, things like value-added taxes and other sorts of policies that the U.S. would interpret to be a barrier to trade in that country, and that's going to be different for every country. They've talked about the U.S. banks' access to the Canadian market, so it's going it's going to be a piecemeal type approach, country by country approach that the Trump administration says that they're going to take, and it's going to be a complicated thing to figure out the economic impact of that, and tariffs are only just the beginning if the Trump administration follows through on what they're pledging.
Well, it's adding to those growth scare that sort of building in this market. Brendan, thank you very much. Brendan Murray, the very latest on the tariff story. Corporate America bracing for the tariff impact as well. We'll hear from Macy's and their latest earnings call before the market opens. Bloomberg learned that Walmart has asked some Chinese suppliers to cut their prices by as much as 10% to offset the cost of tariffs. Deirdre Hipwell joins us for a bit of a preview on Macy's and the consumer overall here in the United States of America, the hedonism of the U.S. consumer. Good to see you this morning. Let's kick it off with Macy's. They've really shook up the structure of the company. They've closed stores, they've refreshed a number of their shops. What can we expect?
Well, I think, the department store space in the US is always such a challenging space to be in. So there's really going to be a close focus on Macy's, because people are really going to want to see if the CEO, Tony Spring's strategy is working. And of course, the strategy is focused on closing down some loss-making stores, focusing on fewer stores, selling fewer and better products. And I think people are going to want to see where that is taking the company at the moment. In terms of what they're actually expecting, I think they're expecting revenue, roughly a quarterly revenue of about $7.76 billion and adjusted earnings per share of 1.54. And they have topped EPS estimates in the past, so I think we'll be looking to see if they can beat rivals such as Dillard's and Nordstrom's, which have already beat expectations when they reported.
Deirdre, if we could take a step back in this moment for the consumer, we had a fascinating beige book published yesterday. On one hand, it said that most firms expect prices to move higher with tariffs, and they plan, for some of them, preemptively rising prices. But then they said this about consumer spending, that it was lower on balance, with reports of solid demand for essential goods mixed with increased price sensitivity for discretionary items, particularly among lower income shoppers. So lower spending from consumers in general, Deirdre, what is the ability of firms at this point to pass along higher prices to consumers that might come from tariffs?
It's really difficult. I mean, I think the US consumer demand has been volatile for at least a year, and the situation with tariffs and the political situation is only going to aggravate that further. I mean, we had European companies like Unilever and Nestle last year talking about the bifurcation of the US consumer, with a lot more pressure being felt at the lower end. And I think a tariff war is only going to make that potentially worse. And we've seen today, you mentioned it earlier at the start, but Walmart is asking some of their Chinese suppliers to take a big hit. So there's going to be really difficult conversations going on between retailers and their suppliers. And they're probably going to both have to share some pain. Whether the supplier takes it all, I think, will leave some hard negotiations. But I think what we're also going to see is price inflation, because I just don't see how retailers will be able to absorb all the costs of a tariff war. And of course, they're not, we've got tariffs potentially in Canada and Mexico and China. So, we're seeing a reshaping of global trade here, and that's going to be very difficult to navigate.
It's just the level of discomfort that we've probably got to suffer. Deirdre, thank you very much, Deirdre Hipwell there. Looking ahead to Macy's and the angst of the consumer here in the United States of America. Coming up, it is ECB Day. We'll run through the slate for you on your agenda right here on Bloomberg Brief.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
You're watching Bloomberg Brief. I'm Danny Berga alongside Manus Cranny in New York. Let's get you set up for your trading day on this Thursday. Earnings before the bell, Macy's, and then we're going to get Broadcom after the market close. Plus, the ECB will announce its rate decision. That comes at 8:15 a.m. Eastern, followed by President Lagarde's press conference at 8:30 a.m. And Treasury Secretary Scott Bessent will be speaking at the Economic Club of New York at 12 p.m.
More headline whiplash. Danny, keep an eye on the autos again. President Trump delaying the Canada and Mexico tariffs for a month on the automakers. What are they going to announce in the space of a month that will save them? Stellantis down 2%. It rallied by 9% yesterday. Marvel extending that post-earnings plunge as the results failed to meet pretty lofty expectations. Now we've just flicked over to the bottom. Here we go. We're back to Marvel, and let's just flick it on to Broadcom, down just under 4%. Not looking great, I should say, ahead of their earnings. They come out after the market closes. Now we can talk about bonds, Dan.
There we go. You just set it up for us perfectly. Let's look at those bond markets that Manus gave you a little tease of. The sell-off continues. We're pushing higher by 6 basis points in Japan. We're higher by 9 basis points after the biggest one-day move for German bond markets since the 1990s. It is this feeling of in the U.S. you have tariff and layoff headlines, that economic pessimism at a time where Europe has flipped on the stimulus switch.
Yeah, and I think, look, you made this point at 5 a.m. at the very start of the show. It's the differential between U.S. Treasuries and 10-year yields, and that is the spread that's going to be traded perhaps the most. We are capped, relatively capped in terms of the trajectory for us. We dropped by 10 basis points yesterday on growth scare, on the back of ADP, ahead of the jobs numbers. We are capped relatively to the drag higher in those global bond yields on fiscal issues globally, not in the U.S.
And I think it's important to acknowledge how different of a narrative that is from a mere few months ago when Bloomberg was at Davos. The conversation was pessimism among European executives, and everyone was so excited about the animal spirits being unleashed in the U.S. It's almost as if that narrative has done a complete 180 at this point.
Yeah, and the question is then, to what extent does the consumer, we've already seen it in terms of the optimism, the spending, those have rolled over. We're in wartime economics. That's what Ludovic Sobran said to us from Allianz, and that's got interesting ramifications across all markets.
All right, that is it for Brief. Surveillance.
They're up next. There you go. 2 for 1.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And, you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up very like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
We've had a really good run in asset prices here. With another round of tariffs coming and the blizzard of policies that come out of Washington, there's going to be a lot of volatility.
The key downside risk from our perspective would be if the tariffs wind up amounting to more than we had anticipated.
I think people pull out, the valuation questions are there, and we have this erratic policy that's too hard to invest.
We're probably going to get some pullbacks, high valuation, slower growth, policy uncertainty.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
This is the longest trading week ever. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday with equity futures resuming the decline after snapping a two-day losing streak yesterday briefly. On the S&P 500, we're negative by 1.2%. On the Nasdaq 100, we're down by 1.4%. Your day ahead looks like this. 8:30 Eastern Time, jobless claims just around the corner. 8:15, a very interesting ECB meeting with the German debt market taking center stage. 10-year yields in Germany just having their worst day since 1990. We started the week at 240, and right now we're pushing 280.
Which really raises the question, just how much can this bond market absorb the bazooka that Germany may or may not be unleashing? You cannot overstate, or I should say, you cannot understate how much we have seen a traumatic change to the bond market globally, because it's not just Europe. You're seeing it in Japan, you're seeing it in Australia, and it raises the question, if we get mass fiscal spending from the likes of Europe, can this bond market absorb it at a time where we're already dealing with inflation and we already have a lot of debt sloshing out there?
Biggest move in some 30 years in the German debt market. You mentioned Japan. German 10-year yields are pushing higher. Japanese 10-year, 30-year yields, levels we haven't seen since 08-09. We still need to talk about trade policy as well. An exemption for the autos for a month. The confusion just reigns stateside on policy.
Tariff uncertainty, another day of it, continues. We do know that autos, according to this White House, are going to get that 1-month exemption. This comes after Howard Lutnick, the Commerce Secretary, said to us, well, yeah, according to my understanding, they are USMCA compliant. So that begs the question, what other companies are calling the Oval Office saying, I'm also USMCA compliant? We know that, according to our colleagues down in Washington, maybe agricultural companies will get some sort of exemption. But this is why it is so confusing who potentially is in and who's going to be out.
How companies respond to this as well is going to be increasingly interesting. We heard from Best Buy and Target, who said they would be passing on the tariffs to consumers. Walmart, based on our reporting here at Bloomberg, taking a very, very different approach to this. And I'm going to share this story with you now. Some suppliers, including producers of kitchenware and clothing, have been asked to lower their prices by as much as 10% per round of tariffs. According to our reporting, essentially shouldering the full cost of the new tariffs.
And these are producers in China in particular, and this raises a question about their profit margins, maybe none, maybe even taking losses, and how much these producers in China can jawbone their supply chains lower themselves and get costs lower. Again, this highlights two things. Number one, who's going to bear the brunt of this? And number two, can U.S. consumers, with a diminishing consumer appetite, handle higher prices? And what are companies going to do to avoid doing that? Because frankly, the demand just isn't there.
And this is why we've got to all be really open-minded about how the costs will be distributed if the tariffs do stick. There's plenty of different things that can happen here. The exporter can eat it, the importer can eat it, they can pass it on to the consumer. It can be a combination of all three. And the FX channel is important as well. Developments in foreign exchange have gone against what maybe a lot of people thought would happen. Tariffs went on, the dollar's weaker. The dollar's weaker again in the last 24 hours. Coming up on this program, we'll catch up with Jim Bianco of Bianco Research as the global bond sell-off continues. Terry Haynes of Pangea Policy as Trump offers autos some relief. And Jane Foley of Rabobank on the end of dollar dominance. We begin this hour with the global bond market sell-off gaining steam. EU leaders holding an emergency defence summit as Germany gears up to ramp up spending. Bloomberg's Ollie Crook joins us now from Brussels. Ollie, typically it would be ECB day. I'm not sure how many people care about this ECB. Front and centre in the driving seat is Brussels and where you are.
That's right, Jonathan. You can see just behind me, I think we have Zelensky just arriving along with the European leaders, having this emergency meeting that was called just some weeks ago after a number of sort of policy initiatives by Donald Trump and really the reality of what this presidency means for Europe and European security. Jonathan, we've talked about it many, many times. We've had leaders, politicians, everyone tell us it's been a wake-up call since November. This is the week that Europe got out of bed. We saw it at the EU level where we was talking about releasing up to 800 billion euros worth of spending in terms of different initiatives, 150 billion euros in terms of loans. But really the main issue here, Jonathan, and you'll know this from covering the crisis, we have a chancellor coming into Germany, a CDU leader. This is the party that put the debt brake into the constitution of Germany, who is now lobbying to make exceptions so that the EU will loosen its fiscal rules so that EU countries can get more debt. That comes after, bazookas of their own fiscal plans of 500, 600, 700 billion euros in terms of spending on infrastructure and defense. This is exactly the point, Jonathan. We talk about the market impact, generally speaking, on this kind of day. It's monetary policy. Right now, it is fiscal policy, and it's moving the bond market in ways that, frankly, Lagarde and the ECB never could.
And Oliver, that incoming chancellor, really taking a phrase, a playbook from a former ECB official, an Italian, Mario Draghi, when he says whatever it takes when it comes to defense. What are they hoping to get out of this emergency summit?
So listen, they're going to ratify a number of the proposals that have been put out in terms of these sort of outlined by Ursula von der Leyen earlier in the week. Again, this is going to look at easing fiscal rules. This is going to look at sort of direct lending. But for me, in terms of what I'm watching very, very closely is how active is the discussion right now among these EU leaders about the question of joint debt. I mean, I think it's going to be an inevitable conversation. It may be a little bit too early in the game. We have another EU leader meeting in a couple of weeks' time. Maybe it comes up there. But this is going to have to be one of the other active conversations, and especially in the light of the last week, what we saw from Donald Trump stopping weapon supply to Ukraine, basically withholding intelligence. We're also going to get this conversation potentially on those Russian assets, those $300 billion worth of frozen Russian assets. How much appetite is there at the leader level to start to tap these, to start to basically deal with a lot of these unprecedented moments here for Europe? I think that the one thing that we started to see this week, again, in all of the talk, all of the rhetoric we've heard for the last 3 months, is that some of these European leaders are now ready to think outside of the box and make some sort of policy proposals that they've just been too shy, too reticent to do in the last sort of weeks and months.
Ollie, can we just finish up on this? These are things that some European nations, particularly in the south of the continent, have been asking for ages. If they look at the policy track record of their German neighbours, German foreign policy has failed, economic policy has failed, energy policy has failed. And only now, led by Germany, is there at least a consideration of ripping up the fiscal rules on the continent. How does the rest of Europe feel about still being led by German policy with such an awful track record?
Well, listen, I think that unfortunately, there's an inevitability to it, right? It's like that bazooka came out in Germany, and that is basically what shifted anything. I mean, I think there is going to be some resentment. And frankly, I mean, again, we've talked about it for many, many months. We've pressed a lot of leaders on many of these issues. Guys, is it time to start talking about these things, moving outside of the box? And there's been basically a resistance to do it. But Jonathan, there's another dimension to this as well. They're trying to push through this debt brake reform with the last parliament, where they have the 2/3 majority in order to move the debt brake. You have a new parliament coming in Germany. The AfD, the far right, has won 1/5 of the seats there. They're doing it now because they wouldn't be able to do it later. This is another sort of internal domestic national issue that you're going to have in Germany, and you're going to have some resistance also in some other parts of Europe. You have Viktor Orban, who's going to move to block some of these things. So I don't think it's as clean a shot as the Europeans would like it to be. This is going to be igniting a lot of sort of debate, not just at the leader level, but nationally for a number of these leaders.
Ollie Crook, appreciate it. Over in Brussels, it is ECB day. I will say that news conference with President Lagarde gets a whole lot more interesting. How does she feel about what's taking place at a fiscal level, potentially, and what will it mean for this debt market? Joining us now is Jim Bianco of Bianco Research. Jim, welcome to the program, sir. Do we need to rip up the global playbook for investing now?
Oh, I think it's already been ripped up, and it's been ripped up largely because of what's been happening with this payment for security coming out of Europe. As you mentioned before with Ollie Crook, they're going to tear up their debt brake. They're going to deficit spend. They're going to spend money like crazy. You can see it with the way that their yields are soaring higher, their stock markets are soaring higher. Even if you look at their real rate bonds that would anticipate inflation, they're going vertical right now, that big inflation is coming. And just to kind of lead you a little bit, we've got the ECB meeting in an hour and a half that they're so trapped with forward guidance, it looks like they're going to cut rates right into the teeth of a market that looks like we're going to have the economy soaring and inflation going straight up, and it's going to look like it's a gigantic mistake even before they even make the move.
Jim, it's early days, and you're right that it is consensus that the ECB will cut by 25 basis points. But Ollie Crook there made a great point, which is right now what's going on doesn't have a lot to do with Fed or ECB policy. This has to do with fiscal, and fiscal is very much in the driving seat. And I wonder whether it really just permanently shifts higher yields, not just in Europe, but globally, including the United States, going into the future if, and it's a big if, some of these plans do go through.
Yeah, if we assume these plans go through, you're going to see much higher rates in Europe. You're also going to see higher stock markets, too. You're going to see higher rates around the world. Japan looks like it's finally recovering. It's got a higher inflation rate than the U.S. Their rates went over 1.5% for the first time since 2009. So rates around the world are going higher. In the U.S., we have an inflation problem. We had a monster inflation number in January. We have a trending higher inflation. The prices paid index for both ISM services and manufacturing was above 62 for the first time in 3 years, which is when we had a big inflation problem. And if you took University of Michigan, looking at the highest numbers in 30 years on expected inflation, our interest rates should be going straight up too. Why aren't they? Because we're stuck in the mud thinking that this tariff thing is going to cause a recession. But if we ever get off of that idea, there won't be a recession because of tariffs. We can see a massive snapback in yields here following the rest of the world higher, and maybe even substantially higher, back to like the 480 level, or not higher, even higher than that. 480 is where we were in January.
Some people would argue that the reason why people are looking at lower yields and more disinflation is because we're hearing from companies themselves highlighting how they cannot pass along higher costs. And what you get is maybe a price adjustment, but after that, you get slower growth, you get slower sales. And you're seeing that in terms of corporate messaging pretty much across the board. Why do you reject that? And you think that inflation is going to be the sticky aspect of this that will remain?
If you look at the way that we've been talking about tariffs in the last several months, we're not sure exactly what we're supposed to do with them. And I'd like to joke, I'm old enough to remember January when tariffs were inflationary. Now in March, tariffs are recessionary. What are tariffs going to mean in April? Are they going to be stagflation? We're going to go back to inflation. We're not exactly sure which way they're going to go. I get the uncertainty, and I get that it is driving everybody. We're not exactly sure what their impact on the economy is because we're not exactly sure how long they're going to last. We're worried about tariffs now. Donald Trump hasn't woken up, and we'll see by 4 p.m. when the stock market closes if we have the same view as tariffs as we do right now. And so these things are going to constantly change, and we don't know how long they're going to last. But if they don't, could produce that kind of drag on the economy, we're back to fiscal stimulus around the world, big inflation numbers here. And that would be a cocktail for higher interest rates had we not been worried about this recessionary call with tariffs.
Well, Jim, for the market's perspective, it's quite challenging when it comes to the tariffs because they're not even sure which ones are going to stick. And April 2nd, they're not even sure which ones may be introduced. The president said at his joint address to Congress, this will be disruptive. And then the next day, Howard Lutnick came on this program and said, we're going to meet in the middle and potentially there's going to be some reprieve. How much pain do you think this administration is willing to take?
I think that they're probably willing to take a little more pain than everybody thinks that's why their focus is the 10-year yield. Scott Besson said, look, you guys in the stock market, you had 20% years back to back, and now you're unchanged after 3 months. Don't come crying to me about that just yet, at least. And if these tariffs cause the pain that we think they're going to cause, they're also going to cause pain in Europe, in Canada, in Mexico, and in China as well, too. And we'll start seeing it in their markets. Right now, their markets almost seem to be ignoring tariffs, like we were talking about earlier. In Europe, they're so talking about the fiscal situation, they haven't noticed tariffs. Here, we talk about tariffs so much, we haven't noticed their fiscal situation. So eventually, I think these stories are going to start to bleed over across one another, and then we'll probably see an agreement on tariffs.
Hey, Jim, appreciate your time. What a market. Jim Bianco there of Bianco Research on the global economy and financial markets as well. I have never seen sentiment shift this quickly across several dimensions, across so many issues in such a small amount of time.
I've never seen such seismic shift from, of all governments, the Germans come out and abandon their debt brake and take a completely fundamental different approach. Donald Trump wanted to shake things up. He's doing it. Now the question is it going to be a case of be careful what you wish for, or is it going to be a case of just wait and see? There will be gains down the road.
Bond yields up, equities down. We're lower by 1.2% on S&P 500 futures. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Alibaba shares are rallying in the pre-market for the ADRs, up 2.8%. It unveiled an AI model to rival DeepSeek. It said that it's a big leap over prior versions and uses only a fraction of the data used by DeepSeek's R1. Alibaba has pledged to invest more than $52 billion on AI infrastructure over the next 3 years. 7&I Holdings plans to IPO 7-Eleven in North America by the second half of 2026. It will also sell its underperforming retail business, replace its CEO, and buy back shares to strengthen the case against the takeover proposal from the Canadian owner of Circle K stores. 7&I said that it's still constructively engaging with Couche-Tard on its buyout. The U.S. Commerce Department is expected to tap former Morgan Stanley banker Michael Grimes to lead its planned sovereign wealth fund. The fund is part of a larger public-private collaboration to open up large-scale institutional investment options. It is still in its early stages, but is expected to focus on areas of national security. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, the automakers get a delay.
We spoke with the big three auto dealers. We are going to give a 1-month exemption on any autos coming through USMCA.
Terry Haynes of Pangea Policy joins us next, live from New York City this morning. Good morning.
Is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics politics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to the program. Yesterday, snapping a 2-day decline on the S&P 500. Equity futures here negative by a little more than 1 full percentage point. The declines resume. The losses add up. In the bond market, yields higher by 2 basis points, 430. Very briefly on euro dollar through 108, 107.94. That euro has been stronger every single day this week. Under surveillance this morning, the automakers get a delay.
We spoke with the big 3 auto dealers. We are going to give a 1-month exemption on any autos coming through USMCA. Reciprocal tariffs will still go into effect on April 2nd, but at the request of the companies associated with USMCA, the president is giving them an exemption for 1 month so they are not at an economic disadvantage.
So here's the latest. Let's address the confusion. The White House confirming automakers will get a 1-month exemption from newly imposed tariffs on Mexico and Canada. Press Secretary Caroline Levitt also leaving the door open to additional carve-outs. Bloomberg's Tyler Kendall joins us now from Washington for more. So Tyler, are the auto tariffs on or off?
Well, as of now, it looks like they're going to get this 1-month reprieve. But of course, we're going to be looking forward if there's any other companies that perhaps could get an exemption. And we're starting to get some clues here as to how that could develop. Bloomberg News reporting that tech leaders are expected at the White House on Monday. That could include companies like Intel, Qualcomm, as well as IBM. So perhaps chip makers could be in the mix here. And then the U.S. Agriculture Secretary telling Bloomberg News yesterday that the White House is seriously looking at agricultural products when it comes to potential carve-outs or exemptions. She floated fertilizer as one example, which would, of course, have downstream impacts considering the wide use of fertilizer in a bunch of different crop commodities. And then the White House Press Secretary Caroline Levitt also being asked about whether eggs might be included here, particularly as they become sort of emblematic of high prices in the U.S. And she left the door open, saying that President Trump wants to hear from industries and their leaders. I want to stick on agriculture just for a beat because that is going to keep coming up in our conversations because it often makes congressional Republicans the most queasy. The U.S. agriculture sector lost $26 billion between 2018 and 2019. Of course, that was during the tariffs under the first Trump administration. And I reached out to one Republican who's been kind of in the middle of all of this. That's Senator Ted Cruz, because he is the head of the U.S. Commerce Committee. He also represents Texas, which does so much trade with Mexico. He told me that he hopes that these tariffs are, quote, short-lived, but accomplish President Trump's policy priorities. But the issue with that, John, is that this administration keeps pitching us forward that more tariffs are to come, telling us to stay tuned for that April 2nd date when we're expecting a host of other levies to go into effect.
Tyler, appreciate the update. Tyler Kendall in Washington, D.C. To extend the conversation, Terry Haynes of Pangaea Policy joins us now for more. Terry, a number of months ago, before Commerce Secretary Howard Lutnick became the Commerce Secretary, sat around this table and we asked him about carve-outs. He said there won't be any. Terry, what's the approach to carve-outs now?
I think the approach to carve-outs now, John, is kind of typical of the general Trump line. You go in hard, you go in clean on your policy, and then you carve out as needed. That's what we're seeing with autos. That's very likely what we're going to see with tech next week.
Terry, if autos are getting a carve out because they're USMCA compliant, how many companies are we talking about that are USMCA compliant? They're going to be calling the Oval Office saying, "Don't I get a carve out too?"
Potentially hundreds, thousands, sure. And
do they get the carve out?
Well, that's the problem with the approach. Some do, some don't. There's no easy way to tell here. One of the pitfalls in this approach is that right at the beginning of an administration, you're in a situation where you don't have enough support, whether from a cabinet secretary or since the whole team isn't filled out, or from senior aides who know the inside and outside and can actually vet these policies before the decisions are made. So yeah, that alone enhances confusion in the markets.
How political is this going to get, especially with Republican red states like Iowa, Wisconsin, Ohio, that are massive corn and ag producers?
Oh, it's already getting very political, and I imagine that it will continue. You got a situation where there's broad support for the president's general policy, but there's also broad concern about the specifics of the policy and how well it's thought through. Congress increasingly is going to see its job as providing a counterweight to what it sees as deficiencies in the rollout of the specific policies.
March is drug war month, and that is what we learned yesterday, that this is what the goal is of a lot of the tariff policies. And on April 2nd, we'll get the cohesive grand vision of exactly what kind of rejiggering of the global trade sphere Donald Trump has in mind. Do you already have a sense of how that adds up, whether that means which tariffs stick and how that really handles the drug issue with Canada and Mexico?
I think it's useful, I think, to think about tariffs in two different ways. You've got in Canada and Mexico, one example, and then the April 2nd reciprocal is the other example. The specific tariffs are much more what I call geopolitical in nature. The Canada and Mexico is all about border, is all about drugs, fentanyl, and the like, and Canada and Mexico consider them that way, talk about them with the United States that way. The reciprocal tariffs are much more designed kind of in a pure trade sense and are designed to say, okay, kind of tit for tat trade, but the ultimate goal of those tariffs, frankly, is to lessen tariffs overall. One phrase that Scott Bessent uses, I think, is closely borne in mind, which is that he talks about these things as being data dependent. In other words, what the other countries do in response to our desire to raise to their levels is up to them. Implication being if what they want to do is drop their tariffs or get rid of them entirely, we're for that and we'll do the same thing.
Okay, hold on a second, Terry, because this is what people have been saying. And frankly, yesterday, what we heard from the Commerce Secretary was that essentially there will be tariffs and they will be 25%. Meeting in the middle just means carve-outs. And meanwhile, there was a story in the Wall Street Journal saying that when the leaders of Mexico and Canada tried to call Donald Trump ahead of this deadline, he didn't take their calls. What do we make of that?
I make of that as a negotiating tactic. They clearly want some more things and want some more assurances and want some more negotiations to try to get them.
Terry Haynes of Pangea Policy. Terry, appreciate the update. We understand there will be a call with the Mexican leader later on today, I believe. We've got to track the economic data. So the sentiment surveys had been softer. Consumer confidence, softer. ISM manufacturing, weaker. Within that survey, the survey respondents pointed to the tariffs. How much weight you put on that? I don't know. Then we had ISM services. That didn't confirm the slowdown. I think we can take some confidence from that, maybe. We get more data later this morning.
The fascinating thing, though, is that people rejected the strength in the ISM services. It came in above all expectations. The employment component came in stronger than people expected. And yet it didn't materially move the market or shake it from its belief that this was somehow going to be a significant slowdown that was more market than before. That, I think, is interesting in terms of where it puts the emphasis on incoming data.
Going into payrolls tomorrow. Payrolls at 8:30 tomorrow morning. Jobless claims a little bit later as well. Coming up on the programme, we'll talk about the economic data. We'll catch up with Mark Giannoni of Barclays on the US economy with more labour market data still ahead. Equity futures on the S&P near session lows. We're down by more than 1 full percentage point. In the bond market, yields bleed just a little bit higher, up 2 basis points, approaching 430 on 10s, on 30s, approaching 460. From New York City, this is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Live from New York City, welcome to the program. Equity softer this morning. We've got declines. Take a look at the board. We're down by more than 1% on the S&P 500. On the Nasdaq 100, we are lower by 1.3. We're also softer by 1 full percentage point on the Russell. In the bond market, 2-year, 10-year, 30-year, your 10-year yield around 4.30. Yields higher in the last 24 hours, pushed higher by what's developing over in Germany. We'll talk about that in just a second. But also the economic data. ISM services coming in better than expected, going against the grain because the recent data has not been great over the past week on the survey side of things.
Particularly with ISM manufacturing, with the employment component came in really weak. You've seen this across the board. However, small inflection point, the Bloomberg Economic Surprise Index has just started to creep upward, and we did see that ISM services component, especially the employment one, coming a lot stronger.
We'll get more economic data later this morning, so look out for that. Let's turn to the European board. What a run for the euro. Euro dollar has just had a 3-day run, delivering 4 percentage points of euro strength. That is the best 3-day run in a decade. It's been that good for the euro. We're back to about 108. In the bond market, yields higher on a German 10-year yield. Now, if you're not familiar with the movement in the German debt market, 10 basis point moves are rare. 20 basis point moves are kind of unheard of. 30 basis point moves on German 10-year yields are things we haven't seen since the 1990s. Just unbelievable.
This is the immediate aftermath of the German reunification plan in 1990. That is the last time we saw a move like this. And potentially what they have proposed is as significant as that moment, given the fact that they are potentially going to unleash almost €1 trillion of spending, although potentially that much more because there is a blank check behind defense spending.
I think it's fair to say that it's the biggest move on record for Germany in its current form. On our radar this morning, EU leaders holding an emergency defence summit, the European Union looking to unlock an €800 billion package. The EU Commission President Ursula von der Leyen saying, quote, "We are in an era of rearmament."
I wonder if it's a bit of be careful what you wish for. And we were talking about this yesterday because we were speaking with Bob Michael of JP Morgan Asset Management, who said this week was the peak in dollar exceptionalism. And you wonder if that's going to come on the heels of money being sucked away from the United States in various forms and put toward a renewed dynamism of fiscal spending in Europe. And that, I think, is notable. And it is not just Europe, it is also China, but Europe is being pushed into it by the policies of Donald Trump.
Even though for decades we have seen the U.S. administration, not just Donald Trump, but Biden and others, tell Europe, you need to spend more. I love this quote from the Polish Prime Minister Donald Tusk as he enters into the emergency summit. The situation is very complicated and difficult, but I am convinced that this is the turning point where Europe understood what responsibility rests on it. Is this really the turning point that Europe actually follows through with all the rhetoric?
Euro dollar 107.89. Plenty of coverage on this story throughout this morning. Need to talk about the trade story as well. The Canadian Prime Minister Justin Trudeau isn't open to lifting Canada's return retaliatory tariffs unless all U.S. tariffs are also lifted. The Mexican president, Claudia Sheinbaum, saying she will likely have a phone call with President Trump later on today.
So I think that phone call is going to be this morning, because every single day she has a press conference in the morning, and she didn't give a reason why, but she said that's actually going to happen later in the afternoon. So likely that'll happen this morning. There's a lot of questions swirling around on what these auto exemptions actually mean, because until Donald Trump and the Oval Office sign a new order, technically the tariffs are on the auto space right now. Secondary question, the suppliers to the auto sector, are those also going to be exempted? And then what else is left? Brooke Rollins talking to our colleagues Jenny Leonard and Skylar Woodhouse yesterday, saying she's hoping the president looks at the agricultural sector. Potentially they'll get a carve out as well.
What do tariffs on avocados and mufflers have to do with potentially reducing the fentanyl trade in North America? And that, I think, is a question that's important to ask. Are there certain steps that Mexico and Canada can take to potentially push away tariffs on avocados and on mufflers? And the fact that the Wall Street Journal is reporting that calls were made and not accepted, and that also people familiar with the matter were talking about the potential that President Trump wants to tell the rest of the world, I am tough, I am going to put these on, raises some real confusion about what's on, what's off, and what the purpose is.
Can they provide the metrics for the Canadians and the Mexicans? We'll see. We need to debate the fallout. We've talked about this a million times. China and the tariffs on Chinese imports are on. That's really important to recognize. So the economic debate sounds a little bit like this. By definition, the importer has to pay the tariff. We've got all that. How the cost is distributed is basically up for debate. Secretary Bessel is making the argument the exporters will eat it. A lot of people are worried that either companies have to take it on the margin, and maybe that leads to job layoffs, or they pass it on to the consumer, and perhaps that leads to inflation. I think we can have an open debate about all of this. Maybe it's a combination of all three. Walmart is doing this, though. It's asking some Chinese suppliers for major price reductions as it looks to shift the burden of tariff impacts. Sources telling us here at Bloomberg that some suppliers have been asked to cut prices by as much as 10%. This is where Secretary Besant's pushing, and he hopes we'll see much more of this kind of stuff.
And Walmart's the poster child. It's big enough to have the heft to really push these type of changes on the supply chain. Whether the supply chain can handle it is one thing in terms of not becoming profitable and then pushing some of those cost reductions down the chain in other places. There's another point, though, too. And this indicates to me that Walmart doesn't think that it can keep the sales that it has while passing it along to the consumer. And that, I think, speaks to something about the economic data that we've been seeing and some of the uncertainty in some of the data that's been coming out of the United States.
And we're still potentially waiting for what this turns into in terms of retaliatory measures. We do know that China is fighting back, but this morning from the Chinese Commerce Minister, if the U.S. goes further on the wrong path, China will fight until the end. How difficult is this trade war going to be, and the whiplash of these headlines? We're, 6-7 weeks into Trump 2.0?
Some fiery rhetoric on both sides. Let's turn to the U.S. economic data. We get another round of jobless claims at 8:30 Eastern Time, ahead of payrolls tomorrow morning. Mark Giannone of Barclays writing, we retain our assumption that the FOMC will keep rates unchanged through June, at which point weaker payroll gains and progress on inflation prints should allow it to cut. Mark joins us now for more. Mark, good morning to you.
Good morning.
Let's start with those weaker payrolls gains. What's going to be driving that?
Well, you talked about the trade policy uncertainty that's out there, and I think this is a major factor here in keeping businesses on the side, having them wait or extend a little bit the time until they make a decision on investment. It makes them delay also potential hires. So we think we'll see more of that over the next few months.
Secretary Lutnick came on this program, and at the end of the conversation was pretty aggressive about it. He said, this is not my president's data. This is Biden data. It's too soon to see the policy changes that we're doing, the policy push that we're making, show up in the data. Are you seeing it in the data already?
Yeah, I think we've seen in the ISM survey, we've seen some concerns about tariffs. We've seen that in the University of Michigan consumer expectations, consumer sentiment. We've seen that in other measures from the conference board, for instance. So plenty of indications out there among consumers, among businesses as well, that people are concerned about tariffs. They're confused about tariffs. They don't know what the effect is going to be on their activity or on their consumption, on their income.
We've seen this before, though, when the soft data has shown some ambivalence by consumers or even negativity, and then they go out and they spend and they go out to eat. And we saw that yesterday in some of the services spending and the employment. It didn't seem to confirm the negative bias that we're seeing in surveys. When do we know that it actually is bleeding in? And what does the data, Biden data, become Trump data?
Well, I think we'll have plenty of Trump data in coming months. What we have seen now is consumer spending already slow quite a bit in January from the very strong readings that we had in November and December. That's probably going to continue to remain fairly muted in coming months. And the reason for that, I think, is, well, we expect to see lower growth in general due to the trade policy uncertainty, due to concern about income growth for at least some of the consumers. And so with that, we'll see less hiring, so payroll gains should be diminishing. And this is coming both from the trade policy uncertainty, but also on the supply side from fewer workers coming in and entering the labor force and generating jobs and generating income that fuels the consumption. So I think we'll see this deceleration taking place in the first half of this year and continue in the second half of this year. So that should ultimately result in lower growth. So we downgraded our growth projections quite a bit from something close to 2.5% last year to now our expectation is for this year to have a growth around 1.5%.
This raises a question about the bias in markets right now. Some people have come on this show and said the recessionistas are coming out and saying now is our moment to call recession and be really bearish. And they're wrong. This is just a natural cooling, and that's what we're seeing in the data, and it was the progress that we had seen really heading into this year. When is it something different, or is that accurate?
So we still think that we are not going to go through a recession, or at least that's our baseline case, unless the tariffs continue to increase at levels that we are not anticipating at this point, right? So for the current type of tariffs that are being discussed, we think that we can go through with like slower growth this year, higher inflation. When is this going to change? I think it's when we see even more uncertainty about tariffs, sharper increases in tariffs, and therefore then companies starting to lay off workers. We see the unemployment rate tick up, and then the recessionary dynamics would kick in with consumers retrenching, businesses stopping hiring, and then you have these typical recessionary dynamics that would jump in with elevated unemployment rate.
The Fed Beige Book yesterday, tariffs came up 49 times, and this line stuck out to me. Firms in multiple districts noted difficulty passing input costs onto customers. Do you think this is going to force the Fed to move up their cuts?
So we don't think so at this point. And assuming, again, that the tariffs are going to stabilize at the levels that we have seen so far. So we actually, in our baseline, anticipate that the tariffs on Mexico and Canada are going to have significant carve-outs or are going to be removed altogether. That's our baseline assumption. This, I must say, I don't have too much conviction about that, depending on the headlines I hear. So every now and then we hear concerning signs that actually some of the tariffs might stick, in coming months. But assuming that the tariffs on Canada and Mexico have very significant carve-outs, I think we are going to see some moderate slowing. I think it's to 1.5% growth. This is our assumption. If the tariffs stay, we'll have much more significant inflation and we'll have much more significant downturn.
The problem we have to confront in between, though, is the fact that no one knows what the tariffs will be or how widespread the carve-outs will be. And in the meantime, no one can plan. So we keep going back to that phrase we've heard a million times by the business community. They've expressed this so many times in so many different ways. Wait and see. If you wait and see, you're not hiring, you're not investing, you're not doing those things that you came into 2025 thinking about doing. And I think that's a problem. That's the problem we have already. Sitting here and saying that maybe down the road there'll be carve-outs. Perhaps it won't be 25% or it'll be 10. Okay, have that debate. I think it's an important one. But in the near term, we have a problem to confront right now. And that's the idea that people aren't doing things they were otherwise going to do. And that's going to show up in the economic data potentially.
And it's something that we've talked about extensively, the idea that being on hold, and you said this yesterday, is doing something. It is an inaction. It is a decision. I will also say there are anecdotes, particularly smaller businesses that have much smaller margins and depend on cash flow, that actually are laying people off because, frankly, they can't survive at the same size if they have that kind of tariff pressure on them. And we are hearing that across the board. That we heard that from one of our guests recently.
I think you can have some sympathy in the idea that if you pull back the government's role in the economy and increase the role of the private sector, you can increase the dynamism of the American economy over time. But you have to accept in between, there's a price to pay. If you're a federal worker right now, personally, I wouldn't be booking that vacation. I wouldn't be spending the money on that big ticket item because I'd be worried about whether I have my job or not by the end of the year. Now, you might make the argument that perhaps they're facing forces that all of us in the private sector have been facing for a long, long time, and you'd be right. But ultimately, for the economic data, that conversation's irrelevant. In the meantime, there will be a whole host of people in this economy pulling back because they don't know what the future holds.
And also, it's not just people who work in the federal government, and this is the key. It's contractors with the government. And there was an anecdote that I read this morning in a newspaper about this small company in New York that imports mangoes and avocados from Mexico that are going to be shutting down in certain capacities. There are those anecdotes starting to come out.
The destination still might be good, but
Correct.
the journey could be choppy. Mark, it's good to see you, as always. Thank you, sir. Mark Giannoli there of Barclays. Equity futures right now near session lows. We're down about 1% on the S&P 500. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Trump administration's top hostage negotiator has met with Hamas officials in Qatar. It's a rare instance of direct contact by U.S. officials with a group designated as a terrorist organization. Israel and Hamas are currently exploring an extension of their 6-week ceasefire that expired on Sunday. Elon Musk, meanwhile, has met this week with House and Senate Republicans on his DOGE efforts. Lawmakers urged the billionaire to communicate more effectively about looming cuts and work with Congress on a package for the cuts. They went on to warn that the actions might be struck down by the Supreme Court. Republicans also expressed frustration about specific cuts like those made among veteran affairs employees. The Wall Street Journal reporting this morning that Starbucks' CEO is telling corporate employees, step up, get back to the office, and take responsibility for improving the company. It was Brian Niccol's first address to employees since widespread layoffs last month. Next Wednesday, Niccol will be holding his first shareholder meeting since taking the helm in September. And that's your brief, John.
Danny, thank you. The vibe shift in corporate America is quite something. We heard it from Jamie Dimon. You're hearing it from Brian Niccol. Just think about how it used to be several years ago. Do you remember those reports of that first-year, second-year analyst or something like that at Goldman Sachs? Having a PowerPoint presentation for partners and saying we're working too hard? Do you remember that?
Yeah.
Oh, I remember
and
that.
I think they got more for their per diem for
My
ordering out if
goodness.
they work too late.
Yeah.
Things have changed, let's put it that way. They've changed pretty quickly since then.
Let's see how many of those people stick around. And that, I think, is going to be a key question at a time where there aren't a lot of other job opportunities.
Yeah. Up next on the program, the end of dollar dominance.
I think dollar exceptionalism has ended this week. I think you're going to see this flow out of dollar-denominated assets, and I think the dollar comes off from where it is.
That is a huge call from Bob Michael of JP Morgan Asset Management. We'll get reaction from Jane Foley of Rubberbank out of the City of London from New York City this morning. You're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, never does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Here's the shape of things this morning. We are negative by 1% on the S&P. We're down by 1.2 on the NASDAQ. Taking the headlines over the past few days, this move in the euro, in a single currency, 3 days, 4% move. Haven't seen that in a decade on euro dollar. Just absolutely amazing. Under surveillance this morning, the end of dollar dominance.
I think dollar exceptionalism has ended this week. Everyone has talked about how expensive U.S. markets have gotten relative to non-U.S. markets, but nobody wanted to step in front of the steamroller. And now the steamroller's rolling the other way, and I think you're going to see this flow out of dollar-denominated assets, and I think the dollar comes off from where it is.
Such a big call from JP Morgan Asset Management's Bob Michael. So here's the latest so far. The dollar on a 4-day losing streak and hitting a 4-month low against the euro as tariff policies weigh on growth expectations. James Foley of Rabobank writing, the return of US growth concerns has clearly been a drag on the dollar. However, the change in the fundamental drivers behind the euro have been even more dramatic. Jane joins us now for more. Jane, welcome to the program. I have to say, we talked about this a little bit earlier this hour. It takes time to internalize a shift this large on the continent. It would take weeks, months, maybe even years. Jane, could you just communicate from your standpoint how large a shift we're seeing from Germany?
Well, certainly it's a significant shift in terms of the news that we've had, but of course everybody in Europe is aware that things take time in order to come into fruition, and this is a real issue, I think, for the people who've been buying euros, aggressively this week. Is this just a sugar rush, or will we actually have a different determination of the time frame it needs to get this money through from Germany, from the EU, into the economy, into the defence sector? And if there are disappointments along the way in terms of that timing, well, we could see 105 again in euro dollar, and potentially quite quickly, because we know that there are hurdles. We know that if this change in fiscal policy gets through Germany, well, it's with the outgoing parliament. The new parliament after March the 25th could have legal challenges even to this. And then what about capacity? Europe doesn't have huge capacity in terms of defence. How quickly can it actually spend all of this money? So we know that the timeline for Europe could be quite disappointing.
So, Jane, you raised your forecast to euro dollar to 107. You said that you're going to update that by the end of this week. That means you have 1 day to really look at all of the facts and figure out how much is real and how much is overly optimistic. What are you looking at to make that determination, and what's the range of potential outcomes?
Well, I do think anything from the Fed is going to be really important here, because, we're hearing the arguments about the slowing in U.S. growth. We can see also, the stock market and how that in the U.S. could affect confidence for the U.S. consumer. But even though if we were to accept the fact that the U.S. economy is slowing, well, what about inflation? Because, maybe we were a little bit optimistic or pessimistic in terms of the inflation push from tariffs at the start of the year. But tariffs are still inflationary, and even if the Fed is worried about growth, it's unlikely to cut interest rates aggressively if it's concerned on the inflation front. So I think that's a really important part. To what degree are the Fed able to cut interest rates in an environment where inflation has been looking sticky. It was looking sticky because of the Biden month through the end of the Biden administration, likely to look sticky now because of tariffs. And we just don't know the impact of those tariffs. So the Fed likely to be cautious on that front. So whereas that could give the dollar a little prop higher, it's possible that the worries about timing about German fiscal spending could actually knock the euro a little bit lower from the perch that we've seen over the last couple of days.
Although if you take a step back, Jane, I wonder if Bob Michael is onto something and whether you would agree with this idea that more broadly, maybe it's not this week, but maybe it's this month, maybe it's the next couple of months that we're seeing the peak in dollar exceptionalism. And with all of the money looking to be raised elsewhere, there is going to be a sucking sound away from the United States in dollar assets.
Well, you know, I think this is a question really for about U.S. exceptionalism, really for the next decade, for the next 2 or 3 decades. Even I don't think it's going to be able to be answered in a very short term. I mean, to me, you know, one of the definitions of U.S. exceptionalism is the fact that the dollar has its own fundamentals, and that derives from the fact that about 50% of the world's invoices are in dollars, and that means that even when negative news comes from, say, the U.S. budget, people need their dollars. They buy their dollars. That's why it is essentially a safe haven. And for that to change, we're going to have this very slow, and it's already started, this very slow progression away from using dollars as an invoicing currency, and therefore, as a reserve currency. That has started. It's quite possible that Trump's policies with respect to Europe, with respect to Canada, Mexico, etc., make people move away from the dollars. But that is a very slow process, and I don't think we're going to be able to answer that question quickly.
Well, what fills the void, Jane?
Well, precisely, and that is why the movement away from the dollar, use of the dollar internationally will be very, very slow. I mean, clearly what we've seen over the last few years is, China wanting to use the renminbi as more of an invoicing currency, for instance. That will carry on, and some of its trade allies will continue to, be pushed in that direction. It is going to be interesting to see whether or not there is a European response over the next 4 years. That perhaps will depend what happens between Trump and Europe in terms of tariffs, for instance. But again, I think the question about dollar de-dollarization is a very slow one.
Hey, Joan, appreciate it. Jane Foley there of Rabobank on the shifts we're seeing out of Germany, potentially huge. It's got to get through Parliament, but it could be absolutely humongous. We mentioned how long it would take to internalise the shifts that are developing in the biggest economy in Europe. I would go back to July 26, 2012. Then ECB President Mario Draghi delivers a speech in London. And in the middle of that speech, he says, we will do whatever it takes to preserve the euro. Believe me, it will be enough. I was in the newsroom in London that day. I know people who were in the room. And the people who were in the room, some of which didn't really understand how big that moment actually was in the moment. It was only in the days and weeks after that we really got our hands around how big the shift was that we were about to see. I sense something similar in this moment out of Germany, who've used similar language, in fact, precisely the same language, whatever it takes. I think it's going to take a while to truly understand how big the rebalancing we could potentially see in Europe, and for that matter, the global economy and the bond market as well.
Some analysts talking about even a shift higher to 130 in the euro versus the dollar longer term. If you do get some of the promised funding, a lot depends on how serious they are, the methods to actually getting there. But honestly, this is a market that isn't fully efficient, because how do you fully price something that still is in its initial incipient forms?
There are some ifs that linger still.
Correct.
I think we should continue repeating that. Up next on the programme, Max Kettner of HSBC, Toby Marcus of Wolf Research, Jill Carey Hall of Bank of America, and the former chair of the Council of Economic Advisors, Jason Furman.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past
to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Staying on top of potential tariff risk is important.
Tariff policy is taking place in such a haphazard way, it ends up creating self-inflicted damage to the U.S.
I think dollar exceptionalism has ended this week.
The economy is still holding up fairly well, although obviously Q1 is looking worse by the day.
I think at the end of the day, the U.S. economy is going to prove resilient.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The declines resume. Your second hour of Bloomberg Surveillance starts right now. We're down 0.9% on the S&P 500. On the Nasdaq 100, we're softer by more than 1 full percentage point. Some weakness as well on the small caps. We'll talk about them later. The Russell, -1 full percentage point. Your day ahead shaping up as follows. 90 minutes from now, we will get jobless claims. Look out for that at 8:30 Eastern Time. An ECB rate decision at 8:15. A news conference 30 minutes later. This one gets far more interesting, given potential developments in Germany. Speaking of developments in Germany, developments in the bond market. 2-year, 10-year, 30-year out of Germany. The German 10-year yesterday up 30 basis points, 3-0. We had another 6, 285.
Which really raises the point that Ollie Crook was highlighting, and I think it was a great one, our colleague out of Europe, which is the ECB doesn't hold the cards anymore. If you want to see who holds the cards, it's the fiscal spending, and that's really going to be front and center. How the ECB responds to it, they're going to hedge, they are going to haw, they are not going to discuss it. People saying this probably will be the last 25 basis point cut, maybe even in the cycle, and they need to start to talk about neutral. But there's a bigger question here, which is, does it concern them that this bond market is raising questions about the capacity to absorb all of this debt while remaining with borrowing costs remaining in check?
That news conference coming from Christine Lagarde, the ECB president, at 8:45 Eastern Time. Look out for that. It's decisions made stateside right here in America that's pushing the Europeans, the German government specifically, to do things they've refused to do for a long time.
Absolutely. Donald Trump has been needling them to raise their defense spending, and of course, the fact that he is at the moment halting a pause in the transit of weapons going to Ukraine. Some intelligence is being withheld. So Europe has no choice, but they are forced to act. And Frederick Merz is saying, we're going to do whatever it takes.
Here in America, we're focused on the economic data. The latest data point, 8:30 Eastern Time, jobless claims, payrolls tomorrow morning. Economic data is going to become more and more important. Look out for more tariff deadlines, 25% on steel and aluminum. That's a week away. Then early April, we'll be talking about reciprocal tariffs. The United States going after the Europeans and maybe pushing the Chinese even further.
Absolutely. Tariff roller coasters, how the Wall Street Journal editorial board puts it this morning. Two key things I'm watching out for today. One, that we know that they're going to get an exemption on auto tariffs. We need to see that actually play up in the executive order, because right now they're technically still in place when it comes to the paper trail. Second, Donald Trump is likely going to get on the phone with Claudia Sheinbaum. Is there a deal that could potentially work out before Sunday when she says retaliatory measures will come into play?
With all this tit for tat, people are feeling uneasy. And we're seeing that in surveys, we're seeing that in the economic data. And I just wonder how much that's placing an increasing emphasis on economic data that's to the downside and making people dismiss data like the ISM services that came in hotter than expected yesterday. And so to me, it really puts the focus on an asymmetric response to negative news.
Look out for more economic data later on this morning. Coming up this hour, we'll catch up with Max Kettner of HSBC on US exceptionalism. We'll speak to Jill Carey-Hall of Bank of America on risk to small caps, and Jason Furman, the former chair of the Council of Economic Advisors, on tariff confusion. We begin this hour with the global bond market sell-off deepening and stocks resuming declines. Max Kettner of HSBC writing, Goldilocks has had a few scratches in the last few weeks. Data misses have started to cast some doubt over the idea of US exceptionalism. However, we'd argue this is precisely what we're looking for. Max joins us now for more. Max, good morning. Welcome to New York. We've got a lot to catch up on. What's that last line about? This is precisely what we're looking for.
I think overall, if you think from a more strategic perspective, then actually this is the kind of stuff you want for US exceptionalism. Because the problem is, think 2 months back, the consensus opinion was you got to buy the dollar, you got to buy US equities. And actually, when we look at anything else, don't even look at it. It's not even worth looking at. It's just the US and nothing else. And here we are 2 months later, and all of a sudden nothing's worked. So one of the, you know what I mean? Like one of the key ingredients for both this idea of US exceptionalism, but also the idea of Goldilocks is that you've got these persistent doubts around it. That, you know, people are saying, oh, AI, how are we going to make money with AI? And how about, you know, this big discount of the rest of world equities, international equities versus the US? Isn't the US too expensive? So this perpetual question around valuations. Now, that's the strategic question, right? That you're saying, hey, that idea of US exceptionalism is not dead. Absolutely not, because, you know, we've got lower corporate taxes, the S&P effective tax rate is much lower. Your ROE gap, I think I would always argue, look, you can look at valuations as a really, really negative sign from a strategic, a longer term perspective in the US. But you can also look the other way around and say your ROE gap between the US and the rest of the world has more than quadrupled in 15 years. So fine, you're paying a higher price, but guess what? You're getting more than 4 times as much profitability. Again, that's the strategic perspective. Doesn't tell us, unfortunately, an awful lot about the next couple of weeks.
This has been the most exhausting 5% pullback I think I've ever witnessed on the equity market on the S&P 500. Do you buy this weakness or chase the strength in Europe with banks up 25% year to date on the stock 600?
Yeah, I'd rather look elsewhere right now. So we've just put out a note this morning saying, look, guys, probably the US is not the place to be right now, at least tactically, because those tariff headlines are probably not going to go away. I think for the Fed put to come back into action, there simply isn't enough weakness yet, right? So you said this has been the most exhausting 5% pullback, and I feel it. I think all of us fall for
Have you ever seen anything like this when sentiment seems to have shifted so much, but the market's only done so little?
It's amazing. I mean, it is. We've actually done some analysis on this week when we look at some of our positioning and some of our momentum indicators. The drawdown that we've seen so far is almost only half of what we would usually see when our indicators go down by that much, right? So you've got a big shift down in those positioning indicators, but normally you'd say, yeah, that's probably like 6-7% down, but by that time it was only 3-4% down. Well, so that is exhausting, I get it, but the problem is for the Fed put to come back, we would need more weakness. You know, you're saying 5%, yeah, fine, but is the Fed really going to go in? It's like, oh my God, Nvidia is down, so yeah, we need to cut rates.
Well, hold on a second. There is this question about the journey mattering, and this has sort of been a theme over the past couple of weeks. How much does the journey matter if the destination is a good one? And we're talking about how it's only a 5% pullback, but it can be up 10% and then down 20%, and then eventually we'll get to 5% in one day. So it raises this question about risk-reward models at a time where you cannot model this type of volatility. You cannot model a headline risk. How much is that alone pushing capital away from the United States right now?
I think on a tactical basis, yes. I think on a tactical basis, Lisa, that's exactly what you want to do. When we look at, the US, if you had predicted what's happening now from a policy perspective in the US, if you had told me that a month ago, I would have said, risk off everywhere. Don't buy Europe even less. Don't buy China. Don't buy EM. No, don't buy anything. Now you look at it, I'm like, actually, you know what? Europe's really looking great. Like Germany, as a German, I look at this, and I'm like, this is as watershed as you can imagine. Right? Like the Germans spending money, and I know that from myself, right? To get myself, I'm in New York, and I'm just like, really? Coffee, $7? I'm like, I'm not going to have coffee. Actually, no, I'm going to go to the Bloomberg office every day, get my coffee for free, and then I'll go away, so I don't have to spend money.
You can borrow money.
You can spend it on but it is genuinely, it is such an extremely watershed moment for Germany. And then you look at the banks, and we've just, when I came in, it's like 25%. You still want to buy that? Heck yeah. Absolutely.
So when do you think that the optimism has gone too far? We were just talking to Jane Foley, trying to pour some cold water on this optimism that we're hearing around. When do you know that we're overstating it or understating it? What are you looking for?
Once you stop having the conversations about should we worry and what could stop it, I think then we're there, right? So it's a bit like with the idea of US exceptionalism at the end of December, beginning of January. Once everyone's super bulled up, then yeah, fine, you're probably done. But to be honest, when you look at positioning indicators, when you look at flows, certainly flows have been starting to come back into European equities, but they've only just started. Right? 2 months ago, you'd have said, why are we even looking at Europe? What's the point? Right? What is the point? And now we look at it, I'm like, wow, this is like the best thing ever. It's been 2 months. It might, again, because it's so exhausting, it might feel like 2 years, but it's genuinely just a couple of weeks. I'll give you an example. I was in Frankfurt literally 3 weeks ago. The amount of conversations with clients I've had about fiscal stimulus, about infrastructure and defense spending was zero. Absolute zero. Because 3 weeks ago, we're like, never going to happen. Come on, you need a 2/3 majority. Come on, why are we even talking? Yeah, let's talk about the next thing. It's 3 weeks ago. This is as watershed as we can imagine. And then you look at, you look away from the US, and you're saying, hey, why would I not buy German mid and small caps or European small and mid caps? You look at China, you look at the Aegis Tech trade, right? The broadening AI trade. You look at China Internet. Yeah, that still makes sense. No? You look at Japan, hey, rates probably going also a bit higher. Japan banks, fine, they've rallied a lot, but with rates maybe going another 25 bips higher than the market is currently pricing, great, still good for the banks. So you look outside of the US, and there's loads of things happening now that are actually really uncorrelated to the US. Whereas 4 weeks ago, I would have said, if this happens in the US, everything's going to go, correlation is 1 and everything's going down. And it's exactly the opposite, which is in fact really good. We guys have this conversation about correction and an exhausting 5%. If we were sitting in Frankfurt, we'd be happy daisy. I mean, we'd be like freaking cowboys right now.
Are you and your Frankfurt German friends thanking the President of the United States for this?
No, I think, that's probably a bit too far. I honestly also don't really care what the
catalyst is.
Sort of the catalyst is. The important thing from a market perspective is, number one, is it happening? Is it likely happening? Number two, is it sustainable? And that looks like it's happening.
You have a lot of conviction, though, that this is happening and will be sustainable. You don't think this is a head fake from the German politicians?
I think we've gone too far for that to be a head fake, right? For that to be like, oh, actually, never mind. Like, we just thought we're going to spend 800 billion.
I know, Europeans can be pretty fickle when it comes to spending.
Yeah, but that is mostly red tape and mostly bureaucracy, right? That is, and I think that's more the longer term issue. So then we get to your question on, like, is this a head fake? Tactically, it's not. Is this a great 3-6 month trade? Absolutely. Is this the watershed moment where we're burying US exceptionalism, and the next 3 to 5 years we're only buying European equities, and now European profitability is going up relative to the US? Probably no, because you've seen what Draghi was saying 2 weeks ago around implicit tariffs within Europe, that we've got implicitly 45% tariffs within the EU on goods and 110% on services. You look at the EU recovery fund, it's the uptake on the recovery fund from almost 5 years ago keeps being subpar and subpar, because it's not like corporates don't want it and governments don't want it, but there's so much red tape, so much bureaucracy within the EU, right? That needs to be tackled. That's not going to be tackled with infrastructure and defense spending. But those are two separate things. We can talk about the strategic asset allocation decision, the 7 to 10 year decision, or the sort of 6-month decision where you're saying, is the spending the watershed moment for the next 6 months? 100%.
In 6 months' time, can the bond market absorb it when we're having a real conversation about a massive tax bill going through Congress here in the United States?
I think so. I think, you mean in Germany as well?
I mean the global bond market.
Yeah, global.
Germany's issuing more. US might have to issue more. What does that look like?
But I think Germany traditionally basically starts issuing more on bills. So that actually, at some point, I think will be bringing in natural buyers for bonds. It still means, obviously, as we get more issuance, that probably bonds are going to continue to cheapen versus swaps in the next few weeks and months. But that trade's gone an awful lot already. But, I'm not particularly bothered. I think in the US, I'm also not bothered because, we can look always at the government debt side of things. But when we look at the private corporate debt side of things, massive deleveraging in the last 15 years. No? You look at net interest payments of corporates. When you look at those, we're like on a 20-year low. Because, corporates have been hoarding cash, they get the high cash rate, and they've locked in maturities. You look at the S&P, you got almost 60% of debt that's maturing after 2030. Why would I? When people are like, oh, yeah, but there's all this debt from corporates. I'm like, great, call me in 15 years. I don't care. So from that, the corporate sector and the private household sector actually looks way, way more healthy to absorb sort of that bigger issuance.
The Europeans just sound so happy right now, don't they? What a change.
When have you never seen me happy? I blame the coffee. I blame the free coffee.
No,
so, give the German free stuff and he's happy.
All I can say is watch him go buy a $7 cup of coffee and all of a sudden these fiscal stimulus plans, they're real.
Yeah, come back when it's like euro dollar 120, 125, back to 150 again. Max, it's good to see you.
Thank you.
That'll make a difference. Max Kentner of HSBC. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The White House said that it will exempt automakers from tariffs on Mexico and Canada for 1 month, following pleas from industry leaders. The exemption applies to auto parts that comply with the USMCA trade pact. It's intended to give companies time to come up with plans to move more investment and production to the U.S. That announcement pushed U.S. autos higher in yesterday's trading, though most of them are lower in the pre-market this morning. Also moving in the pre-market, Macy's, those shares down 2.25%, reporting earnings about 15 minutes ago. Its sales and profit forecasts were more downbeat than analysts had expected. Macy's says that it's taking a conservative approach on the outlook, given what it called external uncertainties that both the company and consumers are facing. Shares of Marvel are also down sharply in the pre-market, nearly 17%. It expects $1.88 billion in sales in the fiscal first quarter. Even though that was in line with the average estimate, some projections were as high as $2 billion. Those expectations for the chipmaker were high. Investors wanted to see a bigger payoff from the AI boom. And that's your brief. John.
Hey, Danny, thank you. More from Danny about 30 minutes away. Up next on the program, no pain, no gain.
I think for folks on Wall Street who may be concerned, look at what this president did for you in his first term. Wall Street boomed, stock market boomed. The president expects that to happen again, but most importantly, Main Street is going to boom.
That conversation up next with Tobin Marcus of Wolf Research from New York City this morning. Good morning. good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equity softer here. We're down by a little more than 1 full percentage point on the S&P 500. In the bond market, yields are higher by 3 or 4 basis points, 431.48. Look out for labour market data this morning, including 8:30 Eastern Time. Jobless claims just around the corner. Under surveillance this morning, no pain, no gain.
President Trump has made clear, Caroline, that he loves tariffs, but the stock market does not. How does he factor that into his decision making?
I think for folks on Wall Street who may be concerned, look at what this president did for you in his first term. Wall Street boomed, stock market boomed. The president expects that to happen again, but most importantly, Main Street is going to boom, and that's why the president has this whole of government economic approach, which includes tax cuts, tariffs, regulation cuts, and an energy industry that will bring down costs for American consumers.
So here's the latest this morning. President Trump freeing automakers from tariffs on Mexico and Canada for 1 month, buying them time to move more investment and production to the United States. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the program. It's been a conversation up here in New York. I'm not sure what it sounds like down in Washington, D.C. We got a flavor of it just then. How sensitive this administration actually is to stocks, to the equity market, to what happens on Wall Street.
Right, and John, you actually asked Commerce Secretary Howard Lutnick the same question yesterday, and he had responded exactly like the press secretary there, saying that this administration is trying to push forward its broader macroeconomic view here when it comes to deregulation, boosting oil production, and then, of course, importantly, trying to push through its tax cut agenda. That is going to be critical moving ahead, considering that we know that Capitol Hill is already starting to raise concerns here when it comes to getting those tax cuts across and also made permanent, as this White House would like to see. When we go back to the autos, that press secretary right before that question was also asked whether or not this White House thinks it's realistic to actually see significant shifts in production or plans within 1 month's time. And Caroline Levitt responded that President Trump told the big three that they better, quote, get moving. Of course, we're talking about some very complicated supply chains here where we see auto parts move across the border multiple times before a vehicle is ultimately finished. So the benchmark of progress that this administration is looking for is one of perhaps the biggest questions going forward about whether or not this reprieve or other exceptions or carve-outs that we see could ultimately get extended.
Tyler, thank you. Tyler Kendall over in Washington, D.C., out of the nation's capital. Joining us now is Tobin Marcus of Wolfe Research. Tobin, really difficult question to start, forgive me. Where do you think we'll be a month from now?
Well, a month from now, we will have just gotten past April 2nd, which is the much larger tariff rollout deadline that President Trump seems to have his focus on. You know, the confusion about the timing of the Mexico and Canada tariffs last week, I think, came just because he keeps talking about that milestone as the thing that he mostly has his eye on. You know, there's a ton of variability about what could happen then. He's talked about sectoral tariffs globally on autos, semis, pharma, agricultural products at a 25% rate. And then we have this reciprocal tariff policy that could either be like pretty innocuous if they're only really looking at tariff rates when setting those reciprocal rates. If they're throwing in value-added taxes, as they've said that they want to, you know, then we're looking at a much more dramatic expansion of tariffs globally to the tune of 13 percentage points on kind of global average tariff rate increase.
Tobin, when the president talks about tariffs, though, he's all in. And then the next day, 24 hours, 48 hours later, we see them take a step back. It feels like 2 steps forward, 1 step back. Autos are getting a reprieve. What else do you think will get a reprieve?
It's not obvious to me that anything else is going to get a reprieve. Again, he seems quite determined. Autos were by far, I think, the standout pain point. They were the example that everyone would give you. You know, it's this very high salience industry in the U.S., like a sort of a focus of national kind of pride in our industrial base that had just such obvious possibilities for kind of cascading disruption if you had, suppliers in Canada and Mexico were saying they're just going to shut down production and cause plants to be idled in the U.S. So, they went after that, but they've not done anything else, and it's not clear to me that they're going to. You look at the rest of the tariffs, the China tariffs are notably more sweeping than last time around. None of the exclusions for particular products, even things that consumers, really can see directly, have been given this time. Now it's just 10% across the board on everything, and I think they do have a real preference to go wide on these.
The Agricultural Secretary, though, Brooke Rollins, spoke to Jenny Leonard and Skylar Woodhouse at the White House yesterday, and this is what she said. As far as specific exemptions and carve-outs for the ag industry, perhaps for potash and fertilizer, et cetera, to be determined, she's hopeful and said everything is on the table. Isn't this politically really the third rail for the Trump administration, especially ahead of midterms when you're talking about the Corn Belt and the red states where agriculture is produced?
Yeah, I mean, obviously last time in the first Trump administration, we saw kind of countervailing subsidies that were meant to blunt the economic impact of the tariffs at that time on farmers. Certainly, I think there was going to be some solicitousness of farmers, but, the message that Trump sent in his joint address to Congress the other day was very much like, it's going to be great eventually. We may need to deal with some disruptions in the meantime. So, I wouldn't rule those out. It's not like it dramatically scales back the tariff regime if we carve out potash or fertilizer or what have you. Those are relatively small shares of total U.S. imports from Canada or anywhere else. So, it could be done painlessly. But again, the fact that it hasn't already been done is an indication, I think, of how much they do want to leave as much of this in place as possible.
A couple of weeks ago, people were speculating on the motivation behind some of the tariff threats and the tariff implementation. Some people said that it would lead to lower tariffs in North America after a renegotiated USMCA. Some people said that it was to encourage different national security issues, and other people said it was because this is a president that actually wants to put on tariffs, wants the higher walls to protect U.S. production. Do we have a clear sense of which it is?
We don't entirely. There's certainly been some continued interchangeability in rationale on these. You hear, even within the same interview, Commerce Secretary Lutnick, for example, will often talk about, you can't just, kill Americans with impunity by letting fentanyl flood into the country, but then also talk about them in terms of economic justifications. And certainly what we've seen in terms of the limited relief so far, that has been very economically motivated. I think that the latter of your three justifications seems closest to what Trump himself is thinking. Even this sort of 1 month delay seems to be intended to kind of dovetail with this larger rollout on April 2nd, which kind of makes these tariffs part of the same overall economic framework that he's been putting in place, particularly since, there's definitely no clarity in Ottawa or Mexico City about what they're being expected to do on fentanyl in order to get these off.
Tobin, we'll find out if he gives us many details, if there is a call, a little bit later. Tobin Marcus there of Wolf Research. The press secretary making the point, I think it's a valid one, to think about the fuller policy platform and not just trade. They're going to be doing other things as well, deregulation, tax cuts. This conversation needs to shift pretty fast to those other few things.
And they need to get the support of a number of representatives who are facing off with some of the concerns that Anne Marie was talking about, which is whether it's DOGE and job cuts there, whether these tariffs affect people in their particular regions and they get the blowback. So it raises this question about how much support congressionally he has for some of these proposals.
And when it comes to Congress, there's a massive to-do list before they start talking about the extension of tax cuts. We might have a government shutdown next week. That is on the precipice of what they're dealing with right now. Then you have the debt ceiling in the summer, and then they're going to have to fight it out when it comes to the extension of TCJA.
There's an ECB meeting taking place right now. There's a decision at 8:15 Eastern Time. 30 minutes after that, there's a news conference. In 2 weeks, the Federal Reserve has got to put out forecasts. Keep repeating that, March 19th. That's going to be very difficult to do. In just a moment, we'll catch up with Jill Carey-Hall of Bank of America on the potential impact of tariffs on small caps. That's next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Let's check out the equity market. Equity futures down here by 1 full percentage point on the S&P 500. On the Nasdaq, we're down by 1.26. Yesterday, we snapped a two-day losing streak. The losses resume. We're down by more than 1 full percentage point on the Russell. We'll talk about the small caps with Jill Carey-Hall in just a moment. I want to turn to the bond market. 2-year, 10-year, 30-year yield. Yields on a 10-year this morning higher by 3 or 4 basis points. The 10-year, 431.29. We're up by 4 on 30s to 460.94. At the corner of my eye, a data point that we don't typically break or typically see. Let's get over to Mike McKee and try and bring Mike in on this data. Mike, challenger job cuts is a data point that maybe we look past. Not this morning.
Not this morning. This is going to catch people's attention. And Lisa, you've been asking, when are we going to see Doge in the data? This is the first black cloud on the horizon, I think. 172,000 job cuts announced. That's a more than 100% increase over the last month. Now, Challenger breaks it down this way, saying government jobs, they've lost almost 62,000. Then consumer products and technology also contribute to this. Education jobs down by almost 3,000. And that may be part of the NIH situation. Now, the second biggest is retail. That doesn't have anything to do with Doge, but it probably does have to do with the 20,000 employees at the Joann stores, which are going out of business, and also some store closings from Macy's and Kohl's and others. So while this data probably won't show up in the February number we get tomorrow, we are setting ourselves up for a very interesting March. I do have to caution that job cut announcements don't necessarily mean that many job cuts, because maybe they're filled through attrition or maybe they don't happen over a period of time. So we don't usually pay a lot of attention to Challenger, as you said, John, but in this case, it's a number that certainly feeds the narrative we've got these days.
And Mike, it's only one half of the ledger as well. Job hirings, of course, is another part of the picture we need to discuss. But Mike, for a number of months, we've had a very low churn dynamic in the labour market. That's a phrase that Andrew Hollenhorst of Citi has described things by, because hiring has been quite low. And we've also seen firing soften as well. Quits have softened up as well. This freezing of the labour market has really taken hold over the last number of months. What would explain something like this?
Well, it may be a combination of the Doge effects in Washington and then sort of a churn you get at the beginning of the year as companies reset. You mentioned hirings. Hirings were up quite a bit, 34,580 compared to just over 6,000 in the month of January. And there's always a lot of churn in the labor market, but now it's the job cuts that are getting the attention because everybody's seeing this story play out day after day. We've got in an hour coming up the jobless claims numbers, and that's going to be interesting to see because we should start to see there some of the federal workers numbers show up in the data.
Your tone is the correct one, Mike. I'm saying as markets really don't respond massively to this, it hasn't been a data point that has been looked at as a tradable one for a while. I am curious, though, this in particular, planned cuts last month were the most for a February since 2009. That kind of forward look, is there some tell in that kind of tone from these challenger job cut data?
Well, certainly it suggests that there is something going on here. Now, what is interesting is all these Doge numbers basically have not been announced. They've just been happened. I mean, we get told after the fact that all these people get laid off. So a number of these may be in private companies who are contractors for the government, and that would suggest that there is more going on underneath the surface that we need to pay attention to.
I feel like Lisa today, because I keep referring to the beige book yesterday, but I actually, for the first time, I think in ever, I thought it was interesting. The Chicago district said there were many contacts that reported having little trouble filling positions. One contact in retail said they had, quote, resumes stacked to the ceiling. How quickly could the labor market really start to crack, Mike?
It could start to crack quickly, although at this point, it's really about the psychology of growth. If the companies out there start thinking about a recession and start trying to plan for one, you will see a lot of cuts right away. What John said earlier has been holding, that companies are just sort of not hiring, but they aren't letting people go. If that's going to change, then that's something that the Fed has to worry about.
Mike McKee, appreciate the breakdown. We'll catch up with you again in about an hour's time. Mike McKee on jobless claims at 8:30 Eastern time. I think a little additional weight adds to the importance of jobless claims later this morning. Just to go back over that data, the Challenger job cuts, the announcements totaling just north of 172,000 in February, a 103% increase from last year. That increase the most since 2020. I think we have to recognize it's only one half of the picture. The other half is hiring. Hiring picked up as well. But it's interesting to see things start to loosen up in the labor market. To Mike's point, and I said it earlier, things had frozen up a little bit. Not so much anymore, based on that data point.
There has been a shift, and we see it in the headlines in terms of Doge job cuts. This is interesting to me, and especially the market reaction that isn't that significant. And I wonder how much some sort of negativity in the jobless claims data will also be shrugged off as some of the Doge effect. At what point does it suggest some sort of broader weakening? And I think that is a question that can only be answered by corporations and some of their forward guidance.
These are plans, not necessarily going to see the actual layoffs take place, and we'll see what happens. Could be a head fake, I don't know. But every single day, as we get more data and build a fuller picture, Lisa, we've got to keep going over the data points as we get them. We'll get another one in about 55 minutes.
And that's going to be really important to see in terms of initial jobless claims. I do wonder, the idea that we keep talking about how federal employees are a pretty small number, but the contractors are not. We have to add to that the uncertainty that tariffs cause for smaller companies that are dealing with much smaller margins, and that anecdotally are looking around and saying, if this goes on and the uncertainty, the longer it keeps going, the more we have to retrench our headcount.
Stocks have got to deal with that as well. We're lower by 1 full percentage point on the S&P 500. Tariffs, job cuts, got to talk about equities. Jill Carey-Hall of Bank of America remaining cautious, saying small caps are more at risk from tariffs given their thinner margins. Deregulation should be bullish for parts of small caps, but the macro backdrop will remain important as well. Jill joins us now for more. Jill, good morning. It's good to see you.
Good morning.
What happened to all the bullishness on small caps in November after the election? Where did all that go?
Well, I think, we going into the year, we've been cautious on the Russell 2000 despite some investors' bullishness, and I think the economic backdrop, if that remains supportive, is obviously a positive. And if we see deregulation, that will certainly be a positive to pockets of small caps and many pockets of the market where it's not necessarily priced in, we think, in sectors like financials. But I think there's a couple issues with the Russell 2000 right now that still make it challenging. I mean, a year ago, everyone expected that small caps would see a bigger earnings recovery and would see very strong earnings growth. That keeps getting kicked down the road. And, this earnings season, we haven't really seen any evidence that make us feel very confident in that strong earnings recovery that consensus has been expecting. The corporate guidance from companies has been weak in both large and small caps. And part of that may be seasonally. Usually corporates do issue weaker guidance in January and February. But the commentary on earnings calls, even though it was very positive for larger companies in terms of corporate sentiments, when we look at positive versus negative words on the earnings calls, it was very negative for small caps. And the spread between that corporate sentiment measure for small and large was actually the most negative we've seen in our data history going back to 2004.
This is important at a time where big companies might have the negotiating power of, say, Walmart, that can go try to job bone some of their suppliers down to lower prices by 10%. How much thinner are the margins? Can you give us any sense of what you're seeing in terms of how susceptible and how more susceptible some of these smaller companies are to some of the tariffs?
Right. I mean, I think the Russell 2000 has been challenged in that, it's been in this earnings recession since 2023. It hasn't really climbed out of it yet. These companies have thinner margins, as you mentioned, and we've seen just a record proportion of non-profitable, non-earner stocks within the Russell. So the fundamental backdrop has been a lot more challenged, and at the same time, as interest rates had risen, the debt profiles of these companies have been a worry. So if we see higher import costs for these companies, the potential earnings hit for small caps, if we assume a scenario of the current tariffs on Canada and Mexico and China, and then we assume retaliation, this could be about 3 times as much of an earnings hit for smaller caps in the Russell 2000 as it could for the S&P 500.
Some people, and just a contrarian view to push back, would be that yields are actually going lower in the United States, even as they climb everywhere else. You are seeing lower borrowing costs as a result, and you also are going to get an extension of tax cuts that could potentially be better at a time where less regulation could also lead to that M&A boom that's been iced for now. How much can that offset the hit that you were just talking about?
I think, this will definitely be a benefit to pockets of the market. So I think there's been a broad view that, okay, the M&A will pick up and this will benefit the Russell 2000. We haven't necessarily seen that historically. The Russell has actually underperformed more frequently in years M&A has picked up a lot than outperformed, often because the market's already run up and valuations were more extended. Maybe not necessarily the case for the Russell now, but valuations aren't necessarily cheap anymore. So I think, the macro backdrop, cost of capital, there's going to be other drivers beyond just who chairs the FTC for M&A. But I do think, when you see M&A pickups, it does tend to benefit pockets of small caps, whether it be areas like staples or healthcare. We've seen a pickup there. Financials, we expect that area to see an M&A pickup. Deregulation, I mean, we didn't necessarily see small caps outperform during the last period of deregulation because of the other factors that were going on in terms of trade and manufacturing recession. So I think the manufacturing backdrop will be important. We are expecting a manufacturing recovery. So looking at the ISM and some of the other data points, many of them are still supportive. Some of them have been a bit more mixed, but that is something that would be supportive of small caps broadly. But I think all of this suggests that you want to pick stocks. This is a backdrop where there's a lot of different baskets and pockets of the market that will be behaving very differently based on a lot of these factors that we're seeing right now, whether it's trade or immigration or manufacturing, bullish themes like productivity and reshoring. So stock selection is going to be more important, we think, than just buying an index.
The president said, he was honest, he said it's going to be disruptive and we can live with some of that pain. Are you potentially saying you'll become less cautious when potentially some of the better policies, at least is pointing to, tax cuts, deregulation, come into play maybe later in the year? Is the sequencing what's hurting the small caps?
I think, if some of the policies that could potentially impact earnings more in terms of tariffs or immigration, where small caps are a more labor-intensive size segment, are front-loaded, that certainly can impact, the size segment more. And also if it just creates uncertainty for corporates, and at a time, like I said, when some of these companies have still been trying to get out of this earnings recession. We think mid-cap companies, within the SMID umbrella actually look better positioned. They're better positioned fundamentally. They've seen earnings revision trends turn positive. They have cleaner balance sheets, better fundamentals, potentially less earnings risk, better margins in terms of the risks from tariffs.
How often are clients asking about Europe right now? How much has changed on that front?
Well, I think, there's obviously a lot going on globally, and the U.S., we think, in terms of the S&P 500, still looks like a high-quality area. And, the S&P 500 is obviously expensive, but, that's one reason that we think the equal-weighted index within the S&P and large-cap value, there's, potentially less extended positioning and valuations and more upside for some of the cyclicals in that pocket of the market.
Jill, appreciate your time and the clarity on a stock market. Jill Carey-Hall there of Bank of America. I remember a conversation I had with a guest a long time ago. When I first moved here, so the best part of 10 years ago, and they came on set and I asked about Europe, and they said to me that Europe was good for vacations and not for investing. That conversation's changed pretty quickly at the start of 25.
I was actually wondering, as you were talking, and the fact that you brought it up in your response, I'm thinking, you kind of flip it on its head. Now maybe it's good for investing, but I'm kind of glad I got my European vacation.
Not so good for vacations at 108? You're complaining about 108?
Well, I'm not complaining about that, but people talk 130. You were mentioning 150. What?
The 130s, 140s again. I wouldn't be happy about vacations in Europe at those levels again.
I lived there at 134 in Rome.
Don't want to repeat at that. I'm happy around 110. I think that's a nice compromise.
I'm glad.
Not that I've got any skin in the game. These aren't trade recommendations.
Keeping the Puglia trip at 110?
These are not trade recommendations, okay? Jill, it's good to see you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. German bonds are extending their decline this morning of about 5 basis points. That follows the biggest sell-off since German reunification in the 1990s. At one point, 10-year yields hit 2.93% this morning. That is the highest since October of 2023. Driven by a sea change in Germany's spending plans, the bond sell-off has gone global. Japan's 10-year yields, for example, crossed 1.5% for the first time since June of 2009. Elsewhere, sources tell Bloomberg that Walmart has asked some Chinese suppliers to reduce prices by up to 10% in order to offset the cost of President Donald Trump's tariffs. Suppliers have pushed back, citing already thin margins and concerns that further price cuts would lead to losses or compromise product quality. The Wall Street Journal reporting that President Donald Trump is expecting to issue an executive order that would abolish the Department of Education as soon as today. A draft of the order, viewed by the Journal, directs Education Secretary Linda McMahon to take all necessary steps to facilitate the closure of the Education Department. The White House has not yet responded to a request for comment. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny later on this morning. That story won't go away, will it? Keeps lingering.
It keeps lingering, and they want to put education back into the states. The issue is there's a number of grants, students that have special needs, some of that money, and also it gets appropriated in Congress. There's going to be a lot of fights between DOGE and Congress.
Interesting read in the Journal this morning. Up next on the program, tariffs fueling economic fears.
Some tariffs will come on right away, and then some tariffs will go be registered, and they will take 3 weeks or 4 weeks. So there's a process for tariffs in America. Once it's in, they will stick.
Jason Furman, the former chair of the Council of Economic Advisors under President Obama, joins us next from New York. This is Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Listen carefully. Can you hear the rhythm in the markets? Not not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Live from New York City, welcome to the program. Equities down about 1 full percentage point on the S&P 500. A data point came out about 20 minutes or so ago that we wouldn't typically talk about. Challenger job cuts. According to data released from that firm just moments ago, reporting an increase in job cuts, a 103% increase from last year, the most since July 2020. Only one half of the picture. Hiring also picked up, but this data that comes out, Lisa, is going to get more and more attention over the next few days.
This data has been influenced by some of the DOGE cuts in Washington, D.C. federal workers. It is showing up. But the fact that we just saw the biggest print of job cuts and expected job cuts going back to the Great Recession is definitely something fueling a tone.
Under surveillance this morning, tariffs fueling economic fears.
Some tariffs will come on right away, and then some tariffs will go be registered, and they will take 3 weeks or 4 weeks, and they will come on in due course. So there's a process for tariffs in America, but we will announce them, and we will be negotiating with all these countries thereafter, and then they go into effect over a period of months. Once it's in, they will stick.
So here's the latest this morning. Markets looking for more tariff relief from the Trump administration, delaying levies on auto imports for a month. Jason Furman of the Harvard Kennedy School writing, I've rarely seen an economy turn negative as quickly as this one has. But people shouldn't get over their skis. I expect all of this to slow growth and add to inflation, but don't expect anything dramatic in the data right away. Jason joins us now for more. Jason, welcome back to the program, sir, and I'm totally with you. I think we all are. This shift we're seeing in sentiment in just a month, so big and so quick. Where does that more constructive tone come from at the end of that quote there? Why should we ultimately avoid anything too dramatic?
Look, there's no debate that the Trump administration has been negative. Just about everything they've done has been negative for the economy and is going to hurt it. You can debate the magnitude. And partly I'm reacting to, there was the Atlanta Fed's GDP Now said that the economy was cratering in the first quarter. I think that number was flawed. Things move slowly. You know, consumers are really, really nervous, but my guess is that they're probably still spending and they're going to wait and see how things turn out. So the types of problems we're seeing now, they take time to build. They don't just go straight to recession.
Jason, we do have a carve-out, though, for the auto sector, and there's lots of conversation. Maybe agricultural will be next. If you're USMCA compliant, you get a carve-out, basically, does that mean these 25% tariffs came and went, and what's the impact going to be?
You know, there's tariffs that are going to come, there's tariffs that are going to go, and then there's more tariffs that are going to come back. I mean, you just showed Howard Lutnick. He expressed pretty clearly that there's going to be more and more and more, and as he just said, they're going to stick. So, yeah, you can do carve-outs, but there's still lots and lots and lots of tariffs on Canada and Mexico. And remember, you know, we're less than 2 months in to this administration. In Trump's first administration, it took him nearly 18 months to get to the first set of tariffs. That was after an extensive and judicious process, and it was on a much smaller set of imports than anything we're seeing now.
What do you make of the April 2nd argument that they're looking for reciprocity, basically trying to make sure they can rewrite the rules of trade so that it actually is, in their mind, free and fair?
We already have reciprocity. If you look at other rich countries, their tariffs against the United States tend to average about 1–2%. Our tariffs against them average about 1–2%. On average, they're the same. Now, there's some things they have higher tariffs than we do. Some things they have lower tariffs than we do. but they average out to about the same. So we have reciprocity. If they want to sit down and do a free trade agreement and get those tariffs from 1 to 0, I'd sign up and be wildly enthusiastic.
Jason, you said that it takes time. This is a barge, and to shift the U.S. economy will take more than just a couple of weeks of bad sentiment. At what point do you think that we'll actually start seeing some of the uncertainty and some of potentially the expectation of higher prices begin to show up in the economic data, the hard data?
Yeah, I mean, I think you're going to start to see it right away, but it'll start pretty small and grow. Some of what I'm most worried about here is actually what it does on a 5 or 10-year time horizon when you're talking about how businesses think about their integrated supply chains, how they organize themselves to have maximum efficiency. Now they're going to have to think how they organize themselves to be resilient against an extremely uncertain political system. But I think you'll start to see it a little bit right away, but it'll really grow. And of course, it depends on, do these tariffs escalate or do they end up dropping all of them? And of course, anything is possible.
This is a pretty significant regime shift, at least when it comes to tariffs. And yet what we've been talking about a lot of this morning has been Europe and has been China and has been what's going on there with respect to fiscal stimulus and supporting their defense sector. And it's raised this question that JP Morgan's Bob Michael raised yesterday, where he said, we saw the peak in U.S. dollar exceptionalism this week. Do you agree with that? Is that something that you're seeing in terms of the slow drip feed of rearranging supply chains and even maybe invoicing that we see around the world?
I feel pretty good about the dollar and pretty secure about the dollar, although if you wanted to do something about dollar supremacy, you would throw a massive amount of uncertainty into the U.S. economy, which is what we're seeing right now. But I think even that won't be enough. And look, what we're seeing in Europe is good. I'm glad that Germany is untying its hands. I know that's a little bit for the bond market to adjust to up front, but absolutely the right move. And Europe has been behind in spending on its own defense. They do need to shift to something more like closer to a wartime economy, so that they can really be in a better position to defend themselves.
They've been massively behind. Jason, it's good to hear from you, as always. Jason Furman there of the Harvard Kennedy School. I think you referred to the US economy as a barge, more like a supertanker, right? Very, very difficult to maneuver. Things don't happen very quickly.
I like the reality check, saying, look, people can feel bad, but they still go out to eat, they still buy sweaters, they still buy watches. And that is what we're seeing right now. At least we look at the services data. Question is that drip feed and the 5 to 10 year outlook, and how do you even begin to model that at a time where we're focused on what could happen in the next 2 minutes?
And maybe the market's getting over their skis because the headlines have been like a fire hose, and they have been very quick. The problem is you do with tariffs, at least the administration taking a step forward and then one back. And the problem is you just don't know how far back they're going to take some of these measures.
We're focused on the next hour of programming. 8:15 Eastern Time, ECB interest rate decision. 8:30, jobless claims. 15 minutes after that, a news conference with Christine Lagarde. Coming up, Andrew Sliman of Morgan Stanley, Pooja Kumar of TD Bank, Constant Hunter of The Economist Group, and David Rogel of BlackRock. From New York City, with equity futures down 1 percentage point, this is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want But with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world, and so that has been very lucrative as a business.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it on the China Show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek did was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China Show live every weekday.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We've had a really good run in asset prices here. With another round of tariffs coming and the blizzard of policies that come out of Washington, there's going to be a lot of volatility.
The key downside risk from our perspective would be if the tariffs wind up amounting to more than we had anticipated.
I think people pull out, the valuation questions are there, and we have this erratic policy that's too hard to invest.
We're probably going to get some pullbacks, high valuation, slower growth, policy uncertainty.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your next 60 minutes looks like this. At 8:15 Eastern Time, an ECB rate decision. 15 minutes later, jobless claims in America. 15 minutes after that, we'll have a news conference with the ECB president, the central bank president, Christine Lagarde. Look out for that later on this hour. Your scores at the moment look a little something like this. Equity futures near session lows. We're down by 1 full percentage point on the S&P 500. On the Nasdaq 100, we're down by 1.4. Check out the bond market and look at the front end of the yield curve. Yield's down again by 6 or 7 basis points. It's a break of 4%. It's 3.9384. And Lisa, the economic data becomes more and more important this hour.
What we can do is basically flip the whole script coming into this year right now during this week, where growth was strong in the U.S. and going to be weak everywhere else. Suddenly, that is no longer the case. You have Europe, which is investing in a fiscal spending package that we haven't seen yet in terms of confirmation, but is certainly being priced into the market. And in the U.S., we just got challenger job cuts that highlight the potential pain from the federal layoffs and really sets up these initial jobless claims that we get in about a half hour time.
We've had some conflicting data over the past week or so. Consumer sentiment dropped back. A lot of people blamed tariffs. We saw the same thing in ISM manufacturing. Within the survey, the respondents pointed to trade uncertainty. ISM services, bit of a relief on that front. Beige Book overall, the tone was decent still, just about okay. Jobless claims is important, payrolls even more important. Tomorrow morning, we're still looking for 160 on payrolls.
And a lot of people are looking past disruptions that could be tied to what we see in Washington, D.C. You can see that with a pretty muted reaction to today's numbers from the jobless announcements from the challenger front. I just am curious about at what point people are discounting the good news. and focusing on the bad news because they're looking for the high-frequency data that isn't really going to confirm it in the same degree that a lot of people are feeling it.
I think they just want the clarity. Tell us what the tariffs are and on what. Is it 5%, 10, 15, 20, 25? Is it on autos, off autos? Why do we have to go from one day to the next not really knowing? Just give us some clarity so we can plan. We came into 2025 with lots of confidence. These companies want to hire. They want to invest in America. They're anticipating tax cuts still to come later this year. It's that volatility around policy which is unhelpful.
Well, it's a feature, not a bug. And throughout this entire process, Donald Trump, the negotiator, has actually been able to get concessions when it comes to Mexico and Canada on things like the border and on things like fentanyl. The issue is, of course, the pullback in the stock market and the fact that now we're already seeing the autos get, technically, they said they're going to get a carve-out. We need to make clear, I'm waiting for the executive order to drop, that it's actually been amended. But now the conversations are, well, what about every other sector that is USMCA compliance? What I'm most looking forward to today is not the ECB, but Scott Bessent, the Treasury Secretary, speaking at the Economic Club of New York at noon.
A little bit later on this afternoon. Coming up this hour, we'll catch up with Andrew Sliman of Morgan Stanley on when it's time to buy stocks. Pooja Kumar of TD Bank on today's ECB decision, and David Rogel of BlackRock reacting to US jobless claims. We begin this hour with higher bond yields and stocks resuming declines. Andrew Sliman of Morgan Stanley writing, I think this is a time to get incrementally more bullish. We have seen a dramatic risk off. I think we can now increase our exposure to risk on stocks. Andrew joins us now for more. Andrew, welcome to the program, sir. It's good to see you. We said earlier on the program, the most exhausting 5% pullback I can remember. Andrew, why is now the time to buy?
Well, I think that it's a 5% pullback, but you've had a series of stocks that were very speculative in nature, and they've really pulled back hard. And, you know, if I was on a month ago, I would have said, look, I'm worried there's too much enthusiasm for these, you know, kind of go-go growth stocks, and they've been actually taken to the shed. So I think this is going to be the story of this year, which is it's more of a trading market. I think the market will end the year, you know, fine, but it won't be as good as it's been the last 2 years. That's if you're not going on a limb. But the problem is the market's open, 250 days a year. And if you get a single-digit return, that's a lot of movement around a single-digit return. So what Lisa said before, I think is right, which is sentiment is very washed out now. It wasn't a month ago. And, you know, it's a time to get incrementally more optimistic. My experience, I've been in this business a long time, Jonathan, you fade DC when people are too optimistic about DC, and you get more optimistic when people get very negative about what's going on in DC.
Well, Andrew, I want to understand that this is fine. It will be fine by the end of the year. What's the strategic anchor that gives you the confidence by the time we get to the end of the year, things will be fine?
Yeah, two reasons. Number one is I'm not as convinced that earnings are going to collapse. You saw fourth quarter was very good. We haven't even begun to factor in the possibility of tax cuts. Now, you may say, oh, it's never going to happen, but no one's factored it in. And so I think earnings are going to come through. The problem is the multiple is too high. The story of American exceptionalism, when you really think about it from a multiple standpoint, has been that we've had these big tech stocks that were capital light, and that's what drove the multiple higher. Well, you know what? They're not capital light anymore. They're spending a lot of money. So I think the story will be that earnings will come through, but maybe the return won't be as good. It will bring the multiple down. And the other thing that I think is key here is that we really have only seen flows from retail turn positive second half of last year. 8 trillion, 7 trillion, whatever the number in money markets, that was the hottest product until the second half of last year. So I think there's a lot of liquidity, and you have the Fed cutting. So I don't think it's a negative year. I just think we're coming off two very good years, and we need to play catch up on the multiple.
Andrew, I hear you, and there is a lot of liquidity out there. And 2 weeks ago, people would say, where else would it go other than the United States? But suddenly there's a competitor. And suddenly there is a story that's not just about policy uncertainty in Washington, D.C., but about fiscal spending in Germany, fiscal spending in China, and the potential of bright shoots elsewhere. How much does that change your equation?
Yeah, I mean, I think that's right. I think there are other alternatives, and I think that would be reflected in the multiple, not as much necessarily in the fundamentals. So yes, I think China is very intriguing because you're seeing these companies fundamentally, they're beating numbers, right? their multiples are a lot lower, and now you have a government that has done a huge pivot and is now embracing. However, as an investor, you have to be a little bit cautious on there will be noise coming out of Washington D.C. and Beijing. So I think it's a place to incrementally increase your exposure relative to the U.S. And I think Europe is intriguing also, although I can't help but wonder whether Europe is kind of like China was last fall, where you get this big pivot on hope, and then kind of some of the reality set in, and maybe there was too much enthusiasm, too immediate. I think there's a chance that, let things calm down a bit and then go back in and, look for opportunities. That's what we did in China. We didn't chase it last fall, but as the stocks started to come back down, and then once that pivot, that meeting with Xi, that was really the time to step in.
Andrew, there's a link between what we're seeing in terms of Chinese tech stocks and what we're seeing here in the U.S. this morning with U.S. tech stocks, in particular NVIDIA, that are getting hit hard yet again. And I wonder how much the story, if we didn't have the stuff going on in D.C., if we didn't have the potential fiscal spending in Europe, would it be about some new advancements made by Alibaba, by Manus AI, talking about the DeepSeek moment on steroids and saying they can do more with less and suddenly come out with these models? How much does that challenge the U.S. tech companies that are spending, as you said, that aren't capital light?
Yeah, I mean, I agree with that. And then the problem is you have a multiple differential between the hyperscalers and the Chinese tech stocks. But I'm a believer in the big semiconductor companies because there does seem to be this advancement. Morgan Stanley just had a tech conference. I heard nothing but good things for the NVIDIAs of the world. And so I do think there is an opportunity there. And look, going back to the original question from Jonathan, I think you have to look at companies. What companies have just had big pullbacks that are fundamentally doing well? And I think there's some of our tech stocks are in that range. I just think these very big mega cap tech stocks, they have a spending problem for their multiples, and that's what's going to keep the cap on the S&P this year.
Andrea, you mentioned the Fed and that the Fed's going to be cutting rates and that that's part of the bullish thesis that you have underpinning the reason why you are optimistic and you are still risk on. How much does that get challenged by some of the commentary we've heard from Fed officials that they're trying to balance the potential for higher inflation on the heels of tariffs with potentially slower growth?
Yeah, I mean, look, I'm not a Fed, expert. I'm a portfolio manager, but I just look and say, look, if the economy starts to weaken, the Fed is going to step in. I don't know if the timing will be perfect, so it doesn't mean you can't get drawdowns. Again, going back to, I suspect it's early in this year we'll get a 5% pullback. I suspect we'll get a rally, and then we'll get a bigger pullback at some point this summer. But I think the Fed has equity investors back. It's the Fed put, which is they will, if we see more meaningful cuts, if there's more uncertainty out of Washington, a la tariffs, that creates, concern amongst companies, I think the Fed will step in. And
Andrew, it's interesting you say that. Can I just jump in? Because when they talked about increased uncertainty at the end of last year, it actually led them to raise their inflation forecast, not drop it. It actually led them to reduce the amount of cuts they forecast, not increase them. And I just wonder why that's going to change sometime soon.
Because last year, the economy was doing really well. And, you saw fourth quarter numbers came in great. But my point is, will they pivot? I don't think they'll need to. I think the economy will have to stay in. But to answer Lisa's question, my point is, I think the Fed counterbalances what's going on in Washington. Washington really steps on tariffs, really steps on that hurts companies. I think the Fed incrementally gets more dovish.
Andrew, appreciate your time. Thank you, sir. Andrew Slimman there of Morgan Stanley. Check out the bond market. Rally at the front end of the yield curve. We're down about 7 basis points on a 2-year, 3.93. in America. Keep an eye on that. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just that latest data. You mentioned U.S. employers announcing the most job cuts since 2020 last month. That's according to data from Challenger Gray and Christmas. The government sector saw the biggest reduction with nearly 62,000 workers laid off, thanks to DOGE. Overall, job cut announcements increased 103% in February compared with the year prior. It also comes before jobless claims data, which is due out in just a few minutes, and the payrolls report out tomorrow. Alibaba shares rallying after it unveiled its latest open source model. It is a big leap over its previous versions while just using a fraction of the data that DeepSeek's R1 uses. Alibaba has pledged to invest more than $52 billion on AI infrastructure over the next 3 years. And a check on Kroger shares in the pre-market. Those are down about 1/3%. The grocery store chain reported fourth quarter sales of $34.3 billion, just shy of analyst estimates. It is the company's first report since its former CEO, Rodney McMullen, resigned Monday following a personal conduct probe. And that's your brief, John.
Danny, thank you. Thank you very much. Up next on the program, an ECB rate decision, plus Pooja Kumra of TD Bank here to react from New York City. This is Bloomberg.
Is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
ECB rate decision just dropping, coming in at 250. The estimate was 250 on the deposit rate. The previous number, 275. So that's a 25 basis point reduction, as anticipated. So no big change there. Get to some of the other headlines elsewhere. But just to set the scene, the attention has shifted from monetary policy to fiscal policy in a big way over the past few days. And that's driven yields much higher across the continent as we anticipate a big loosening of the fiscal push out of Germany. What does that mean for this market? Just to touch base with the FX market, euro dollar back through 108. We're positive by 1/4% at 108.18. Lisa, what are the headlines?
But to me, the fact that the ECB said that monetary policy is becoming meaningfully less restrictive is the initial move towards saying that we are closer to a neutral rate. This is going to be considered the baby step toward maybe shifting to a pause at a time where, as you said, fiscal very much in the front and center, otherwise saying that the disinflation process is well on track and that wage growth is moderating as expected. So here's the question. At what point are they setting up for a pause, and how much does fiscal factor into that?
Let's get to the team coverage. Bloomberg's Lizzie Burden joins us now out of Frankfurt alongside Ollie Crook in Brussels. Lizzie, first to you. Let's get to the decision. Go through the details, what you're looking for from the news conference in 30 minutes' time.
Well, John, this is what was expected in terms of the decision, but the focus very much on the path ahead. And Lisa, you bang on to focus on this language around the restrictiveness of policy. They're saying that it's becoming meaningfully less restrictive. So they've not quite dropped the language. If they had dropped it, it would have suggested an end, perhaps, to cuts. Maybe this suggests a pause to cuts. And it's not quite keeping it fully, which would have suggested that you'd have another cut in April. So keeping their options open because there is just so much uncertainty uncertainty, both on the tariff front and on the fiscal front. Friedrich Merz has pledged to do whatever it takes when it comes to defence and infrastructure spending. You've talked about the massive impact on the bond market, and I'm sure that that's going to come up in the press conference with Christine Lagarde. How much is the ECB going to do to support all that spending? And what if you see these spreads widening to the point that actually you do need the ECB to step in with the transmission protection instrument?
In the ECB's words, uncertainty is rising. And Ollie, some of that uncertainty comes from where you are on the fiscal front.
Yeah, absolutely, John. I mean, I think it'll be very interesting to see what Christine Lagarde has got to say in the press conference. You know she's going to get pressed on this. I mean, if we're talking about the Germans basically pumping €1 trillion into the economy over the next few years through sort of infrastructure and defense spending, that is going to obviously have material effects on a number of different things, not just borrowing costs, but, you know, heating up the economy. What will it do to inflation? I mean, we talk about the labor market. I interview a lot of CEOs from the defense space. There's a sort of real lack of skilled labor in order to, if you want to actually build out all of these developments. There's some of them are taking full teams from the auto sector, which is in a cyclical downturn, going into defense. I mean, this has really the potential to really rewire the European economy in a major way. And again, we'll get in a few hours' time now the sort of fruits of the discussions here. How many hundreds of more billions are going to be unlocked at the EU level to be sort of pumped into the economy, to say nothing of the fact that if they do actually loosen those fiscal rules at the member state level, that's going to have big national consequences as well.
Ollie, appreciate your time. Ollie Crook out of Brussels alongside Lizzie Burden in Frankfurt, Germany. More from Lizzie later on today. She's in Frankfurt, Germany. That ECB news conference is about 25 minutes away. There's a line from the ECB that's just dropped, not pre-committing to a particular rate path. That's a line you hear a lot from the European Central Bank, but it takes on a whole new meaning. Only a month or two ago, I would say maybe even only a month ago, we thought, and maybe there was a really strong argument for this ECB to need to get accommodative, to cut rates even more aggressively. Here we are a month later, and the ECB is in absolute no man's land because the German government is looking to push through a big easing of fiscal policy.
Honestly, I can't even imagine how Christine Lagarde is going to give any guidance at a time where, if you take a look at their forecast, they lowered their economic growth forecast for the Euro region in 2026. They also lowered the inflation forecast going forward, but increased it this year. At the same time, we don't understand what the implication is going to be from tariffs. So on one hand, you have the great divide of suddenly this watershed German spending moment, and then you have the potential for U.S. growth slowing and potentially tariffs putting up the walls to Europe. You put that together. Good luck, Christine Lagarde.
It needs to be across a number of things as well this morning, not just in Europe. So over in Europe, the German debt market yesterday, biggest sell-off we've seen going back to the 1990s, a move of 30 basis points on a 10-year maturity. This morning, up another 6. Here stateside, we've got equities near session lows, down by 1.4%, just about on the S&P 500. Yields dropping at the front end of the curve on 2s, as we anticipate jobless claims data that drops in about 10 minutes' time before payrolls tomorrow morning.
Yeah, right now what we're seeing is exactly the script being flipped on its head, where suddenly growth looks potentially stronger in the Euro region and the potential for spending. Those jobless claims and those planned job cuts from Challenger really did shift the conversation just slightly. And now you see an increasing number of Federal Reserve rate cuts being priced into the market.
To extend the conversation, Pooja Kumrat of TD Bank joins us now for more. Pooja, welcome to the program. Let's start with Europe. Where does this effort from Germany leave the European Central Bank and Christine Lagarde in 20 minutes' time?
Good luck to Christine Lagarde, as you said in the conference. I think it's a very tricky situation. I think one thing which they were not expecting was such a big fiscal package. And how it gets implemented is still a big question mark, right? We have this envelope that's been given that will be spread out over 10 years. So we really don't know how much of it can actually get into the growth in the short term. Like, just to give you some perspective, we had an 800 billion NGO program that actually gave 1% growth in the 10 years. So I'm not sure how much it impacts the growth narrative for ECB right now. And even when it comes to inflation, it's hard to actually pencil down when we also know there's a risk of tariff. But I think for me right now, its key is, how do they think about restrictive? I think if they really seem a bit more complacent that they do not need to cut more rates, I think that's where you could see bunds getting really hit right now. And not just bunds, as we can see in today's session, the entire EGB complex is getting hit right now. Next, I will also be looking at how they are viewing the fiscal package. In case you missed, we did see S&P actually considering this fiscal package actually positive for German growth and its credit rating. I think in theory, it's a great concept, but what markets were not prepared for is like within a scale of 2 days, we've got easing from both EU and Germany, and which is really hard for markets to take in, especially in the world when ECB is not buying any bonds.
Pooja, I'm just curious, the comment from the ECB that they're not pre-committing to any particular path and that, frankly, they think that there has been a meaningful shift toward being less restrictive for policy. What kind of color are you looking for in the press conference soon?
So I think since ECB has actually released their paper on what they think about neutral, which is a range of 1.75 to 2.25, there's a lot of actually arguments, even within the market, as well as there is a lot of views across the General Council board as to what does ECB define neutral as. So I think here I would like to know what are they thinking. Do they really believe the statistic papers that said 1.75 to 2.25 is the range? And what I would be also looking at, okay, as a long term, given the fact that say in the period of 5 years, we do have this spending coming in Europe, and then how do we define this new neutral? So I think that would be key right now, and I don't think ECB is in the shape to actually answer this question, just given the fact that nothing seems to be certain right now.
Well, looking through the statement, it talks about lower exports, ongoing weakness and investment, in part originating from high trade policy uncertainty, as well as broader policy uncertainties. What's going on in the United States, even though we haven't seen these tariffs yet, is that already impacting on the ground what's happening in Europe in terms of trade and exports?
So far, the PMIs in Europe in Jan actually saw a pickup just because everyone was front-loading the entire tariff impact. But right now, general sentiment is we really don't know whether that's coming or not. April 1st is when we will get to know what is the consequences of all the retaliatory tariff that Trump is proposing. And if that goes through, it's a pretty big hit for European economy. If you look at VAT as well as the normal getting the tariff deal done, it could actually hit Germany close to 20%. So that's a very big move. But the idea, I think, with all central banks is we really don't know whether these tariffs are coming or they are just a negotiation tool. And I think that's what ECB will try to say, that they really have no clarity when it comes to tariffs. They know they are coming. I mean, it's very evident that Trump is actually coming to Europe. It is whether you think about the Ukraine war, whether you think about the NATO spending for defense, and next will be the tariff part. But actually, ECB as a whole needs to be on a wait and watch mode till April 1st.
Pooja, appreciate your view. Pooja Kumar there of TD Bank on the ECB after reducing interest rates by 25 basis points, and no one's going to talk about that rate cut. No one's going to be talking about that rate cut. They're interested in two opposing forces right now, which is fiscal stimulus potentially coming out of Germany. And I stress potentially because it's not done until it really is done and the money's hit the ground and we're actually doing things off the back of it. But at the same time, in about a month from now, could have additional tariffs on the European Union. And the ECB has got to somehow work out how to set policy somewhere in between.
So that's the reason why everyone's just looking at this statement that monetary policy is becoming meaningfully less restrictive and saying, what do you mean by that? And how much does this mean? And you're not going to cut rates again? The
news conference 20 minutes away. Look out for that. In just a moment, we'll talk jobless claims, more economic data just around the corner. Constant Hunter of the Economist Group, David Rogel of BlackRock, here to react.